90% of the grapes went unpicked.
Wow.
They just fell on the ground.
Are the wine makers running into financial trouble as well?
Yeah, I think everybody's feeling pressure. That said, I've talked to some wineries that are doing fine. You know, the ones who are making really good wine and have a strong following and brand and are doing interesting wine.
What's it doing
They're telling us to wrap.
What's it doing to real estate in places like Sonoma?
Well, right now,
Asking for a friend.
right now, prices are still high. You know, the real estate prices in Napa, Sonoma are still very high. It's one reason those wines are expensive. You know, though, I'll just say quickly, since we're at this affordable red, Banshee Mordecai.
Affordable red.
Affordable red, 24. Again,
$24.
yeah, again, a good one for, you know,
But this is
holiday.
a whole mishmash of a ton of different grapes, right?
It is a mishmash of crazy grapes. It's Syrah, Mourvèdre, Cabernet, several other things. And
It's like
then
there's 17 different grapes.
So that's $24.
Yeah.
Now we're going to the prices.
now over here for the pricey stuff. So I brought this one because UNESCO just declared Italy's cuisine an international heritage. And as far as I'm concerned, wine is part of cuisine. So this is an Italian wine.
What's this go for?
This is $189 a
The
bottle.
funny part is I never know the difference. You know, you could give me the most expensive wine in the world, I wouldn't know the difference. You give me the $24 lot, and I might like,
$24 was
Yeah.
a little sweeter. I like it.
It's a little sweeter, a little softer. This is a little more structured. It's from Le Macchioli.
oh
It's
yes.
a little hard.
Cinzia Merli is a brilliant woman who makes great wines. You know, but the 24-buck wine's a really good wine too. And so it kind of, you know, affordable is in the eye of the beholder.
You must be one of the most popular party guests to have this time of year. I imagine your dance card is full. Because I would want you at any party I was at.
I go to a lot of parties with a lot of wine. Then the other hand is people are scared to bring wine to me, which is kind of unfortunate. My friends are like, I'm not bringing you wine. I'll bring you a cake, you know. So,
Great, thank you for doing this for so many years.
yeah, it's such a pleasure. Thank you.
Good to see you.
Happy holidays.
Absolutely happy holidays. When we come back, a lot more this morning. Some big corporate stories, including the government kicking off the process to allow NVIDIA to export high-performing AI chips to China. But first, before we head to that break, take a look at yesterday's S&P 500 winners and losers.
Oh yeah. What they got going on here, CNBC? Little upgrade. We have an intermission video. CNBC is currently on a commercial break. The video. AMD hit $200. Doom. This is strange.
Five things to know ahead of the opening bell this morning. Japan's central bank raising its short-term interest rates to a three-decade high of 0.75% to help lift the country's 10-year Treasury yield past 2%. The Bank of Japan also signaling readiness to tighten further. Meantime, data center deals hitting a record $61 billion in 2025. That's according to the S&P Global. European Union leaders agreeing to loan Ukraine more than $100 billion to help the country defend itself from Russia for the next 2 years. But EU countries could not agree on a plan to use frozen assets from Russia to support Ukraine's defense. So that's still on the table. House Republican leaders committed to vote in the new year on legislation to ban members of Congress from owning or trading individual stocks. That's been on the table for quite some time. The government on the way to potentially allowing sales of NVIDIA's second most powerful AI chip to China. Reuters reporting that the Commerce Department has sent licensed applications for sales of NVIDIA's H200 processor to the state energy and defense departments for review.
When we come back, we've got CNBC's list of the most valuable college sports programs in America, an already lucrative industry growing even richer. And a reminder for you folks, you can get the best of Squawk Box in our daily podcast. Just follow Squawk Pod on your favorite podcast app and you can listen anytime. We'll be right back. College sports valuations are surging, driven by bigger media deals, expanded playoffs, conference realignments. Among the factors changing the college landscape and driving record valuation, you've got name, image, and likeness rights, known as NIL, and a pro sports business model all taking shape. The top 75 athletic programs are now worth a total of $51.2 billion. That's up 24% from 2024, according to CNBC's official college valuations list, which is out today. This year's most valuable athletic program is the University of Texas at Austin, which is valued at almost $1.5 billion, $1.48 billion. They're followed by Ohio State, Texas A&M, University of Georgia, and the University of Michigan. And joining us right now is the man behind the list, CNBC's very own senior sports reporter, Michael Ozanian. Mike, thanks for joining us.
Great to be here.
That is a big jump in these valuations, better than any of the major averages this year. The NASDAQ is up by about 19% for the year to date. So what happened?
As you read, Becky, what we're seeing is a huge increase in media rights. The Big 12 just doubled its media rights agreement. If you look at the top of the list, dominated by Big 10 and SEC schools, they have the largest media rights deal. The college football playoffs, currently 12 teams. They just got a new deal with ESPN. It's going to increase the value to $1.3 billion starting next year. The college football viewership is second only to the NFL. So you're going to see media rights continue to increase, thus the interest from private equity.
And by the way, these are schools with big football programs.
Oh, yeah.
At the top of the
Football's
list.
the driver.
There are going to be fans, legions of fans who follow this pretty closely, and I'm guessing the University of Alabama fans and the Notre Dame fans are going to be ticked off at you. Where are our programs? Why are they not in the top
Well,
five?
Notre Dame's ticked off because they missed the playoffs.
Yeah,
I
that
think
too.
they should have. Wait, listen, Notre Dame just got a new TV deal itself. They're independent in football.
They're the unicorn of all of them. They're the only ones that can do this without
Exactly. So their deal is actually very good. So they're going to be moving up in value. But if you go to overall revenue, one of the things we do include our donor money. So like University of Texas, they got a huge increase from donors. One of the reasons was they renovated their stadium. They've redone the locker room. So that could have big year-to-year fluctuations. Ohio State actually, for the fiscal year we looked at, had 2 fewer home football games, which is one of the reasons why their revenue didn't climb as much.
Explain the methodology. Explain what you put.
So we basically look at total revenue, and then we apply a multiple.
Oh, by the way, there's Notre Dame at number 6. Tennessee and USC still beat out Alabama, which comes in right ahead of Nebraska.
We start with total revenue, and then we adjust the multiple of revenue we look at based on things. How much NIL money are they getting? Because starting next year, NIL money is going to be on the balance sheet. So it's a big factor. It's one of the areas that you noted that is surging in college sports.
The NIL money that they're getting, is that largely coming from alumni? Where else are they getting?
It's largely coming from alumni or outside programs outside of the school that basically facilitate this for the individual players. So it's coming from both. That's one of the things that they're trying to figure out is how do they organize this and regulate it?
Yeah, it's a tricky question for sure. There's also this whole question about private equity that is now looking at all these programs as a way of getting more NIL money coming in. And this is really, this is no more a college program at this point.
It's pros. It's the pros. And the University of Utah became the first school to cut a private equity deal. They announced that a few days ago. Some private equity deals are looking at entire conferences. The pension fund in California is, gotten pretty close to doing it with the Big 10 just on their media rights. USC and University of Michigan sort of have pushed back against it at this point, but some of these deals may take entire conferences.
What's your thought on what it does to the sport, how it changes things, how it changes the university programs? I mean, we've always emphasized that these are student athletes, emphasis on student in many of these programs. That doesn't seem to be the case necessarily for the future.
It's professional sports.
These are like gladiators.
And it's these players now, you see they go into the player portal. They change teams almost every year, some of the better players. They're not starting on one team, they go to another school. So really, people are trying to wrap their head around this, figure out how do we monetize it? How do we keep the team really good? And thus you're seeing coaches like Lane Kiffin leave. He leaves Mississippi, goes to LSU for this enormous contract. Why? He thinks there's a better chance of winning a national championship there.
You know, I watched the Nick Nolte the college basketball movie.
Great
with
movie.
Chips. It was 1994. I just watched it again this past week, and it was shocking in how it kind of laid out the precursor to everything that's happening right now. I'm surprised that hasn't gotten more attention and kind of a resurgence, because that was all based on this idea that he didn't want any dirty money coming in. And the pressure that he was under to try and win with these situations. I can only imagine these college coaches are facing so much of it now. It's not fair to rip off the college athletes and have schools make all this money,
Right.
but this brings all kinds of new problems of its own in terms of
What
it
I think,
does.
what I think's going to happen, one of my concerns, a lot of people's concerns early on is what's going to happen for the less popular sports. So what happens to the volleyball team, the swim team, and so forth. And what I think is going to happen, it's going to take a number of years, is those sports too will be able to monetize their popularity and revenue streams. Because if you look at, for example, the WNBA or the NWSL, the Women's Professional Soccer League, you go back 5 years ago, their revenue, their valuations were nothing. People woke up and said, these women's sports are incredibly popular. A lot of people do watch them. They want to see them on social media. So I'm hopeful that as popular sports like men's football, men's basketball, we're seeing all the money pour in. I'm hopeful that more money will pour into these other sports as well.
Question for you. Your friend Alex Sherman was here and talked about the possibility of lockouts
Yeah,
this
at
year.
the WNBA.
Major League Baseball and WNBA this coming year. That was sort of one of the predictions of one of the executives that was anonymously quoted. I don't know if you think that's even possible, but if it is, what happens to all of these valuations that we're talking about?
Well, I go back to the NHL. Gary Bettman had
Worked out
two,
for him.
right? And he put in a hard cap. They missed a couple of years. It really hurt revenue, hurt value short term, but it's really paid off long term. The value of the NHL team is soared. My personal opinion is the players in the WNBA aren't getting their fair share.
That's what I think too. That's I understand the Gary Bettman school of thought on this, but the WNBA.
Yeah, and I also think that for Major League Baseball, they have a huge problem because right now, you know, you have the Dodgers and then you have everybody else. But the Dodgers tie to Guggenheim and all that money and the ability to defer the contracts, I think you will have a strong enough constituency of teams that are going to...
If the WNBA does a lockout, I mean, the difference now is there's a competitor. Unrivaled, and maybe Unrivaled goes broader, does it longer, so they're only in the off-season right now. But if you do a lockout with the WNBA right now, I think you run a bigger risk of some competitor popping up and taking them.
But ultimately, the competition will be good for the players
Yeah.
at some point.
Yeah.
You know, again, it's short term, no, but these players, you know, you look at these players, they get some great viewership numbers out there. It's you know, it's very
Yeah, they
exciting.
are the ones bringing the fans.
Exactly.
Yeah.
You know, and that's the same thing that happened with college sports that we're talking about. The players woke up and said, hey, the schools are making all this money from these used TV deals. Then
Why
the
shouldn't
coaches
we?
started to make all this money. What about us? And when they won that court case, it opened up the window for this.
Yeah, I'm so torn because you see both sides of it, but you don't want the athletes who are actually doing the work to be taken.
Genie's out of the bottle,
It
as
is.
they say.
Yeah. Mike, thanks a lot.
Thank you.
Great to see you. By the way, you can check out cnbc.com for the full list to see how your school stacks up, and you can write to Mike to complain if your school's not where you think it should be.
Okay, coming up, just how much is OpenAI worth? A new report saying the company is raising money at a valuation approaching $1 trillion. That is with a T, folks. We're going to get that story right after the break. Don't go anywhere. But first, got to hand it over to our friend at AccuWeather, meteorologist Bernie Rayno. What's going on?
It is a windy Friday across the Northeast with rain along the East Coast. In Boston, New York City, Washington, D.C. this morning, drying out this afternoon. Look at the cold. Your AccuWeather exclusive forecast, 20s in Minneapolis, Chicago. Cooler in the Southeast. Looks great in the Southwest. How about 71 in Los Angeles? Still a few showers in Seattle. If you're doing your traveling, delays. Boston, New York City, all day today should be good in Dallas. To help you make this best decisions and be more in the know, make sure to download the AccuWeather app today.
Welcome back to Squawk Box. So OpenAI is reportedly looking to raise as much as $100 billion for its expansion plans, which could value the company as high as, ready for this, $830 billion. So we're getting close to the $1 trillion mark. The Wall Street Journal saying that the earliest fundraising round would be completed at the end of the first quarter of this coming year. And then OpenAI expected to draw in financing from sovereign wealth funds as well. Earlier in the week, the information reported that OpenAI had held early talks with investors about raising funds at a $750 billion valuation. So those numbers keep going up. Who did this? Are you responsible for this?
I did not.
Do I have to read this myself?
Well, actually, let me read this.
This is like
Okay, let me read this.
You
How
can
about
read
that?
it because I can't. I didn't know that some producer was going to do this to us.
All right, well, this is something worth celebrating. We had the champagne already this morning when we were looking at wines to be checking out over the holidays. We should have saved it for this moment. Former President Barack Obama out with his list of favorite books from 2025. And guess who's on the list? They include Michael Lewis's book, Who is Government? His wife, Michelle Obama's book, The Look, and Andrew Ross Sorkin's 1929. So there you have it, folks. Barack Obama himself recommending Andrew's book, and I think it worked, right?
Yeah, I was so surprised. I mean, by the way, I look at his list every year.
But I think his list is influential, and it actually
Oh,
gets into sales.
you can look at Amazon sales and you can see things moving around. Absolutely. So, Mr. President, former President of the United States, thank you.
And
Appreciate it very
congratulations, Andrew. We should have saved the champagne for this
much.
before
Well,
they took
who
it
knew?
away.
I didn't know that
Cheers
they would
with our
mention
coffee
this
and
on
tea.
TV. So there you go. Thank you.
All right. By the way, folks, you still have time to order if you haven't yet. If you have last-minute Christmas presents you're looking for, to sign it for you. Order those books and order them right now on Amazon. When we come back, we're going to get into Nike's latest earnings report. Wall Street, not a fan of the numbers. That stock is down pretty big this morning. We're talking double-digit declines. We'll talk much more about this right after this break.
We got some news on Nike today. Nike shares down sharply, really on China weakness, also some soft guidance. Joining us right now is Kevin McCarthy, his Neuberger Berman, a senior research analyst. The stock off about 10% right now. Kevin, you heard what we heard from Nike about all this. Do you say to yourself, this is a dip worth buying? Do you say that there's more to go? What are your feelings here?
Yeah, good morning, Andrew. I think clearly the market is going to be disappointed by these results today, in particular the lack of financial progress. And I think, frankly, that we need to take their word for it, that this will not be a linear progress. That being said, I do think that there were some redeeming qualities in the quarter, some encouraging data points, particularly out of the U.S., that in my view doesn't really change the long-term earnings power of the story. So yes, I'd be a buyer on a day like today.
59.09 is the price tag right now. What do you think the price should be 12 months out?
What I think that this is a alpha generative investment higher over the next couple years, without putting a precise number on it. If you're looking at something in the mid 50 billions in revenue, getting back to the double digit margins, 10% as your starting point, that I think is kind of your financial recovery starting point. And then you kind of start to think maybe what is potentially an option with margins going higher? Could it go 20? Could it go 30% higher? But I think you kind of pick your multiple on top of that for a growth business. So
how happy are you with this management team?
I think there are changes still. Elliott is still trying to find who he trusts, who he relies on. So there are some shifts being made, but I think he does know, I think he knows what he needs to be doing. And again, going back to some of the more kind of the encouraging data points on progress, the U.S. started first, right? So, we've got now clean U.S. inventories, which has been a slog to get through. Order books are improving. Gross margins ex tariffs, they were actually up. And you could argue that Nike's actually doing okay where they can effectuate the most change, which is in their direct stores. So why is all of this important? Yes, it's important because of full price selling and better margins, but at the end of the day, this is a turf war being done sport by sport, region by region, channel by channel. They started in the U.S. We're seeing the progress points in the U.S. and over a couple-year period, I think that, like I said before, this will be an alpha generative opportunity.
How much of this, though, just has to be about the Nike brand reemerging as hot again? I think one of the big questions is just from a zeitgeist perspective, where Nike lies in all of this.
I think Nike, when you look at teen surveys, is actually still faring pretty well. They've got a lot of blocking and tackling to do. I think the re-entering the zeitgeist is going to take time. And so when we think about kind of the cadence of how innovation is going to flow through, it's going to start with performance. The performance is what inspires the lifestyle. The lifestyle is what kind of gets you into the zeitgeist. That's going to take time. They don't need all of that to get into their double-digit margins. But I take your point, and I think it is a battle, and they got to put some wins on the board on the performance side before it kind of matriculates into the lifestyle side of the business.
One final question for you, Kevin. I think a lot of folks are watching what's going to happen with tariffs, whether it's the Supreme Court and what comes out there and how things move. Do you think that re-scrambles the story?
Oh, for sure. I mean, if it depends on the magnitude. But I think that could quickly change. I mean, we're talking about 300 basis points. There's over 300 basis points of impact. So, yeah, that would be a game-changing situation. But there is still a lot of blocking and tackling that they can do to elevate the brand to where they want it to be.
Okay, Kevin, good to see you. Wish you a very happy holidays. Look forward to seeing you again. Very, very soon.
Congratulations on your book. I'm gonna have to pick that up for the holiday. All right.
There you go.
He knows the way to a man's heart. There you go. Thank you,
I would
sir.
also say Michelle Obama is also on the book list too, though.
She
So
is.
Just throwing
She is
that
on the
out
list,
there.
as she should be. As she should be. Another book to go out and get. The Look is what it's called.
Yeah.
Meantime, we're coming up just on 7 a.m. On the East Coast. You're watching Squawk Box on CNBC. I'm Andrew Ross Sorkin, along with Becky Quick. Joe is off today, but we got so much going on right now. Our top story, TikTok, reaching a deal to keep operating in the U.S. That's according to a new memo out. 2 TikTok's employees from the company's CEO, the social media company, and its parent organization, ByteDance, have now signed agreements with Oracle, Silver Lake, and the UAE firm MGX to form a new TikTok U.S. joint venture. We're going to bring you a lot more on that story later this hour. Meantime, President Trump speaking to NBC's Kristen Welker in a wide-ranging phone interview. He said he is not ruling out going to war with Venezuela. And on tariffs, he confirmed that he views them as permanent. He said they've given us greater security and wealth, reaffirming something that Scott Bessent has said repeatedly. And then House Republican leaders committed now to vote in the new year on legislation to ban members of Congress from owning or trading individual stocks. They've committed to do that. We'll see whether they actually do. Becky Quick.
We have some breaking news on the race for the Fed chair job. Our senior economics reporter, Steve Leisman, joins us with the details. Really?
Good morning, Becky. Senior administration officials telling CNBC that Fed Governor Chris Waller had a, quote, strong interview with President Trump in which the two discussed the labor market in depth and how to jumpstart job creation. The interview took place in the president's residence and concluded shortly before the president stepped to the podium and addressed the nation on the economy on national television Wednesday night. Treasury Secretary Scott Bessent, Chief of Staff Susie Wall, and Deputy Chief of Staff Dan Scalino also attended the interview. It's a sign Waller's candidacy is being taken seriously, though the officials declined to say if he's the front runner or where he stood in the whole race for the Fed chair job. CNBC also learned BlackRock's Rick Rieder will be interviewed at Mar-a-Lago for the Fed chair job in the last week of the year. The officials said that at least 4 candidates, including NEC Director Kevin Hassett, the favorite for the job in the prediction markets, and former Fed Governor Kevin Warsh, who had been previously interviewed by the president. The officials added that Fed Governor and Vice Chair of Bank Supervision Michelle Bowman no longer being considered for the job. Now, the officials said the conversation about jobs with Waller showed criticism was misplaced that the president was seeking a candidate based on the criteria that the next Fed chair would follow the president's orders on race. They said the president's interest in the interviews with candidates was broad-based across a series of economic issues. On a lighter note, the president was said to have been seriously impressed when informed that Governor Waller could bench press 350 pounds.
You know, you always bring us the details that matter, and that's a no. I'm not saying that sarcastically. Like, those are like those little details that bring you inside the room.
I heard in awe was what I heard.
In awe.
In awe. I heard that from a separate source.
That's
I've
a lot.
seen Waller. I'm actually surprised and impressed by that, too.
Yeah. Governor Waller has a pretty strict workout regime, with my understanding.
Okay,
Yeah.
so all of these reports, all of this kind of what we're seeing now with these interviews,
Yeah.
is all to counter what the president himself has repeatedly said, that he had somebody in mind, that he knew who it was going to be.
So that and the idea that the president wanted somebody who was only going to listen to him on race, they're definitely emphasizing that there's more interest, more discussion on broader economic topics in these interviews than just are you going to listen to me. We continue to hear that, and look,
This is not to counter reporting that's been out there. This is to counter what the president himself has said.
Becky, I think you're hitting on something that has amused me, that sometimes the president is not his own best friend. Right? Like when he sat there and with the affordability stuff in the background, then he called affordability a hoax. You can imagine people around the president kind of cringing in those situations, you know, when they thought they were, remember the great constant theme of Infrastructure Week? That was going to be an infrastructure week and never quite wasn't. Sometimes the president is not his own best friend, but we can report with certainty that they did discuss jobs. It wasn't all about Are you going to lower rates and
Is
listen to me?
Is the president himself not locked in? Is that the message you're getting back, that he's not locked in on one candidate and he's still waiting and going through these interviews, and we will see where he goes a month?
Yes, that is. You can read this online, Becky, and so can viewers, by the way. That this is a serious process following. Look, I was surprised a couple weeks ago when the president on Air Force One said, "I know who it is," and then we were able to report that interviews were canceled. I don't know if you remember, but I guess it was back in October. I was able to break the story of the process that Treasury Secretary Scott Bessent had laid out.
Yeah.
And it looked like one that, by the way, is both real and symbolic, right? Because this pick for Fed chair is something being watched down the road at Wall Street, but 5,000 miles away in every financial center anywhere around the world, and in Japan. Not only who is picked, but the how it's picked matters a lot. It always has. I've done, I think, 4 or 5 of these processes over the past several decades.
It reminds me a lot of what we're hearing with Warner Brothers Discovery and the bids that have come in for this. Is the president actually in the camp of the Ellison bid from Skydance, right, or from Paramount Skydance, or is he saying no? I'm not in that camp, and if it's Netflix and it's an American company, I'm good with that too. I'm good for whatever shows up. A lot of this is process to undo things that have been said, again, not by the press or anybody around him, but by the president himself in front of cameras.
That is an accurate point, Becky. And I think the other thing is that when they are now back on track with this process, the president is sitting down with these candidates. He's going to sit down with Rick Reeder.
Okay.
And I don't know.
I think Wall Street probably appreciates hearing that.
I think they probably
getting a good.
Yeah, especially I think the Waller Reeder people are because I think there's a lot of.
And you don't think, I mean, there are these other people who speculate this is all, not theater, but, you know, that he's got the selection, but that he also wants to suggest that there is a process so that he can say that he's looked at everybody.
You know, Andrew, if that's the case, they're going through an awful lot of hoops to jump. You know, you get these key people that are running the U.S. government in a room to talk to a guy for however long, I couldn't determine how long it went. For theater, I don't know.
I'd get mad if I was wasting hours and hours of my time and I'm not the president. So.
Yeah, I mean, if the president wants to cut it off, and it will be his choice, and I know people around him don't know who he's going to pick yet. I do.
But are you saying he doesn't know who he's going to?
I don't think he. You know, I don't think so. I think he wants to meet with these people, and he wants to talk with them. And look, there's another sign in all this that the president is maybe a little more concerned about what's happening in the job market. The job numbers have not been good. Right, and he needs to turn his attention to that, and they need to figure that out.
I just want to go back to this. It's a 350-pound bench press, not a deadlift. This is a bench press.
I'm not smart enough or spend enough time in the gym to know.
350-pound bench press. That is really pushing weight. I'm not saying a deadlift. By the way, a deadlift of 350 pounds is a lot too. I'm just thinking to myself,
I might have just
throwing around a lot of weight.
You know, now we're going to get all these texts and tweets and stuff from people who really do this stuff. But
he's like a big guy, but
he's not that big. He doesn't look as big as.
Yeah, I was going to say 350 pounds benching.
No, that's not what impresses me.
Okay.
What impresses me is 350 pounds and expertise in monetary policy and the economy and getting inflation and interest rates right.
It's like
that's what impresses me.
It's like you with fishing.
Exactly.
Okay.
Exactly. And
Steve, thank you, sir.
My pleasure.
I want to take a quick look at futures on this Friday morning. The Dow up about 17 points. NASDAQ looking to open about 81 points higher. S&P 500 looking to open higher as well. Take a look at this. We're going to send it over our friend Frank Holland with a look at this morning's pre-market movers. What's on tap?
Hey, good morning, Andrew. We're going to start things off with Nike. The pre-market laggard on the S&P, despite beating estimates in fiscal Q2, as its China sales came in well below estimates, dropping 17%. You can see shares pulling back about 10.5%. Nike also guided low single-digit sales declines for the current quarter and a more than 3% gross margin hit due to tariffs. Now, if this move holds, again, 10.5%, it would be the stock's worst day since back in April. Meantime, take a look at FedEx shares. We saw them pop after earnings this morning, actually pulling back fractionally, pretty close to flat, though. This is despite beating estimates in Q2. It seems to be guidance weighing on the stock, along with comments from CFO John Dietrich that the shipping giant will, quote, see meaningful headwinds from the grounding of its MD-11 fleet in the current quarter. FedEx also saw some weakness in its freight division that the company says is still on track for a spinoff coming up in June. Also looking at NVIDIA shares this morning, taking a look, they're moving higher, though, up over 1% after a Reuters report citing sources that the Trump administration has begun a review of NVIDIA's advanced chip sales to China. President Trump said earlier this month he would allow NVIDIA's advanced H200 to be sold in China if the U.S. received a 25% cut of the sale. CNBC's reached out to NVIDIA for comment. Again, shares of NVIDIA up just about 1%. Back over to you, Andrew.
Frank Holland, thank you, sir. I want to wish you a happy weekend, and we'll see you next week.
Yeah, thank you.
All right, when we come back, President Trump signing an executive order to ease restrictions on marijuana. We'll tell you what it means for pot stocks next. And later, former TikTok CEO Kevin Mayer will join us on the news that TikTok has signed an agreement to create a new U.S. joint venture. That's coming up in the 8 o'clock hour. Squawk Box will be right back. Welcome back, everybody. President Trump has signed an executive order to reclassify marijuana from a Schedule 1 to a Schedule 3 drug. While not making it fully legal, it would ease federal restrictions. Joining us right now with what this means for the marijuana industry and personal consumption is Kevin Sabat. He is the CEO of Smart Approaches to Marijuana, a former White House drug policy advisor, and he's the author of One Nation Under the Influence. Kevin, first of all, thank you for being here. It's been a while since we've had to talk to you. for those who aren't familiar with it, let's go back and talk about, you were an advisor in the Obama administration, and I believe, correct me if I'm wrong, I believe when you went into that job, you thought that that marijuana should be legalized, and you changed your mind after you saw more details, saw more research. Is that a correct assumption, or is that a correct description?
Well, I was always a little skeptical of marijuana legalization just because when you look at the data, today's marijuana is so much more harmful than it once was. It's 10 to 30 times stronger. We're talking 99% THC in some cases. It's been genetically bred and altered to increase that. So it's causing things like psychosis now, which it wasn't doing 30 years ago. It's causing violence. It's causing a reduction in IQ. It's causing heart failure, diabetes, stroke. I mean, the things that we're learning on a daily basis, there's been tens of thousands of peer-reviewed studies on marijuana, and it doesn't look good. So, yeah, I'm very skeptical. Also skeptical of creating a new industry a la big tobacco that's going to lie to the American people about the harms and encourage youth consumption. I don't think for our country, I don't think we can compete on the global stage if we're stoned all the time. It's not going to be good for us.
I tend to agree with your theories on all of this. When I say anything like this on air, I have people come after me on Twitter, on X, and basically say I don't know what I'm talking about, that I need to educate myself. Why don't you tell me what you've learned?
Well, what I've learned is that every single medical association really in the world agrees that marijuana consumption is not a good thing, that it is much stronger than it once was. It's causing addiction. We have now 1 in 2 people who use marijuana in the past month actually use it daily. That's versus 1 in 10 for alcohol. So the numbers for marijuana have skyrocketed. But yeah, I mean, people sort of, they have their own experiences in college or whatnot, and they think that they generalize that. I get that. But that's kind of like saying because I can speed or I've sped on the freeway, we should get rid of speed limits because speed limits don't cause, reckless driving. I mean, it's just the anecdote does not make data. That's not evidence. And the evidence is really clear. Journal of the American Medical Association just last week basically saying that most people using medical marijuana, it's not really doing anything for them, and actually 30% of them are addicted to marijuana. So it's just the levels of THC we're seeing because the plant has been changed and legalization is promoted, commercialization is really off the charts, and it's worrisome, not just for young people actually, I think for the population as a whole. When we think about our workforce, we think about our pilots, our doctors, our bus drivers. Again, what is China and India doing? They're not legalizing marijuana anytime soon. So I think it's a great mistake that we keep kind of going down this path. But I also think people are beginning to wake up. I'm seeing a lot more coverage, and I'm getting a lot more positive emails and folks from people who have changed their minds because they don't like the smell everywhere. They don't think it's good. They've seen the psychosis and the schizophrenia, the mental illness that we have as a result of it. I've seen a lot of people change their minds, and even some states are looking at rolling it back now. So it's a very interesting time in this debate.
What does this executive order mean by changing the classification from class 1 to class 3?
Yeah, it's confusing, trust me, it's very confusing. It's essentially, the executive order directs the Attorney General to expedite the process for reclassification. It doesn't actually do anything new. There's already been a process. It started in the last administration, really as a political issue, I think, for the president, President Biden was very against legalization. But what this does is essentially encourage the process to move along. What it doesn't do is legalize banking, which that's probably why the pot stocks fell dramatically yesterday, because investors really want the banking. And, I think it's a very bad idea to allow the marijuana industry in the, U.S. financial system. It's just not a good idea at all. Now, what it is going to do, though, is allow for tax breaks for the marijuana industry. So some of the stocks did go up, some went down, but it was not up as much as people thought it was going to be at all with this announcement. So they will be able to take tax breaks, which I don't like because that increases the advertising and promotion. Like, I don't care if an adult smokes a joint in the privacy of their own home. I don't want to arrest adults for smoking marijuana. No one's calling for incarcerating them. I'm not saying we should put them in jail, but this idea of mass commercialization and promotion, which is what the tax breaks will do, is not a good thing. The president was very clear to distance himself, which was also interesting, from general marijuana use. He was saying he's not going to take it. He doesn't want it. He said that numerous times. RFK, the Secretary of Health and Human Services, emphasized the dangers. The director of NIH emphasized cannabis use disorder. I think there was some ambivalence. Really, this was driven by a few of the president's belt buddies, to be honest with you. Many of whom are investors in the marijuana industry. They have an incentive for this to go forward. what I saw in the Oval Office was actually a lot of people that not super comfortable with this idea of expanding marijuana use. They were trying to draw a real bright line between medical and non-medical, which is not an easy thing to do, but I think that's what they were trying to do.
I would say I'm of the same thing. I have a lot of empathy for people who need to do this for medical use. If you're a cancer patient, if you're someone who has epilepsy, there have been cases with Parkinson's where it seems to be super helpful. How can you look at that and say, is there a way to do this to make sure that people who really do need this from a medical perspective have access to it?
Well, yeah, look, but we don't smoke our medicines, right? We don't allow, we don't allow Tylenol with codeine, which is a Schedule III drug. We don't allow that to be infused in gummy bears and advertised on the freeway, right? So there's a proper way to do this and an improper way to do this. The proper way to do this is through FDA trials, and maybe we'll have more of them now. I don't know. There's already been 55,000 studies on marijuana, but we can have more, of course. I'm a PhD. I love studies, so that's fine. Research, we need to research, but the point is, if we can extract any of the therapeutic benefits and allow it to be delivered in an FDA-approved form, no one has a problem with that. We have plenty of FDA-approved drugs that are also dangerous, and we don't want them to be abused. So actually, that's not the issue. The issue is, selling joints and saying that that's medicine for the average quote-unquote patient who we know is a 32-year-old white male with a history of drug and alcohol abuse and no history of chronic illness, getting his card from a woman in a bikini on Venice Beach. That's not really medicine. And so I think there's the right way to do it and the wrong way to do it.
Kevin, thank you for joining us today. Where do you see this headed, by the way, just in terms of the legalization process? Do you expect 5 years from now that marijuana will be legal on a federal basis and that it will be part of the banking industry?
Well, I'll never forget debating probably the smartest person in drug policy about maybe 15 years ago, who told me with a straight face, and he had been right about so many things. He said, Kevin, we're going to have legal marijuana in Hillary Clinton's second term. You just wait and see. So the point being is, we don't know what's going to happen. It's been going, in so many different directions. Like I said, several states are voting against it, actually, to repeal the sales of legalization. Massachusetts, Maine, these are not exactly super red states that are doing that. There's no momentum in Congress for this. In fact, Congress was actually very upset about what happened, even with rescheduling. So there's zero momentum for legalization there. I don't really see this as a winning issue. It doesn't drive people to the polls. The president kept talking about 82% of people who want this, but when they find out that, how marijuana is tied to some of these negative health effects, like psychosis, like the other things that alcohol is not tied to, actually, they change their mind, and they're beginning to change their mind in a lot of places. Cambridge, Massachusetts, not exactly a neoconservative bastion, is leading the effort to repeal this in Massachusetts because they don't want to be smelling it everywhere. They don't want it around daycares. They don't want it around, kids. And so I think there's actually already a bit of buyer's remorse, which means it's extremely uncertainty, very bumpy road ahead. I would not be betting on legalization anytime soon. We'll see what's going to happen.
Okay. Kevin, thank you. Good to see you this morning.
Thank you too, Becky. Thanks so much.
Coming up, 'tis the season for charitable giving. We're giving you an update from the Boys and Girls Club of America next. And later, the latest on the Fed's rate path. New York Fed President John Williams is going to join us live at 8:30 Eastern Time right here on Squawk Box. Do not go anywhere.
Time now for today's Aflac Trivia question. What is the official beer of the college football playoff? The answer when Squawk Box returns. answer to today's Aflac trivia question. What is the official beer of the college football playoff? The answer, Modelo.
The year's most important giving season has arrived amid economic uncertainty, but corporate philanthropy is holding strong. Joining us right now is Lisa Anastasia. How do I pronounce your last name? I apologize. I feel like I'm mispronouncing it. Or just
Anastasia, don't worry about it.
She is the Chief Development and External Relations Officer at Boys and Girls Club of America. Good morning to you. Help us understand what's going on in the world of philanthropy right now, especially, well, there's the corporate giving and then individual giving. What are you seeing?
Yeah, it's really interesting. You know, despite some of the economic uncertainties and pressures of this year, charitable giving hit an all-time record of $590 billion. And corporate giving is actually the highest it's been in 40 years. And there's a good reason for that. Corporate giving is a business strategy. It helps drive sales, it improves customer loyalty, it increases brand awareness. So at the end of the day, giving back is good for business.
But you're saying now that corporations are giving more money charitably than they ever have, because there was a real pullback on charitable giving for a long time.
There was.
Post 2017 with the changes in the tax structure that allowed everybody to not have to itemize, but by not itemizing, you wouldn't get your deductions on the charitable giving.
Yeah, but what's interesting is with Giving Tuesday results recently, it was a 13% increase year over year, $4 billion donated and 38 million people participating. So consumers still want to give, they're just giving in different ways.
But I'm curious about the corporate giving, because, you know, back in the 80s, corporations gave actually a lot of money. There was a huge amount of philanthropic giving, but people thought of it as marketing.
Sure.
Oftentimes they thought the CEOs were actually abusing the sort of company coffers because they had their sort of pet projects. There was a real pullback on corporate giving because shareholders said, what are you doing with my money? You shouldn't be giving my money away. Give it to me and I'll give it away. Yeah. Do you think there's something changing?
I do. I mean, corporate giving now is actually a business strategy, right? 50% of young adults say they're more likely to buy from a brand that gives back, and almost 60% of consumers say they'd be willing to pay more for a product that does good. So I think companies are now seeing this actually as a key way to improve customer loyalty and connect with key audiences.
Has the corporate giving taken over for a drop in individual giving, or is individual giving up too?
Individual giving is up too, so they both have been rising.
And how much are you getting from these donor-advised funds and things like that? Because that's actually also a major shift among the wealthy, if you will, in America.
Yeah, so donor-advised funds continue to grow, depending on the year, as much as 10 or 20% year over year. And we expect to see that rise over time as well.
And when you think just about sort of the future of giving, when you think about the future of giving, how much of it do you, when you like think about your own budget, for example,
Sure.
is going to end up coming from the sort of corporate side? Are you spending more time trying to raise money there, or are you going more after the individual world?
So when you look at giving as a whole across the country, individuals is still the largest portion. In some cases, corporate giving only makes up 7% of the amount of money a nonprofit raises. But a lot of times it varies depending on the organization.
When you think about matching,
Yeah.
the other piece of this has always been a match.
Yeah.
Some companies actually got rid of their matches. Are you seeing more companies putting matches back in? What's happening there?
We are, particularly because employees are expecting that of their companies today. About 70% say they want to work for a company that gives back and offers matching gift programs. What we're also seeing is a rise of matching gifts with consumer programs. So for example, we had a big matching gift with Planet Fitness during Giving Tuesday. Kohl's is doing one right now as well. Consumers love it. It's like buying something on sale, right? Your dollars go further.
Let me ask you one final question. I'm sure this is probably not on your bingo card. So one of the things that's actually happened, it was quite remarkable earlier this week. You saw Ray Dalio, I don't know if you focused on this, gave money. This is now through the Treasury Department. This is the Trump accounts that are starting. I don't know if you followed this. Michael Dell participated, gave $6 billion. And you're able now to donate directly to young kids,
Right.
Effectively through a government vehicle. This is really the first time we've ever had anything like this before. And Ray Dalio earlier this week did it for every kid, I believe, in the state of Connecticut. You can do it now by zip codes. So you can actually go state by state or street by street. And I actually wonder how you think that, depending on how Trump accounts is what they're called, some people invest in America or invest in America, whether ultimately actually that becomes a real vehicle for charity that may be fabulous in certain ways, but actually could ultimately take away from other charities.
You know, that's an interesting, I think we have a lot to learn there. I would say in general, charities have been around a long time, right? Boys and Girls Clubs has been around for 160 years. I think a lot of times that structure, that strategy is really important. So I think you'll see a rise, but I think charitable giving will still be strong.
Okay. Lisa, thank you. Appreciate it.
All right, when we come back, we're going to take a look at the updated Kalshi odds for the next Fed chair after Steve Leisman's report about Christopher Waller's interview with President Trump. We'll have those numbers for you next. And later, Arthur Brooks will join us on the affordability debate and how to be happier during the holidays. Squawk Box will be right back. Recapping our breaking news from the top of the hour, senior administration officials telling Steve Leisman that Fed Governor Chris Waller had a strong interview with President Trump in which the two discussed the labor market in depth and how to jumpstart job creation. CNBC also learned that BlackRock's Rick Reeder will be interviewed at Mar-a-Lago for the Fed chair job in the last week of the year. The officials said that leaves 4 candidates still in the running for the Fed chair job. Here's a look at the updated Kalshi odds for the next Fed chair. At this point, they are citing Kevin Hassett up by 8%, Kevin Warsh down by 27%, Waller up by 21%, and we'll continue to watch this as well.
Coming up, we're going to get you ready for the trading day ahead. We could see some volatility from December options expiration. Details on that in just a moment. Don't go anywhere, folks.
All right, folks, let's take a look at the futures. Actually, those are the Fed chair odds that we've been watching. The Nasdaq's indicated to open up by about 67 points. Dow futures indicated up by 26, and the S&P futures indicated up by another 9.5 points this morning. It was a strong day for the markets across the board yesterday, but for the week to date, all three of those averages are down, at least at this point. Joining us right now with her take on the markets is Marianne Bartel. She is the Chief Investment Strategist at Sanctuary Wealth. And Marianne, welcome.
Thank you. It's wonderful to see you.
We're doing the Christmas thing.
Yes, we definitely are.
Let's talk a little bit about where you see things headed, because you think stocks are going to still head up into the end of the year. You're looking for the S&P to close at 7,000 for the end of this year?
I still think we can track up. Maybe we don't get to 7,000 by December, but maybe in January. I still think the trend is up. But our outlook for next year is more of a reset. I don't think markets, particularly the tech sector, Mag 7, can continue to go vertical. I think we kind of get a reset, a correction, a lot of volatility. It's the midterm election year, which tends to have a lot of volatility. But I do have the markets closing up by the end of the year at 7,500.
By the end of next year?
By the end of next year. So I still see positive gains. I still think tech is going to remain the leader. I just think it needs a period of rest, consolidation. We're starting to see some of the value sectors like healthcare take over, financials. Financials I like, but I don't see value taking over leadership. I do think we're going to stay growth, and there's a lot going on, as you report all the time, in the AI space. I still think it's very early stages. Semiconductors are still the leaders within the space. But if they get a correction in 2026, I think that's going to reset them to continue to rally into the end of the decade.
So you'd actually like to see a bit of a retracement?
I would love to see a little bit of a retracement.
Because then you would put money to work?
Well, I still have money in there,
yeah.
But if you do have some dry powder, some cash, I think you can go back in. Now, investors shouldn't be traders. Would I take a little beta off, maybe reduce some volatility? I've already done that in the portfolio that I manage. I do want to reduce risk, but I'm going to be looking to add back next year.
As we see rates come down, is that why you think value stocks are not going to be the leadership? If rates come down, that continues to kind of fuel the high flyers that have been running things to this point?
No, I think the leadership stays tech because that's where the power of the earnings is going to be.
Okay, so it's just long money that's
this is where's the earnings. Now, healthcare did have a really good earnings quarter, but I don't think they're going to be able to keep pace with technology. I think between comp services and I'm including all tech companies, no matter where they reside in the marketplace, will remain leadership and maintain the strong earnings power that they've had.
Is this a witching day today as well?
So it's a witching day, so everybody's talking about it, so it'll be a non-event. But generally during witching, everything is settling and expiring is the term that they use. And you tend to have volatility and you tend to have an explosion in volume, but it really doesn't change the trend of the markets.
Yeah, so your volatility today would mean what? The potential for just
things to move around.
Move quickly.
Move quickly and move around, but it doesn't really set a trend.
What else are you watching for 2026? What do you think will lead the way beyond just the technology stocks?
See, that's the problem, Becky. We don't have anything else, and that's the problem. Can you continue to have a concentrated market? You can. What I'd love to see is new companies come, right? Have a really active IPO market.
Well, we did speak yesterday with President of NASDAQ, who talked a lot about these issues. The idea that you could have some really big companies coming to market, whether that be a SpaceX, whether that be an OpenAI, one of these companies coming. The great news is it would be out there, but the trouble for other companies is if it sucks all the capital away, what happens?
Well, that's the issue. And if you have a choppy market, there's going to be a lot of companies that don't want to do their IPO in a choppy market. But normally, as you end into a secular bull market, because I still see the S&P going to 10,000 to 13,000 by the end of the decade. I see great gains within the market. As you get closer to the
13,000 over the next 5 years, or 4 years.
4 years. Yeah, I'm very confident in that number. And as you go out, that's going to be the end of the secular bull market that started in 2013. But as you go into that, that's when you really get a lot of IPOs, you get a lot of M&A activity, and you get euphoria within the markets.
And you're looking at a long runway.
I still think we have a long runway, but don't ask me what happens when you hit the end of the runway.
Marianne, thank you. Good to see you this morning.
Meantime, we've got a correction in tech stocks that's already started. Tech and semis have a hard time going to the new highs in 2026. That's the question, as they've been potentially overstretched. This corrective wave will carry over into 2026. They'll make a bottom and continue to roll into a bull run. We're going to see whether that is the case or not. That's the question of the morning, and we'll talk about it.
We will.
Just a little bit.
Coming up in the next hour, though, New York Fed President John Williams will join us in an exclusive interview. First, though, Courtney Reagan is at a Target store in New Jersey to talk about the home stretch for retailers. Court, what do you have coming up?
Yeah, Becky, so I'm at a Target in Jersey City. This is the order pickup sort of fulfillment backroom area. It's going to be buzzing very shortly because the activity surges the closer you get to Christmas. So Becky, send me your order. This store's one of the fastest fulfillers in the entire fleet. I'll have more details coming up when Squawk Box returns.
Tis the season for in-store shopping. Courtney Reagan has a closer look at the final retail push as shipping windows close and shoppers are forced to trek to the actual brick-and-mortar stores. Courtney, what are the crowds looking like as we get into this crazy rush season here?
You know, Becky, I think it feels pretty measured so far, but that might be because Christmas is on a Thursday, so maybe you don't feel as rushed going into the Super Saturday as normal, but I still think it's going to be pretty nuts. And you don't even necessarily have to get out of your car, especially if you come to Target. Around 75% of orders placed on Target's website or app so far this season have actually been fulfilled by order pickup or drive up. And that is likely to accelerate here as the days dwindle a little closer towards Christmas. So Adobe Analytics predicts that 32 to 37% of online orders will be picked up in stores in the final days before Christmas, around triple the typical percentage for the rest of the year, at least according to eMarketer. Now, fulfilling online orders from store inventory can be a big time saver for shoppers getting orders, but also a significant cost saving for retailers themselves. So 90% of Target's online orders for pickup are ready for within about 90 minutes. This store happens to be one of the fastest fulfillers in the fleet. Target says pickup is about a 90% cost savings over its brown box delivery from a fulfillment center. Now, Kohl's, Bath & Body Works, Dick's Sporting Goods, they all tell me that their pickup orders increased significantly in the week leading up to Christmas, more than double, in fact, for Kohl's. All three retailers say that many shoppers who pick up an online order actually end up buying something else while they're there. Almost a third do that at Bath & Body Works. So those incremental, those radiated sales, really critical for a retailer. Much harder to add an impulse buy or, oh shoot, a last minute thing I forgot for that teacher when you're ordering online. Becky?
Right. That's why when you go to the stores, you got to wind through the kind of shopping queue, and every step along the way, you get 14 other things in your face that while you're waiting, maybe you grab something and pick it up.
That is true. Although, again, if you go to Target, you can do the drive up. You let them know you're here on the app, and they put it right in your car. But a lot of people also add a Starbucks drink. It turns out that caramel brulee latte is the most popular addition for those drive up offers.
I feel you. I'm headed to the stores after I leave Airport. It's the first time I'm really trekking out to them. It's the first time because I did everything I could online up to this point.
You know, it's funny. Walmart did a survey, and they said that 80% of the customers that they surveyed in their stores plan to shop in stores in the final 2 to 3 days before Christmas. So you're not alone.
Yeah, we can't avoid it, and we all wait till the same time, so it's going to be really crowded. Court, thank you. Good luck and happy hunting this weekend.
Thanks, you too.
Coming up, we're going to talk about the IPO market and new developments in the TikTok story. Ben Narison, founder of Tenacity Venture Capital. Don't go anywhere. Squawk Box coming right back after this. Welcome back to Squawk Box. Medline's $6 billion IPO closing out a strong year for public listings. Joining us right now with what to come in 2026, Ben Narrison, founder of Tenacity Venture Capital. Good morning to you. A lot of excitement about a big year ahead, a lot of big IPOs, maybe in the mix, including SpaceX, Anthropic. I don't know whether you think OpenAI is going to get there or not, at least in the next calendar year. But where do you think we really are in these markets right now, Ben?
Well, I think, we talked about it a year ago, and my prediction was that this year would be the blow-up year for IPOs. I guess it was a little off, but we still got some in. Medline's obviously quite successful. I think next year is going to be phenomenal. Everybody's excited, bankers are excited, VCs are excited. A lot of great high-quality product in the pipeline. We've seen this happen before. When the bubble burst, it was almost a decade. In fact, I funded Lending Club, which was the largest tech IPO of the decade, Lending Club came out 10 years after the bubble burst and sort of reset IPO land. And I think that's going to happen again. I think everything you mentioned, SpaceX, Anthropic, are going to be very exciting. The secondary markets are absolutely exploding. The terms are insane. I mean, I had friends ask me if they could get some Databricks. I checked around the market, and the answer was, good luck, get in line. And when I did find it for them, the costs were crazy. People are just being a little bit piggish at this point. But that's because they see a pending IPO for these companies and the ability to make some alpha in the near term.
So, there's, the other big question is, are we in some kind of bubble?
Look, I mean, I think of it more like a natural cycle, similar to, so when I was young, they used to talk about how you built muscle. You would grow, you would plateau, you would grow again. The reality is that's not how it works. You get stronger, you then regress, and then you get stronger again. Whenever you have a major world-changing technology, you're going to have a lot of excitement. The best and brightest are going to navigate towards that. You're going to see the most brilliant entrepreneurs trying to do things there. A lot of those companies won't make it. There will be a bloodbath, but the ones that succeed will be tremendous. I doubt anybody would argue that the long-term value of the internet was not material, and that will happen here as well. The very nature of venture capital is to fund, I think Bezos put it well, like, we're probably the only country in the world where there's a deep venture capital that's willing to put billions of dollars into might only have a 10% chance of success. As long as those things that are in the 10% chance of success do so wildly well that they pay for all the things that didn't work out and more, then it works out just fine. So it's not that we're in a bubble, we're in the sort of energetic period where people are very excited about what can happen, but the winners have not yet been declared. I guess you could say Anthropic and OpenAI have been declared as winners, but those are interesting. And of course, OpenAI is now the white whale of future IPO possibilities. We'll see. There's so much money available to them.
But along the way, in terms of the big guys, do you have any fear that there will come a point where the economics of the business haven't effectively either caught up to the valuation piece of it or caught up to some of the financial commitments these businesses are making?
So this is the current story du jour, right? Like, we're spending all this money on AI, but it's not going to pencil out. We're not going to see the benefit. Very similar to what people said about the web and the internet back in the day. I think you will see it in individual companies, but I think overall you will see great value being achieved. Today they just announced that OpenAI hit $13 billion of revenue. Think about how young that company is to reach that level. Now, the flip side of this argument, of course, is that the companies that are buying these products are not seeing the value yet. Interestingly, I had a founder of mine who is in a company that does AI. It's about a $4 billion valuation company. Call me to say, oh my God, people are willing to pay me anything to work with me. And I was like, okay, pause. This is exactly the same thing we saw back in the day. People will pay anything to work with you today because their boards and CEOs are telling them they have to be on this. Next year, you are going to have to show value or they're going to cancel. So make sure you do. So what's going to happen is you're going to see this bifurcation between the companies that did and can show value and the ones that can't. People are going to buy AI almost blindly right now because they don't want to look foolish or behind. But yes, there will be a consolidation where they start to say, okay, show me the money, show me the ROI. This is when the internet shifted from CPM to CPI. Same thing.
Right, and so, but what then it's hard, what this goes to, how do you pick the winners and losers? And what does that moment look like? Meaning, the moment at which you think the investor class or I should say managements, especially in the enterprise and others, say, you know what, we're going to continue using this service, we're not going to use this service over here because it's not actually producing the ROI that we anticipated. There will be that moment, and then what happens?
Well, so that question is different for two different parties, right? It's different for the investor versus management. You know, obviously all investors want to pick winners, but it is impossible to always do so consistently and always be right. You know, TAE, the announcement recently, is being merged in with Trump's unit. You know, when I was in NEA, I went to visit TAE. It's a fascinating thing. What a wild business. That thing has been going on forever. Dick Kramlich, the original founder of NEA, funded that thing something like close to 30 years ago. And believed, by the way, it would be the first $1 trillion business. When will it be? Eventually. You know, it's a phenomenal thing. Management, however, but on that point, if they're right, eventually, great. Where you have those businesses don't work out, as I said, you know, the ones that do have to pay for the ones that don't. For management, it's a different question. It is, am I getting ROI? And I think the right answer today is try everything. Because you got to find the novel thing that works for you and delivers value. And the only way you're going to do that is by using it live. Once you do, you will wean yourself of the ones that don't work, and you will consolidate on the ones that do. Now, what will that do in the markets? It will skyrocket the ones that are successful and kill off the ones that aren't. And it's very Darwinian, and it has always been that way. I'm sure back in the birth of, look, there were 2,000 car companies when cars started in the United States. They certainly aren't 2,000 car companies now. Winners get big, losers die.
Ben, you mentioned TAE. I do want to get your thoughts on that. There's been a lot of questions about what that deal really is about. Trump Media effectively becoming a crypto company, now a fusion company, a conglomeration of these kind of assets. On the other end, there's a question about if you're TAE and you were actually quite successful, why wouldn't you try to actually go public via an IPO and remain independent? Is this a better path? Is this a Trojan horse to becoming public? What's going on here?
Well, they're public now. This is a reverse merger into a SPAC. So it's a little convoluted, but at the end of the day, TAE gets public equity to use in various ways. There's a $3.1 billion war chest. So TAE is working. You know, it's probably one of two functional fusion realities, but it does consume an enormous amount of capital, and that capital will be needed for quite a while. Ultimately, a company like TAE is probably dependent on nation states to build the ultimate reactors to be able to go forward. But having $3 billion to utilize in public stock is a very valuable thing. So I think it's probably an accelerant. I have no direct knowledge. You know, I visited them years ago. It's a fascinating facility. I think it's going to do great things for the planet. On the Trump side, I mean, there's a derogatory term for inflating the value of your stock and then using it to buy something that has hard value, right? We saw this in the bubble. Khashoggi did a pump and dump on some stock once where he literally just bought his own stock until it got to a very high price. Then he tried to buy our company, when you remember when Fashion Mall was public and they had a lot of cash. Yep. And there was just no value underneath. This is a little different. Trump has created value in this entity. The entity has this $3 or so plus billion of value. They've got the crypto assets. And now merging it into a long-term business, it could be truly one of the standouts. Pretty smart. I mean, I think it's probably a smart deal for both.
Ben, I want to thank you. Every time I see you, I'm reminded of the old boo.com days. It's been a long time.
Got my books in the back. I've got, the Boo book and
I remember that all so fondly. This is literally, guys, 25 years ago.
And also the beginning of the end, right? Like when Boo blew up, that was the beginning of the end of the bubble. So, interesting journey.
Interesting journey. Good to see you.
Take care. Thank you.
Do you remember, you covered retail, Boo.com. This is 2000, maybe 1999. This was the hottest, he ended up buying what was, for a hot minute, the sort of hottest fashion.com company. They spent about, I think, $183 million in they blew through like in 18 months or some crazy amount of money. It was two Swedes who had started, Bernard Arnault and Goldman Sachs, all these people that put money in. It was unbelievable. And they were ahead of their time in a very big way.
Huh. Very interesting. No, I don't remember. All right, folks, it is 8 a.m. on the East Coast, and you're watching Squawk Box on CNBC. I'm Becky Quick, along with Andrew Ross Sorkin. Joe is off today. Among our top stories this morning, President Trump has signed an executive order to reclassify marijuana as a less dangerous drug, potentially easing regulations and expanding research. FedEx beating second quarter estimates and raising full-year guidance. Last night on Mad Money, the CEO of FedEx telling Jim Cramer that the company is the heartbeat of the industrial economy, citing strong business-to-business transactions. That stock this morning off by about 1 3/4%. And OpenAI is reportedly looking to raise up to $100 billion to fund expansion plans. The Wall Street Journal says that the round could value that company as high as $830 billion. With funding possibly completed by the end of the first quarter and support expected from sovereign wealth funds.
Checking the futures right now, Dow off about 12 points, NASDAQ up about 35 points, the S&P 500 up about, call it 2.5 points. We're going to get over to Mike Santoli at the New York Stock Exchange. Mike.
Yes, Andrew. So the S&P 500 got some relief yesterday after a 4-day losing streak. That was positive. Micron earnings took the pressure off of the semis, and you got that soft CPI print, had yields lower, and maybe refreshed some of the cyclical trade. Although, in general, what we've had here is about a 2-month churning period. We're right around those levels that we got to in early mid-October. Since then, the market's had to absorb this sort of rethink of the AI trade and the negative performance point to point of the NASDAQ 100. Cyclical's doing fine, so there's a decent macro message. We're playing with this 50-day moving average. Last 2 days, you've had the highs in the S&P right at the same point, just over 6,800. We do get options expiring at the open and the close today. Maybe that releases the market to find new direction. It was supposed to be in a seasonally strong period. We'll see if it shows up. You guys talking about Nike earlier. This is a chart I've run many times over the years. This is a 6-year chart of Nike, Disney, and Starbucks, these big kind of bellwether American brands that traveled very well for a long time overseas, in particular China. Come on hard times and actually sort of rhyme in terms of their trajectory, especially Starbucks and rather Nike and Disney. Just for comparison's sake, over this period of time, the S&P 500 has more than doubled. So this is really, these guys are in the penalty box in the long-term way. We got very inflated valuations during the pandemic as well. One relationship that's been very fascinating to track and is going to be interesting going into next year is the dislocation of crypto. That's Bitcoin relative to the NASDAQ 100. Crypto had acted, Bitcoin had acted like kind of tech stocks in an amplified way for a long time. And now this gap right here, the question is whether it has to converge again, whether the story has changed in terms of Bitcoin. They tend to have fed off the same pool of investors and the same kind of energy about the sort of digital future. We'll see what happens right here, because yesterday there was a midday sell-off in Bitcoin, seemed to thwart the intraday rally, but still stocks managing to withstand the downside drag.
Thank you, sir, for your smart thoughts. Mike Santoli at the New York Stock Exchange this morning.
All right, still to come this morning, a survival guide for the holiday season, and we mean a mental one. Professor, author, and podcaster Arthur Brooks will join us with some tips on how to stay happy during the holiday season. And later, an exclusive interview with New York Fed President John Williams. This is just a day after a lighter than expected reading on that November inflation number. Squawk Box, we'll be right back.
Welcome back to Squawk Box. Our next guest is here with a holiday survival guide. Joining us right now is Harvard professor Arthur Brooks. He hosts Office Hours, that podcast. It's new and it's awesome. Also, of course, columnist with The Atlantic. But what we want to talk about this morning is money and happiness. The very idea of, can you buy happiness?
Right.
And how we should all feel right now when everyone talks about affordability and how unaffordable things are. Does that make you unhappy? I would imagine it does.
Yes.
How do you think about this?
So when we're talking about affordability and inflation, it's not about happiness, it really is about unhappiness. The government can't bring you happiness. It can't. What it can do is eliminate sources of unhappiness, and it can bring you a lot of unhappiness. The number one source of unhappiness that governments typically bring to citizens is not actually maintaining a stable price level, because it chips away at the purchasing power of people, and they hate it. It's a tax. It's a tyranny. It's bad policy, and everybody knows it. So when politicians say, it's not that bad, it just enrages people, and quite justifiably so. That's job number one. If you look at the top 3 reasons why people didn't vote for Kamala Harris, which was really about Joe Biden, it was number 1, inflation. It was only number 2 was immigration, number 3 was social policy or social issues. So that's the thing to keep in mind.
Okay, so how are they doing then on that front?
The problem is that it's kind of stuck, and it doesn't actually do good for anybody to say that it's not a problem. The government means it's hard. It's hard policy because I was trained as an economist, and I know it's a hard problem. But when it looks like you're actually not paying attention to it, that creates rage, and that's a big problem politically. But for people who are not really troubled by that, people who are above that basic level of just eliminating happiness, a lot of people watching the show, that is actually a pretty interesting science as well. Because it turns out we know how to buy happiness, and almost everybody's doing it wrong.
Okay, tell me, I want to know.
What's the secret? What are we
If you have some money,
if you
can you buy a modicum of happiness?
You can, because there's 5 things that you can do. Mother Nature wants you to do one thing, and your impulses tell you to do the one thing that won't buy happiness, which is getting stuff. So people get a little bit above, the parapet, they're starting to make a little bit more money, they get a second watch, whatever it is, a nicer car, et cetera, et cetera. And then you get into this hedonic adaptation, where it's like more.
Keeping up with the Joneses.
Yeah, and stuff won't do it. Stuff won't do it. We all know that. The new car smell fades. We adapt. That's what we do to stuff. But there's 4 other things that you can do, and they all buy happiness.
Okay.
Number 1 is buying experiences with people you love. So that's why a vacation with people you love. That's why if you're going to get a beach house, not for the house, buy the beach house as an attraction, as a magnet for the people that you love to spend time with them. That's why an expensive vacation to Disney, for example, is really, really great and meaningful and wonderful if you're with the people that you love and you're making memories. That's number 1.
Okay.
Number 2 is buying time. And buying time means paying other people to do things so that you have more free time to cut your yard, to clean your house, whatever it happens to be. But you got to spend your time doing something personally edifying or with people that you love. Scrolling social media doesn't count. Watching TV doesn't count. Don't waste the time that you're buying. Be super propulsive about it. That will buy happiness.
Okay. But by the way, there's some people I know that actually love to garden.
Yeah, for sure. Yeah, so you need to spend your time, because that's actually very productive leisure.
Okay.
If you're doing something that creates value that you love, you should absolutely do that.
Some people who do gardening do it by themselves.
Yeah, that's edifying. That's like praying for them. That's a meditative activity.
You could do anything, any activity.
For sure.
I'm waiting for number 3. I'm assuming one of these is going to be to give away.
Yeah, that's number 3. Number 3 is giving your money away, but you have to give it to things that you love. A lot of people who are very rich, they don't like philanthropy because they don't have very much interest in the things that they're expected to give money to. You live in Omaha, and you have to join the board of the Omaha something hospital, because that's what, and to be a member, a functioning member of society.
Because all the things you're talking about are things that I think Warren Buffett figured out.
Yeah, that's right. Well, he actually,
a modest life doesn't.
And he gave his money to Bill Gates, because Bill Gates is super good at philanthropy. And he's like, I'm not good at this, I'm good at investing. If philanthropy is not my thing, I'm going to give it to the expert in philanthropy. And that gave him more joy. You got to find something you're really, really passionate about. My wife and I, Esther and I, are very passionate about Catholic education.
Right.
Catholic education. We give almost all of our philanthropy, which is 10% of our money.
Okay.
After taxes. We tithe. Okay. I asked my dad that, by the way. Very religious guy.
10% before.
That's how I asked my dad, because my dad was always a serious tither. Dad, he has a PhD in biostats, so he was a very sophisticated guy. He said, you tax do you tithe before or after taxes? And he said, before. I said, what? I'm an economist. After, Dad. Why? And he said, just in case.
Because God's
I have one other related giving question. So you give to Catholic charities.
I give to, yeah.
Do you feel bad when people come to you and ask you for money that are outside of the charities that you care most about? Do you give a little bit just to sort of be in that community or not, or whatever it is?
Person. I give
or
to people.
or do you say, I know some people who are very good about saying no. And they say, I'm all in on this one thing, and that's what our family does. We don't do anything else.
Right.
And they feel very good about sort of having these walls. And then I know other people who have something that they care about, but then they end up getting called by 12 other friends and this and that, and the people in their community, and they feel that they have to give.
Right.
But I don't think those people love giving.
They don't love
those
giving.
contexts.
You gotta. So I will give the things that I'm not super passionate about to actually pal up with people I love. People I really care
So to
about.
pal up.
Yeah,
Okay.
that's a really important
But
thing.
is that like buying friendship?
No, it isn't.
My
because
wife and I had that conversation
it's-
once.
No, for sure. But you got to when you're collaborating with people that you trust and like. So one of my buddies comes to me and he says, "Let's give to the Leukemia Lymphoma Association or something like that." And it's not a thing necessarily for me, but I like him. I like him, and I want to support a thing that he likes. The other thing is that you made a very important point. What gives more satisfaction? Throwing dollars out of a helicopter, $100 here, $100 there, or turn the whole dial on one person.
Yeah.
I have data that actually show that when you turn the dial on one whole person, this is the book of Sanhedrin in the Talmud, that says in each person is the whole world. And when I figured that out, my wife actually called me on it. She said, let's do something big for one person. I said, like what? She said, let's adopt a baby. And I'm like, it's only a book. And so we did.
You did?
Did. That was a long time ago. Now she's 22. She's a second lieutenant in the U.S. Marine Corps.
And is that the most
She's a baby.
satisfying
It's the most amazing.
experience in your life?
Game changer. Complete game changer. I mean, it was the most amazing thing. From an orphanage in China. It was the most amazing thing. So this is the key. Well, there's one left.
Okay, there's one more we're missing.
Save your money. Saving money brings enormous satisfaction.
Because you don't have to worry about things. It puts off the fear, the panic.
It's the future. We want progress. We want progress. That's the reason that you shouldn't borrow money if you can avoid it. Consumer debt is idiocy for happiness.
Right.
You should never run a credit card balance if you can possibly avoid it. I mean, some people get it. That's a card debt is insane for happiness. It's horrible. The only kind of debt that doesn't lower your happiness is a mortgage.
Yeah.
Because that's actually more progress than rent.
Right.
We want to make progress. And so debt is bad, is poison for happiness, and saving is actually really, really good for it. It's also intergenerational wealth.
Yeah, that you can take care of your family, you can take care of anybody who comes along if problems happen.
So that's how to do it.
That's pretty simple.
It's the formula.
It's pretty good.
Money and happiness.
Exactly right. And we need lots of happiness. It's the end of the year.
So what makes for the best Christmas gifts? I guess you go back to experiences, you go back to time with people.
That's the best thing to do. And when we figured that out, I started seeing the data and I tried to live it that way. I would go to my kids and I would say, what do you want that we can actually do? And I would go alone away with each one of my kids every year. When they were little, I strongly recommend that. One wanted to go hunting every year. Hunting. I'm from Seattle. Right? And now, he became a sniper in the Marines. So that was like, it was...
There was something useful there.
There was something really useful there, for sure.
Yeah.
Another one wanted to come up to New York every year and go to the opera. He was really, really into the Metropolitan Opera. We'd go to the opera, we'd see operas every year. And my little girl, she always wanted to go to these amusement parks.
Right.
And so I would do one thing like that. That was a Christmas gift. Strong recommend, because that's number two. That's experiences with people you love.
Arthur, thank you for the experience that we love, which is seeing you. So
I love it too. Thanks so much.
Thank you for
Happy holidays.
Thank you. You too. Happy holidays.
Great to have you here.
Thanks.
All right, up next, a check on Nike shares after last night's results. You're going to see that stock is down by more than 11% at this point. And later, New York Fed President John Williams joins Steve Leisman for an exclusive interview. Squawk Box, we'll be right back.
Welcome back to Squawk Box. Take a look at futures right now. Dow basically not moved. Basically off, well, now off 4 points, but was up about a point before. S&P 500 up about 6 points. The NASDAQ off about 68 points. Imagine volume's going to be light as we move into the holidays. Take a look at treasuries right now. The 10-year at 4.1, the 2-year at 3.4. Gold right now, and then we will take a look at crypto as well. But if you want to buy some gold by the barrel, or not the barrel, I was thinking of oil, but gold, $4,063. We could show you some oil. Let's show you some WTI for those folks who like to buy it by the barrel, $56.58. And then Bitcoin, we were discussing earlier as our sort of risk on, risk off situation, $87,876.
Nike shares falling more than 10% in the pre-market trading today. Some worries over weakness in China overshadowing an earnings beat yesterday. Nike CEO saying improvements in China are, in his words, not happening at the level or the pace we need to drive wider change. Check out that stock. It's right now off by about 11.7%, a decline of $7.68. Wolf Research cutting its price target on KB Home to $56 from $63. It's also keeping an eye on an underperform rating. That move follows weaker fourth quarter results, including misses on orders and margins. The home builder's first quarter margin outlook also came in well below expectations, raising concerns despite the stock's low valuation. And KB Home's off by about 4.3% this morning.
Meantime, the NASDAQ and New York Stock Exchange, they're saying they will not alter their trading hours on December 24th and 26th. An announcement coming after President Trump signed an executive order to close the government on those days. The stock market will close at 1 p.m. Eastern Time on Christmas Eve and operate as a regular full trading day on December 26th. When we come back, Steve Leisman's going to bring us a big and important exclusive interview with New York Fed President John Williams. And later, former CEO of TikTok on the deal to keep the app alive in the U.S. We will talk all about it when Squawk Box returns. Why don't we get over to Steve Leisman? He's got a very special guest this morning, a special interview with New York Fed President John Williams. Steve.
Andrew, thank you. Yes, I am here at the New York Fed where I've been, we don't know how many years in a row now, but several, with President John Williams for a traditional December holiday interview.
Well, welcome back, Steve.
Thanks. And John, I was just remarking about how great our teams are who scheduled this months in advance, and knew there would be a shutdown, knew when the BLS would open, and knew that yesterday they would release the inflation report, which they, of course, did not know. But we're lucky here to have you to comment on it. Yesterday, that inflation report came in lower than expected, but it was a little controversial. Give us your takeaway from that report.
Well, a couple things. I think that, you know, some of the data that we're seeing is actually pretty encouraging in the sense on the CPI news. And I think it represents a continuation of the disinflationary process we've seen. And I feel like it's consistent with what we were, or I was expecting. Now, on the headline though, there were some special factors, some technical factors that really are related to the fact that they weren't able to collect data in October and not in the first half of November. And because of that, I think the data were distorted in some of the categories, and that pushed down the CPI reading probably by a tenth or so. It's hard to know. We'll get some, when we get the December data, I think we'll get a better reading of how much that distortion had, how big the effect was. But I do think that was pushed down a bit by these technical factors.
Sorry to interrupt, John, because this is a big issue right now. Did your army of economists already crunch the data and figure it was pushed down by a tenth? Is that a running estimate you have?
Well, that's just a rough estimate, okay. I'm saying. But yes, it is, because a couple of the technical factors. One is, they only collected data in the second half of November when all the sales are on, and that's going to give you a bit of a downward bias. Also, there was some issues about the rent data and things like that. So it's hard to know, but definitely I took some positive signs from some of the categories that weren't as affected by that. But I think that really this is just a continuation of the data we've been seeing, and I'm going to wait and collect some more data in the next month or two to get a better reading of that.
Also, from the Department of being lucky rather than good, we're 2 days after the jobs report. Yeah. Give us your sense of what's happening in the jobs report and your level of concern with the level of payroll growth.
Well, I think
rising unemployment rate.
Right, and again, I think we have a similar story as with the CPI. I think the basic signs from the employment report, again, they didn't have the data, all the data for October, but they did have data for November. I think what we're seeing is, we're seeing steady job gains, especially in the private sector, so that's good news, a continuation of moderate growth. In the unemployment rate, I think that due to some technical factors, again, because they weren't able to collect the data in October, it probably boosted the unemployment rate in November maybe by a tenth. So I think that if you think about that, the unemployment rate has edged up to around 4.5%. Pretty consistent with kind of what I was expecting. Again, we'll get more data in the next few months to see those technical factors from the government effects of the government shutdown. Those will fade away from the data. But my conclusion is the labor reports have been pretty consistent with what we've been seeing, especially with this gradual cooling of the labor market. No signs of a sharp deterioration at all.
So put A and B together, the inflation and the employment, did any of it change your outlook for where interest rates need to be?
Well, it really, so far that's just a few data releases. Fortunately, we'll get a lot more data before our next meeting, and of course we get a lot of data.
Just for the record, you're the one that put out the data-dependent T-shirts.
Yes, I did.
So it's a fair question.
Yeah. So I do, obviously, I see the data as broadly consistent with the patterns that I've been seeing, and I think we're consistent with the decision we made to cut interest rates at our last meeting. So I think that again, none of this data is changing my view of the outlook. I would take some, positive sign from a little bit lower inflation data. That's what we've been looking for, but nothing that's a game changer yet. But we'll collect more data, and I think monetary policy is really well positioned right now to gather more information, see what that's telling us about the economy, the outlook, and the risk to achieving our goals.
So you use that phrase, well positioned, which is a new operative phrase, at least is taken by the market, which means you're probably going to take a pause in January. Am I reading that correctly? Is the market reading that correctly? That's the way the market is priced right now.
Well, I never take a pause in my job. I'm always hard at work and collecting the data, analyzing it, looking for all the signs of what's it mean for achieving our employment goal and our price stability goal. So I don't think of this as a pause or anything like that. I do think the data are telling us that, really we're seeing a gradual movement of, I think, underlying inflation back to 2%. But we're going to have to watch all of the data as it comes in, see what it tells us. I don't personally have a sense of urgency to need to act further on monetary policy right now, because I think the cuts we've made have positioned us really well, and to really try to, I think one goal here is to stabilize the labor market. I don't want to see the labor market cool too far. I want to see inflation come down to 2%, but again, without doing undue harm to the labor market. It's a balancing act, but again, I feel like we've got this in a pretty good place.
John, I don't know the extent to which our viewers know that you're one of the world's experts when it comes to understanding this concept of the neutral rate, the rate the Fed would set to not grow the economy, or stimulate the economy, or not cause it to contract. In your view, where are we relative to the neutral rate?
Well, the way I think of the neutral rate is in terms of the real or inflation-adjusted interest rate. And so today, based on a forecast of inflation of a little under 2.5% for next year, that puts the real interest rate somewhere around 1 to 1.25%. So that's in the kind of I would say in the range of estimates of neutral that are out there. So I think we have moved toward closer to neutral. My personal view, speaking for myself, is that the neutral rate is probably a little bit below 1%. So we're still mildly restrictive in terms of the stance of monetary policy. We still have some room to go ultimately to get back to neutral, but that's not guiding my views on what should we do at a specific meeting. That's more of a conceptual framework to think about it. But clearly, I do think that we've gotten closer to neutral. I still think we're a little bit above.
But the question has to be, the follow-up question has to be, do you feel a need for the Fed to remain modestly restrictive?
Well, I think right now with inflation still at something like 2.75%, and we need to get a sustained basis back to 2%. I think that modestly or mildly restrictive stance that we now have gotten after the cuts from last year, I think is helpful in that regard. But I don't see this as like overly restrictive or very restrictive. This is getting in the vicinity of neutral.
Can you walk us through your outlook for growth? Where do we end this year, and what happens next year?
Well, where do we end this year is still an open question because we don't have a lot of that.
I wouldn't ask that question that way. I would know.
And so my view is probably GDP growth for the year as a whole for this year, say 1.5 to 1.75%. So that's slower than the year before. I do see growth picking up next year. I think we've got some pretty meaningful tailwinds to the economy, starting with the AI investment boom and all of that activity. Pretty strong financial conditions, especially with the stock market, and also fiscal policy will provide some boost to growth next year. So I do see growth somewhere around 2.25%, and that's a bit above my view of kind of the trend growth rate of the economy.
I'm fascinated, John, by how the AI investment boom and the prospect of greater productivity informs your view of where policy should be. And I guess I've been around long enough to remember 1996 when Alan Greenspan took a flyer and he said, you know what, there's all this investment going on in the economy and it's got to be for something, and it's going to be productivity. So it allowed the Fed to run the economy a little bit hotter than what it thought it could relative to that. Do you feel that, is that informing policy right now for you, this idea that productivity could come in and therefore the economy can run at a higher GDP rate without causing inflation?
Absolutely. I mean, I think that's if we have a sustained period of higher productivity, that boosts the growth rate their economy can achieve without creating inflation. And like you said, back in the 90s, those are my formative years in my career, I think it is important to understand those dynamics. And it can be somewhat disinflationary because it's reducing costs for businesses, the higher productivity and all that. So we have to be very kind of aware, and we are, about what's happening with productivity and understanding all the dynamics around that, how it affects supply and demand and the balance between the two of them. But I do think higher productivity growth is very favorable tailwind for the economy and also for achieving our goals. It's one of the reasons I do have some, one of the reasons I expect inflation to come down, underlying inflation to come down next year and the year after, beyond the fact that, some of the effects of the tariffs will wane and other drivers that should help bring inflation down. The good productivity growth is definitely a help there.
It's fascinating, John, but I just want to be clear. So you're saying that the prospect for greater productivity from AI and other things around the economy is informing your view of policy now. and what it can be and where it can go?
Well, what's informing my view now is what we've been seeing, which is actually very good productivity growth over the past few years, around 2% or so. So that's already happening, and I think that's going to continue for some time. I don't have a crystal ball that tells me what productivity will be, but if the AI boom does turn into a sustained period of productivity growth in the U.S., then I think those are the kind of factor or kind of developments we would expect. I'm not taking that for granted. It is part, though, of kind of my view that we're going to have an economy that's going to grow, have very good growth. It's going to have that with, with inflation coming back to 2% and the unemployment rate coming back down to what I think of as maximum employment.
And you're not being optimistic just because it's Christmas time, right?
Absolutely not. I do feel that we got through 2025. This has been an uncertain year. A lot has happened, and the economy has come through this. And I'm feeling actually pretty good on the base case for the economy. Right. Of course, lots of uncertainties.
We do need to talk about some of that. For example, the idea that AI could lead to substantial job losses. Is that a concern of yours? And how does the Fed respond?
Well, I think what we need to do is understand what's happening in the labor market. I think, again, it's supply and demand. Steve, those are the two words I always go back to. But it's going to affect clearly the supply side of the economy, but also it's going to affect the demand for labor. I think in AI industries we're seeing, or industries related to building data centers, we're seeing very strong demand for labor in those areas. We're going to see very strong demand for people who use AI, but we are going to see negative effects on those whose jobs, can be replaced through technology. This is the same kind of thing we've seen in the past. I mean, net, I do see this as I do not see this as a cause for, structural unemployment or negative effects on the labor market like that. But it will be a period where you're going to see changes in kind of what skills are in demand and how highly they're compensated.
But what about all the investment pouring in? What if it goes bad? It doesn't have those returns. Are you looking at AI as a potential source of systemic risk to the financial system?
I don't see it as a systemic risk to the financial system, although we are very focused on these issues of where's the leverage in the financial system, how is this investment being funded? Those are things that we always study and try to understand as well as we can. I do think that at the end of the day, this is a very fast-moving sector. We're going to have some investments that don't pay off. Other investments that pay off, extremely well, and I think that's part of being an innovator, free enterprise economy. I do think there's something real here. This AI, and especially the latest generations of AI, represent a general purpose technology that I think will transform how we do a lot of work in the economy, just as technology and the internet and other things have in the past. Is there excessive exuberance in some of this? Maybe, maybe not. But I think there is a real thing to the economy that will be a positive.
Alan Greenspan, who we've already talked about, had an idea about addressing bubbles. And he said you don't address them ahead of time, but you're available to clean them up afterwards. Is that your thinking? If there's all of this investment, does it suggest perhaps that rates are too easy or financial conditions are too easy, and it's something you should raise the hurdle for these things to cool it off?
Well, I guess these are pretty easy questions. I agree with the comment that you're quoting, former Chairman Greenspan. I think that you never know how is the market pricing things? Is it high or low? You never know what exactly the future will hold, and we can't know that despite all the research we do and analysis we do. So I think we need to focus on the economy in front of us, achieving our maximum employment and price stability goals. And of course, if there's later on the market say we can adjust to a different reality around AI, then we can respond to that in terms of achieving our goals. And so I am in the camp of let's not try to anticipate that the market may be getting it wrong or there's investment boom that won't pan out. Let's look at the actual economy in front of us and do the best we can with it.
John, we have to talk about the balance sheet, because one of the other things you guys do here at the New York Fed is you basically run the Fed's balance sheet and make sure the funds rate is in line with what the committee has decided where it ought to be. You recently had some tightness in these funding markets overnight that have caused some concern. And you've also decided that you're going to increase the size of the balance sheet. Opinion piece in the journal today says you're doing QE again and you've lost control of the balance sheet. Are those two things accurate?
I don't agree with either of those. First of all, we're not doing QE. So QE, quantitative easing, is a monetary policy tool or decision to basically improve, bring down longer-term interest rates by buying longer-term Treasury securities or mortgage-backed securities. We're not doing that. We're buying T-bills, short-term securities, and we're doing it to provide reserves to the banking system to meet the demand that the banks in our country and that operate here need in order to carry out their business. So we are being led by where is the demand for reserves. We're supplying those reserves as needed in a way that keeps interest rates, as you mentioned, right in the range that the Federal Open Market Committee has set the Fed funds rate for that. So we are obviously not doing QE from my point of view. We're not trying to change the 10-year term premium or something like that. We're really just making sure there's appropriate.
That would be QE.
That would be QE.
John, I want to just make sure that I leave, and apologies to the control room that wants me to wrap up, which I understand. We've been talking for a long time here. It sounds to me like you're a Fed official who, over time, can see rates coming down back towards a lower rate, but in no particular hurry to get there because A, we have holes in the data out there, and B, you want to see how the economy goes. Does that correctly summarize your view on rates?
I think I do see eventually rates coming down lower because as inflation comes down all the way to 2%, we'll need to have an interest rate that's consistent with that. And also I think we're a little bit above neutral, so I think that eventually we get there. But I think, again, yes, we are in a good position, I think, in balancing our goals. And we want to, from my point of view, I want to see how the economy performs, collect more information, especially as we get maybe some cleaner reads.
Your colleague, Governor Waller, said 50 to 100 basis points over no particular time. Is that in line with your thinking?
Well, I think there's a range of views. You can look at our economic projections, right, and there's a range of views. And I think, that's a, I'm not going to opine on his particular view or anything, but I think that, if you think about today, we are, well above eventually getting to a nominal neutral rate when inflation is all the way to 2%. We're not at 2% yet.
President Williams, thanks so much for joining us again this year.
Well, thank you.
All right. Guys, back to you at NASDAQ, I suppose.
Steve, thank you, and please thank John Williams for us as well. Great to hear him, especially at the end of the year, kind of wrapping things up in the middle of this news. We appreciate it. We'll see you later. Up next, China's ByteDance signing a deal to create a new joint venture in a step to avoid a ban of TikTok in the United States. We'll talk about it with former TikTok CEO Kevin Mayer. That is next. Right now, though, as we head to a break, take a look at the winners and losers in the S&P 500 this morning. Biggest winner is Oracle, which of course was down substantially earlier this week, so it's making those gains back. Generac Holdings taking second place there. At the bottom of the list is Lamb Weston. It's leading the laggards today. Squawk Box will be right back. Thanks, everybody. We do have some deal news to tell you about this morning. BioMarin is buying Amicus Therapeutics for $15.40 a share in an all-cash deal that's valued at about $4.8 billion. The company says that this transaction expands its rare disease portfolio and will be accretive to non-GAAP earnings within the first year after closing. That deal is expected to close in the second quarter of 2026, pending regulatory and shareholder approval. BioMarin shares are actually up by 4.7% on this news, and then Amicus Therapeutics up by close to 30% on this deal news. It's a pretty interesting deal because Amicus in itself is an amazing company in how it was founded. It was founded by a man named John Crowley, who's now the executive chairman of the company. He founded this company to try and create a therapy or a drug to save two of his children who were diagnosed with Pompe disease. So the different drugs that BioMarin will be picking up here is one for Pompe disease and another for Fabry disease. These are two rare diseases that are metabolic diseases. Pompe disease is harmful. It allows the harmful buildup of glycogen in muscles and nerves, things like your heart. It can destroy those tissues. Fabry is where the body can't break down fats, and so it causes fatty substances to build up in the tissues the same way. The tissues, the muscles like the heart, the brain, the kidney. And these have been really amazing drugs that have come about, but it was started by a father who was trying to save his two children. It was chronicled, John Crowley's story, his family's story, in a movie with Brendan Fraser and Harrison Ford called Extraordinary Measures. So this has been kind of an amazing story for this company to not only come up with a therapy to save his children, but then to go on and to try and save so many other people too with other rare diseases. Again, this is a company that was founded back just in 2002 and then really took off and launched in 2005, and what a long way it has come to this $4.8 billion deal today.
Meantime, we do have a market flash for you. Palo Alto Networks and Google Cloud have expanded their strategic partnership. They're now saying that the collaboration combines Google's cloud AI and infrastructure capabilities with Palo Alto's AI security platform. And, of course, there's a security arms race going on in the digital space.
As we mentioned earlier, TikTok CEO telling employees that its parent company, ByteDance, has reached an agreement to create a new U.S. joint venture that will hold the U.S. version of the app, and that will be majority owned by U.S. investors. Kevin Mayer is the founder and co-CEO of Candle Media. He's also the former CEO of TikTok and the former COO of ByteDance. And CNBC's Beijing bureau chief, Eunice Yoon, is here as well. She joins us here at the NASDAQ this morning as well. So, folks, let's run through this. First of all, Kevin, what do you think? What does this do? Does it meet the security regulations that Congress laid out?
Well, it seems to me, in looking at the deal, from what I can tell, it does meet that. ByteDance seems to be, and Chinese ownership seems to be below the 20% threshold. You have a very trustworthy American corporation, Oracle, running the algorithm, retraining the algorithm, managing the data flow, making sure data access is limited to the U.S. Data access is limited only to the U.S. Checks all the boxes. And I think in addition to that, you still have ByteDance helping out with the commercial operations in terms of ad sales and e-commerce and the rest. That just seems like a low security risk, but a good way to make sure their values, their top line, the bottom line are driven the right way. I think it's a good deal.
Eunice, what do you think from the perspective of China at this point? Obviously, if this is something that solves the security issues the United States was looking for, is it a situation that the Chinese can live with too?
It looks like it. I mean, there hasn't been any official Chinese government response except for a very boilerplate statement from the foreign ministry where they said that Beijing's position is consistent and clear. But the signaling that we're getting in the state media is that this has Beijing's approval. And there's a lot of citation of a pro-Beijing professor who is saying that this deal is in line with Chinese law. And they're saying specifically that this is not a sale of the algorithm, that Oracle is only reviewing, they said, the algorithm, so there isn't any way that they would be able to copy or steal it. And that ByteDance is the single largest shareholder in the JV, and that TikTok will remain, they say, 100% owned by ByteDance.
Kevin, what do you make of that? This whole thing has revolved around the algorithm, about who owns the algorithm, who controls the algorithm, how the algorithm can work. And for so long, there was an argument being made that if you didn't control the algorithm, you couldn't actually train on it in some other way and change things from a security perspective.
Yeah, well, it seems, Andrew, to me that there was some positioning going on here. The thing that I liked the least about this announcement was that there was no official Chinese government approval as part of it, but it sounds from Eunice that is being positioned in that market. Look, I've heard that the algorithm, although still owned and the code being owned by China, it's going to be licensed, and there'll be a new instance of it. The code will be transported to Oracle servers in the U.S. and retrained, and though the code elements will be the same, the retraining is what causes the algorithm to suggest the various videos in the For You feed. So I do think the training of it, the housing of it, and the fact that the data that would be used to train the algorithm for U.S. users is only going to be captured in the U.S. and stored in the U.S. and viewable only in the U.S. I think it meets most of the requirements, and I do believe, there's some face saving that has to happen. The Chinese government has to spin it a slightly different way, U.S. government a slightly different way, but in total, seems like it meets the requirements.
How do you see the success of TikTok going forward? I mean, one of the questions at some point was whether you'd have to reload, for example, the app onto itself, entirely, whether that would actually create, churn at that point, in terms of bringing advertising into the platform in ways that doesn't exist today, or ways to actually make more money, because this has never been seen, interestingly, despite the valuation, as some kind of shocking business.
Well, look, I think it's set up for success from a commercial perspective. I think the ads will continue. There are ads now, by the way, a fair number of ads interstitially between the videos.
Whether that sort of changes.
Yeah, I don't think it is, because as I understand it, ByteDance will continue to oversee ad sales, the commercialization of the app in terms of e-commerce, and the other ways that it's optimized and monetized from the users. I do think that the app download is probably going to be a bit of a non-issue. Apps are updated in background all the time on phones and mobile devices through iOS and through the Google Play. I just don't think that's going to be a big friction and a moment for people to abandon the app. I think it's going to be pretty smooth sailing. It's going to be interoperable as it is today across the world. Again, with the data being encapsulated in the U.S. Looks like a seamless approach. Looks like it's going to work to me.
I have one other question. Do you see, is it possible that this company could ever get sold to another player in the future? I mean, when you think about sort of M&A down the line, given the way this is structured.
I guess it's conceivable. You have a bunch of different owners with different goals in mind. You have Silver Lake, you have MGX, the Abu Dhabi private equity fund. You have Oracle, which is obviously a strategic investor at this point. You have the 30% of ownership that's still owned by the original non-China investors in ByteDance and ByteDance itself. So to get all those folks aligned on the right vision to have an M&A event in the future, relatively difficult to have a feeling. Probably going to operate as a joint venture, for a very, very long time, and hopefully ByteDance itself will go public as a result of this.
Hey Kevin, I know we got to go, but one last final question for you. It's sort of a curveball. Warner Brothers Discovery, you're in the media business. Who do you think ends up with it?
If I had to make a call, it's a must-have for Paramount, probably Paramount.
Paramount. So you think Paramount comes back with a bigger deal, bigger offer?
I do.
Eunice, we have to run. Last thing we should watch for? We've just got a few seconds left.
Oh, I think that we're going to have to see exactly whether or not the Chinese government at the end of the day is going to really approve, give that official approval.
Eunice, thank you very much. Great to see you. Kevin, thank you.
Kevin, thank you.
Always good to be here. Thank you.
And quick look at the futures for just a quick moment before we hand it over to our friends on Squawk on the Street. We're looking at the Dow up about 11 points, NASDAQ up about 78 points, S&P 500 up about 8 points as well. We want you to all have a fabulous weekend.
Yeah.
Get ready for the holidays. You're going to be away.
I am.
I will be here. Joe will be here.
Happy
great
holidays,
weekend,
everybody.
everybody. Squawk on the Street is up right after.
Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer and David Faber at Post 9 of the New York Stock Exchange. We wrap up the last full week of trading for the year with some quad witching, some TikTok news, Nike, FedEx earnings, and global yields up around the world as the Bank of Japan hikes their benchmark to a 30-year high. Our own 10 years around 415. Our roadmap's going to begin with Nike. Shares are dropping sharply in early trade. China sales plunge and tariffs hitting profits. We'll talk about if the turnaround plan is still intact.
Keeping an eye on FedEx shares, they seem to be under a bit of pressure despite the company beating on the revenue and earning lines. We're also getting a number of price hikes for the stock on the street. We'll check in on that. And then we'll be discussing the latest reports about OpenAI's new fundraising round. It's not quite. It's underway. The number now, $830 billion. I'll have some reporting on that as well.
Let's begin with Nike. Shares tumbling in the pre-market despite this quarterly beat. Got some weakness in China, overshadowing strength in North America. On the call last night, Elliott Hill talked about the turnaround plan and some of the headwinds they're facing.
Our order book is improving season on season. Through the sport offense, we're on our way in product. But as I've said, near-term investments to clean up and elevate the marketplace have put real pressures on margins. Tariffs have also obviously added a significant headwind to overcome. I want to state it very clearly. Margin expansion is a top priority for me and my leadership team. While it will take time, we see the path back to double-digit EBIT margin for Nike Inc.
Guide to a sales decline this quarter. Actually, another good piece in the Journal today about the tariff effect on Costco, Jim.
Yes.
But your point on Nike is that just when one thing makes progress, another area causes trouble.
Right. China was quite difficult for them because they were so trashed. They trashed themselves. They're in the wrong outlets. They've got bad inventory. One of the things that Elliott said that was devastating was this reality would become a lifestyle brand. I mean, that is the kiss of death. They're not a lifestyle brand, they're a sports brand. Matter of fact, they changed a lot of things in America. They've changed it from having a man, woman, child brand to having verticals of sports. Okay, I'm going to say something that people aren't going to like. You got to buy stuff.
Really?
Yeah, you got to buy stuff. Two reasons. One, if you think that the Supremes are going to go against the president, 70. Like that. Okay, in tariff. Now, I'm not talking calcium. I don't want to go to calcium because I'm investment. So I want to own the stock.
You're talking obviously about the Supreme Court case in terms of tariffs.
But I'd rather own the stock than own the bet on the Supremes. Okay. But second, Elliott Hill is a different kind of CEO. He came in and he recognized, Carl, there were so many things wrong, and he fixed North America. North America is really good. But then he goes on and on about how poorly he's doing in China to lower expectations. They are doing poorly in China, and every single thing they tried to discount. That didn't work. They tried full price. That didn't work. But he's going to go over it. And Elliott Hill is going to fix it. And we're all going to say, why didn't we buy it at 56, 57? Now, I'm not doing the Jeffries back up the truck, because previously he had said, just buy it. Credibility issue. But I do say that, you know what? Those who sell it down here, I think you're going to look back and say, first, when the Supreme Court, when Gorsuch says, listen, we don't like the tariffs, you're going to say, why didn't I buy it at 70? And then when China turns, you're going to say, why didn't I buy it at 80? So, yes, I'm a believer in Elliott, totally. And I think he ran a great call. It was a self-effacing call. He did not have any braggadocio. He was just saying, listen, we screwed up, and this is where we're going. I love that.
Yeah.
Humility goes a long way with me.
To your point, PIMCO had a report where they do think SCOTUS does rule against IEPA, to your general view. You think investors get another shot at 52?
I keep thinking, no, this is not going.
I mean, that was the low for the year.
Look, we have to understand. This man took the stock down. I mean, I'm listening, and I'm like saying, oh, wow, how low do you want this, Elliott? I mean, this was like, you know, the Tennessee, the football team?
The Titans?
Yeah, this is like, remember the Titans. Because they were bad, and this was bad. But the fact that he could turn U.S., I thought that was amazing. Look, let's say he did what, there's a fellow, okay, Brian Nickel. I mean, at 77, everybody gave up on him. Stock was 89 yesterday. He got out of China. Now, Elliott has told me, look, we're not going to do a joint venture with China. We're going to fix China, which is positive. But I felt very good after I told him.
Okay. And I mean, when Goldman Sachs says most notable incremental on the bear case is the significant outperformance in North America wholesale because of the gap versus direct-to-consumer widening meaningfully this quarter. And so while that would seem to be positive for the core strategy, it could drive concerns Nike could be oversupplying the channel ahead of brand momentum inflection.
But he's got fresh. It's fresh. Remember, he said you needed to do the two R's. You had to innovate, and you had to get rid of the inventory. He has done that in America. Now he has to go over China. I don't know what they did in China. I mean, if you wanted to destroy it, they made it like Skechers in China. Skechers didn't go private, so I understand. But they trashed it. I mean, whoever was running China, let's just say you couldn't have run it worse than they did. LA's going to go there and he's going to fix it. He's a can-do guy. He's a guy that has aspirations to make this the greatest company ever, the way it used to be. And I think you bet with.
So you think it's bottom, basically.
Yes,
This is it. Today is the bottom.
Well, when you have this much for sale, it usually means that people scalp it here, and then like around 10 o'clock they sell it. I don't want to pay 59, so I was at 57 when I started talking. That's stupid. I am saying that the turn is real. He will do it. He did it in America. North America was. Who keeps saying Converse matter?
There is some chatter about Converse weakness, yeah.
Converse, yeah. Hey, fans. I mean, come on. VF Corporate doing very badly. I come back and say, you either believe in Elliott Hill or you don't, okay? You're betting on Elliott Hill. And he came in, when I saw him last, he said, I'm going to turn U.S. And then I saw him again, and U.S. is, well, this quarter, U.S. is turned. Now, he sets his sights on China, and people can sit there and say, you know what, he's going to screw up China, or you can say he's a winner. I'm going with the winner attitude.
Right.
Sometimes the CEO really matters. This guy really matters.
It's certainly challenging year, third worst down name of the year.
Well, yeah, it's not that. It has not been a winner.
Yeah. On FedEx, why aren't shares reflecting its guidance better?
Okay, so it was up 7 early and at 4. Again, people don't know what they're selling. This was a quarter. I was interviewing Raj. Raj should read this to you.
Yes, I know. He was a guest on Mad Money last night, from what I understand.
And I was interviewing him, and I know Raj is a hitter. So Raj comes out and he goes, look, one of the things that did well with business to business, I scrapped the whole interview and pivoted to business to business because I've been waiting for that. That's where the money is. Healthcare, the healthcare vertical, they own that. They are doing amazing things to get parts to data centers. That's only a $9 billion. Healthcare could be $40 billion. They had a very good Black Friday, then they tailed off, but it's come back. The people who are selling this stock, again, are betting against a guy who's literally taken so many costs out. He's splitting off the freight, which is bad. What are you selling it for? I want to go into people. What are you selling it for? What do you want to go into? What you want to buy? CoreWeave?
No, right. What are you selling that to buy?
I like CoreWeave.
That's an interesting point.
No, I'm just saying, what are you selling? Why are you selling? I want to get in the mind of the seller. Here's the seller. I didn't read the call, but the stock's down.
Generally positive reviews, although a lot of neutrals. B of A's a neutral, JP Morgan's a neutral.
Came in pretty hot to the print relative
yes,
to...
Yes, it did, because Raj, everyone knows that the guy is confident. What they don't realize is the switch from business to consumer to business. Now it's more than 50%. That's where the margins are. That was such a delay.
Some multiple revision higher? I mean, I do see B of A saying now 17 times 26.
Business is really sticky.
Yeah.
Business to consumer is fickle. They went from business to business, and Raj is making that turn. It's amazing. I mean, anyone who listens to that quarter has to come back and say, holy cow, it's a business-to-business company. That's worth a huge amount. Now, the robots still can't work with the odd size shapes, but they're working the robots. We're going to go to one of their, we can go to one of the warehouses.
Oh yeah, we are. You promised me all these great trips, and then you never deliver. We're going to go to Kohl's. We're going to go to, I don't even know.
I see you wore your Kohl's outfit, so I'll go right after. How much Kohl's cash did you get for that? It's like Confederate dollars.
Hey, I wore a nice suit once this week, all right? That's enough.
The nice is in the eye of the beholder.
It was nice.
But I do think that what's happening in FedEx is he has not only gotten so far as to be able to fix a lot of the costs, which is what he's working on, but now he's playing offense with business, and people don't understand B2B versus B2C. B2B is where the money is, like Anthropic. Anthropic is B2B. You want to be B2B. You don't want to be B2C because it's too fickle. B2C, just so people know, that's people who come in and they say, you know what, I love ChatGPT, and then they say, you know what, I love Gemini, and then they say, hey, you know what, my daughter's using Perplexity. That's B2C. I don't want to be in that business. I want long-term contracts from Eli Lilly.
I get it. What's that? I mean, I understand your perspective, though being dominant in the consumer channel can sometimes be incredibly profitable.
Well, but
to your point, it can go away more quickly, perhaps. Apple seems to have been able to maintain a fairly high level of consumer satisfaction.
They're the only one I've ever seen.
They're the only one. All right.
That's because no one really seems to understand that Tim has built an amazing product. They don't understand it. Here, look at this. Oh, never mind.
What was it?
I'm not showing you.
Privacy is a core Apple.
Someone criticized me the other day saying, oh, I'm going to text you and then David Faber's going to see it and then it doesn't matter what I say because it's out to everybody. So I'm being a little more careful.
What do you mean careful? We share all our texts.
No, I'm not showing you my text.
I don't share my text.
I'm kidding.
I
don't know what's going on.
I got bitch slapped.
And I don't want to know. Well, you just did, so.
Okay.
Yeah.
Good.
When we come back, OpenAI's valuations in focus as the startup ramps up fundraising. We'll take a crack at this story regarding valuation in the Journal today. Pre-market, obviously it's going to get a little squirrely perhaps. $7 trillion in options expire today. We'll talk about rates and a lot more when we return. Welcome back. OpenAI upping the ante when it comes to fundraising. In this piece in the Journal today, the maker of ChatGPT aims to raise up to $100 billion in a new fundraising round, potentially valuing the company at $830 billion. The startup aims to complete the round by the end of Q1. Jim, you've been all over this story all week long.
Well, look, this is rather an amazing elevation of valuation because they were $500 billion on Monday. They got to $750 billion on Wednesday. And then last night they got to $830 billion. This has been one of the greatest weeks of all time. I would love to have that week, David. Now, come on. That is a week to end all weeks, right?
It is.
That's like 4 2-point conversions.
No,
Tell me about it.
It's like reporting an earnings number that was 7 times what people thought, and your stock goes up 40%.
It's amazing. Look, if they get the 100 billion, obviously, then Nvidia goes up 25.
There's the key. If they get the 100 billion, I've been, first of all, I had heard the 100 billion number late last week, this weekend. It's like, wow, really? And then the question becomes, well, just step back for a moment. $100 billion raise is so far larger than any IPO that's ever occurred. It's almost inconceivable.
Well, that's like every dollar of Fidelity is going to go in.
Yeah, and so the question I've been asking of existing investors in OpenAI, for example, also who are asking the same questions, by the way, because there's not that much information here really that at least they seem to be getting, is where's the money coming from?
I don't know.
Well, maybe it'll be some in the Mideast. Maybe it's part of the NVIDIA 100 billion.
No, that's at 500 mil.
Well,
And
maybe
it's
it's
not-
changing.
And it's not.
And by the way, maybe it's not 830. I don't know where the number is.
I'm going to say that it could go to $1 trillion over the weekend.
No, but Jim, it could be Mideast money. It could be some of the NVIDIA money that was part of that memorandum of understanding of a $100 billion investment.
Right.
SoftBank may be increasing its own contribution, although they're already at 30 billion, much of which is yet to be invested.
But don't you think it's dicey to put that number out without
I don't know
real
where that
circles?
number's coming from. I don't know where the girl's getting it from. I don't question it, but
It's not made up.
Yeah, but what's it based on? I mean, you got to give me a revenue number and something to at least base it on.
Well, they just a $20 billion run
I mean, is it because SpaceX is 800? They want to be 830? I don't know.
Well, it's entirely possible,
Just to
David,
be
that
the
it's-
biggest
it's
of the
entirely
privates?
possible that it's like Seinfeld's show.
About
It's based on
nothing?
nothing.
I don't know if I agree with that.
Well, I'm
Certainly
just
in
saying
many
that I don't
wouldn't.
like the trajectory. Carl, I don't think that when I read all these different trade publications, there's 500 billion. What happened? No, honestly, you had to have a huge funds come in and circle a gigantic amount in order for them to. Huge. So you needed like.
No, it's a good question. Like, where is the money? Why don't they just come public? Why don't you just
I don't know. I'm not running it.
just move it up?
But
By the way, that sale was their employees for the most part selling at
500
trillion. Yeah.
I mean, look, if you talk a good game, there are people who think that this is not a commodity, that it's proprietary. Then there are other people who think that these are commodities, and that therefore they have to take the money very quickly. I don't know a soul who thinks that they're just a joke, but I do think that the way that this has been disseminated does seem like that I'd like to hear who is telling them these various press outlets. They're never going to tell me, and you're never going to know. But to say it's 500 on Monday and 8:30 last night,
And we should, I don't know if it's a little inside baseball, but they have had some churn in their communications offices.
Yes, they have.
Which this is obviously a key part of any company's communication strategy.
Well, I mean, it had behind the scenes. It would be, and David, you know this from 2000, since this period seems to be a little like that magical period. Is that someone is saying, listen, how much is Fidelity paying? Well, they're willing to pay 600. I'll take the whole thing for 700. And then somebody else says, listen, I don't want that. I want them to take it. I would do anything. But no one has the money to take the whole thing. They don't. There is no pool of money. I mean, there's no pot of gold at the end of the rainbow.
No, although NVIDIA has a lot of money,
Right.
and if they're willing to do it, how would you view that if NVIDIA invested 50 billion at 830 billion valuation, positive or negative?
Negative.
Negative.
Well, because that's just trying to get its valuation up. Why, and remember they have another look. I'm just saying we have to be skeptical of these. That's all I'm saying. We have to be skeptical. I'm not saying they're lies. I'm not saying they're made up. I'm just saying approach it with some skepticism.
Well, the numbers are incredible. That is certainly something I say oftentimes about the quarters when we get them. The numbers are incredible.
There's one guy who had it. 1400 Pennsylvania.
What about it?
President.
Yeah.
1600.
1600.
Whatever it
It
is.
hasn't been downgraded yet. They haven't changed the
It has to be
address.
the president. It has to be the president. It's the only guy who has the money. It has,
What?
it has to be national security.
He's taking about the government taking a stake
Yes.
in OpenAI.
Absolutely. It's the only way they can get the.
No.
I'm telling you.
No.
Why? Was that any more official or not than the stupid stuff we read in the paper?
The government doesn't have that much money either.
Oh, they are.
Well, we'll get to, there's actually some good calls on NVIDIA today. We'll get to that. Others on Tesla, CoreWeave, PACCAR. We'll get Kramer's Mad Dash in the opening bell in a minute.
Get ready, we've got 7 minutes before the final bell for the week. I'm thinking, man, we're getting close to the final bell for the year.
Something,
How did it happen? But we got a mad dash. Talk a little Wells Fargo.
Something we talked about earlier this week. There's a change in Wells Fargo. This was a bank that we said they were around the table, the kitchen table. Now they're around the table, the deal table. David, you have said over and over again, you see the names of the people who work at Wells, and they're not Wells people. They're from everywhere. That a lot of these people are people who I think weren't able to become CEO at their companies because the CEO himself would never retire.
No,
So
I made this point to you, I think it was this week or last, about when we were talking about Wells. They have brought in a very senior layer of deal makers over time.
And it's working.
In various areas, and it's working. They're number 7 now in the league table. So
Netflix, David, you told me Netflix.
I did. Largest single commitment made to an investment grade company, almost $30 billion for the bridge facility from Wells Fargo. They also have been advising on a number of the other deals. By the way, they're not Goldman or Morgan Stanley yet. They're just a little bit above Centerview, a far, far smaller firm that's private. But it can move the needle because the margins are so high in investment
Right, it
banking.
takes 2 people to do a deal, and it takes 200 people to do an IPO. David, one thing I would point out, Charlie Scharf, many people know, is just one of the nicest people. And he's a regular person, and that's attractive to the people who are leaving the master of the universe firm to go to someone who just
So
is
you've
let's
liked
get it
this,
done.
you've liked it all along, you continue
and
to.
We're here. I've had one shouting match with Charlie I feel badly about. I want to take it back, Charlie. I apologize. Because I said, why aren't you buying more stock back? And he said, we're buying back plenty. Well, the fact is, they bought back so much. They bought back everything they could. And remember, the whole time he had the salary cap on him. But
Yeah.
he
You know what? It has underperformed a lot of the other names. I'm just saying. JP Morgan's up more. Citi's up more. Goldman's up more. Thank you. I'm wrong.
Yeah,
that's
wrong.
That's how many years is that?
You're wrong.
That's 5 years. I'm talking.
And now it's a trillion. Now it's worth a trillion.
One
Tell me
year.
it's worth a trillion.
I don't like to be wrong.
I've got 830. I've got 830 in the back. I've checked 850 in the front. I've got 890. I've got $1 trillion.
I'm right.
All right. All right. I have Goldman too. My travel trust.
Yeah, you got everything.
I was voted the most
likely to become a TV crazy person.
No, the most identifiable person who worked at Goldman Sachs.
Oh, you are?
Yeah.
Yes.
How about that? What are you?
What does Lloyd Blankfein have to say about that?
Oh, don't bring that up. He's got a new book coming out.
Does he really?
Yeah, he does.
The things you learn here. All right, we got an opening about 4 minutes away. Don't go anywhere.
Of the big Wall Street strategy desks, B of A is probably one of the most bearish at 7,100 for year-end 26. Today, they issue a report, Jim Hartnett, has a sell signal triggered. It's not always, but is usually followed by a drawdown in global equities of 2 to 6%.
Well, I respect his work immensely, and I take it very seriously when he says that. I'm still betting that we're going to have up here, but we're searching for leadership. It's hard to find a leadership. Giordani, obviously, you can't have everything because it's just too big. David, I look at to Marriott, the consumer, believe it or not, is going to bail us out. And I think that Michael, I don't think he captures soon enough. But he's very good. I really like him.
Very, very clever.
Very nice guy,
Here's
too.
the opening bell, by the way, in the CNBC Real-Time Exchange. And the big board is Sharp Beauty, Women's College Basketball Champion Classic in New York City tomorrow. At the NASDAQ, Okio Pharma, an ophthalmology-focused biopharma. Jim, your point on Carnival's good. They do guide next year, 248, Streets at 242.
Really
I mean, look at month-to-date Southwest Airlines, upgrades of Marriott lately,
No, it's great.
Airbnb.
And you've got to treat with Josh. I think that Josh is going to make the case that this is, this is still a value. It's a bargain. Remember, this is like the Empire State Building in water. I mean, there's so many rooms, and people know that if you go on Carnival Cruise, it's not expensive. It's a bar. Look, David, you're not there at 11:30. You're going, right? You're not.
I'm not on. Yeah, I'm not
I'm
there.
sorry. I'm sorry.
Stick around.
Oh, thank you, Carl. Appreciate it.
Disney's got good cruises. Royal's not been as good. The one that you want to be in, just so you know, when they come on and they are not jokers, is Viking. Viking cruises are for a little bit wealthier.
No kids.
But look, no kids. But look at that stock. Someone put up the chart of Viking Holdings. This is one of the best companies that I've dealt with in a long time. And I think that the people who run it, 59% up this year, incredible.
Yeah.
Now, I was on a barge, an art barge.
That's very nice.
You know how I got on it?
No.
Sag Harbor
Cinema Charity Gala.
Yeah,
You
my
won
race.
the auction.
Carl said, look, why don't you bid? I go up, sold to the man in the back. And I had the greatest time in the world, just so you know.
I'm glad to hear that.
That's Belgium and Netherlands.
Oracle's leading the S&P, David. You want to dive into this?
Yeah, I don't know how much is related to this basically Chinese approval of a TikTok deal that we have previously reported on. Nothing really changing in terms of the ownership structure of the U.S. entity or the entity that will control TikTok U.S. Oracle, obviously, one of 3 owners that will own 15%. These are the same numbers we shared some time back. But the news here is the Chinese apparently have given approval, and this is moving forward. This will be a U.S. governed entity, and there you can kind of see how it all mixes up. Now, maybe there's also just a rebound effect in Oracle that has nothing to do with this. A couple of thoughts, though, regarding specifics to this TikTok deal, because we don't know the numbers, but they're not that high in terms of the actual dollar amount they're paying for each of these 15% pieces of the company. ByteDance, remember, the owner of TikTok will continue to own 19.9%. What really is happening here is the economics are actually still going to be delivered to a large extent back to ByteDance. My understanding is it's a 20% royalty agreement and a split 50-50 on the U.S. profits. So that's a lot of profits and economics going back to parent ByteDance, but the governance is here in the U.S., and that is what the U.S. wanted. That's why the ban was in place, but had been suspended until they could figure this out, and that's where it stands. But that also speaks to why, while they're getting this thing at a discount to a certain extent, the numbers are just not that large given the number, the actual revenue profit number in the U.S. A lot of it is still going to be going back to the parent, ByteDance, in China. By the way, a moment on ByteDance. We talk about OpenAI. Consider OpenAI on one side and ByteDance on another. Its last round, where its employees sold stock, guys, was $320 billion. Its net income this year is $50 billion. So it trades at less than 7 times its net income. It's also got a lot of cash on the balance sheet. ByteDance, you might argue, is worth a lot more than that. It's not clear there was going to be an IPO in its future next year, at least. I'm talking to a number of people around it, perhaps in 2027. And in China, there may be some resistance to when you get up near $1 trillion mark, if you ever do, in terms of value. But
How do you get to Peter Navarro's argument in the FT that they're not trying to stimulate consumer spending?
That they're not in China?
That's Peter Navarro's argument.
Yeah.
It's very good argument in the FT.
Seems like they're not, because it's an export-led economy to the highest extent we've ever seen in the world.
He really
China.
point blank says that's the problem with China, and he's a very powerful article by someone who I hear as much from lately, and I think it's great.
page one of the Journal today is about cheap Chinese goods flooding Europe.
Right, and
more than offsetting any decline to shipments into the U.S.
Yeah, and Navarro's saying, listen, they shut down Mexico. Sheinbaum said, we're not taking your stuff. So now the Chinese have decided to send everything to Europe. Europe is suicidal. They don't seem to be able to stop it. And they've got major oil companies, and the oil companies just are going to go down the drain.
That's a real risk for Europe. They seem to know that, but they don't have the same de minimis tax that or exemption they still have, I believe, that we got rid of here.
Those
Makes you think it's
right there.
interesting, Carl, the anecdotes about people who have tiny little mini warehouses in their homes.
I love that.
You know, like a backyard shed where they're keeping things that they can deliver on behalf of Chinese companies. There's sort of these agents that are just some person who lives on the block.
And we always stay close because those four oil companies we put up, they can just be rich as well.
Well, Deutsche today on Tesla, it sees Q4 delivery down 14 year on year, but they still raised the target because of the promise of robotics.
Yes, and you're going to be hearing more about batteries soon. You're going to hear about batteries that can actually help power the data center issue.
Well, that's what Ford is doing as well. Remember, earlier this week, the big announcement from Ford, including the $19.5 billion charge, a lot of it non-cash.
Right,
but the repositioning was to the battery business, but not for cars, but for the likes of data centers.
I think it's very important. We're going to need it. And by the way, just so we know, and I've been a little quizzical about the valuation, the 830 billion valuation. I'm getting told they do have it. I'm getting told they do have it.
All right, wait. Now, you move around so quickly, nobody can follow you.
No, I'm saying that
You're talking about OpenAI.
During the show,
You've taken in some information during the show.
Information which says, listen, credible sources indicate that they were able to get.
I don't think it's done yet, Jim.
No, it's not.
It's far from done.
No, I'm just saying that some of our viewers are providing information which says, hey, listen, there are people who are willing to pay.
We'll see.
But that's, you're willing to pay, and then when push comes to shove, maybe you back down.
Well,
but
maybe that valuation for OpenAI, that to a certain extent, and their ability to take in another $100 billion that is powering Oracle higher. It's not clear to me that it really is a TikTok-related part of the story.
That's where I was going.
And you can see Micron following through, of course, after yesterday's significant move up on very strong quarter.
I really want to know what Jensen felt about that Micron quarter. I know it's not in town right now. But holy cow, that Micron quarter was such a thing of beauty. And Marosha was so self-effacing. I got to tell you, it was a beautiful call. Now, I'll say Elliott Hill, it was a very self-effacing call at Nike. He made it very clear, listen, we don't have the horses to China. So you've got some CEOs with, I think, an ability to tell a story without any hype. It's really
well, I think on both of those cases, because they've been through cycles that were not favorable at all.
Exactly. And Sanjay's been at the bottom, and somebody comes up top. Look, Elliott Hill's been there for 30 years. He understands that there are real problems at Nike. That quarter, when you read what he says about China, you just say, okay, who lost China? It's like it's like those State Departments, the China hands. Who lost China? John Stewart Service? Did he lose China? Who lost China?
Well, I'll tell you, a Nike Lulu chart will show you that even Nike's troubles don't even approach the depths of Lulu's.
Lulu is challenged. Right.
But both of them with China troubles and obviously North America too.
Pat Davis, he lost China.
Who lost China?
I'm Pat Davis.
Oh, thank you. I love these deep historical references he makes.
Who lost China for the United States?
Yes, I know.
No, I'm saying someone lost China, and I'm going to tell you who the previous CEO lost China.
Got it.
He turned into a lifestyle brand. A lifestyle brand. What is that?
I don't know.
What is that lifestyle
I don't
brand?
know, Jim. Carl, whatever you do, don't lose China. Don't lose China.
Or start a lifestyle brand. Jim,
I'm right about that.
I got to get you today on housing because all the chatter is about a new Fed chair who's going to be super dovish, but Lennar and now KBH. KBH had been a moment this morning in a 4-month
The numbers are so horrible. I mean, the companies, they jacked prices up, and there was a tremendous drive to get them, and now we're starting to realize, boy, they have really overpriced their houses. While I care about the interest rate, it's not as important as the collapse in pricing. This is the time to buy a home. You've come back to 20. Who else has rolled back to 2018 prices other than Doug McMillan? Doug McMillan at Walmart roll back the 2018 prices, and the housing companies have to roll back.
How? When Lennar's gross margin is at a, what, 10-year low? More?
How? They're just not going to do as well. I mean, I thought that Stuart Miller, as much as I like him very much, this co-CEO, now CEO, I did not feel that he had it under control. I did not feel that he had it. I did.
Guys, I do want to take a look at Warner Brothers Discovery, sort of at the end of another week here. Like so many people, I won't be around next week. Of course, who knows if I'll be calling in, we'll see. But the stock is up this morning after a significant decline. Remember, this thing was $30 with the idea, oh, this is going to really be a bidding war. We have to wait to see. We've heard, of course, from the company's chairman right here a couple of days ago, indicating all the reasons why they were not comfortable with the $30 all-cash bid for the entire company from Paramount. And so the question for Paramount at this point is, regardless of how disadvantaged they may continue to feel they were during this process, will Larry Ellison, who, by the way, is getting richer today again with that move up in Oracle of some 6%, his 1.1 billion shares in his trust, will he offer this personal guarantee that appears to have been so important to the Warner Brothers board, certainly when you read the background of the transaction that was offered in the 14D9 that was filed a few days ago. We'll have to wait and see. Will that be accompanied by some sort of a raise in the overall price? This could go on for a while. They could take some time. You do want to try and regain momentum if you still want to be in the game and put the pressure on Netflix. And of course, then the question is, if in fact Paramount did meet those objections, what would the board's response be? Would it be likely to lead to a superior proposal? Would Netflix then come back and exercise its matching rights and raise? So all of this playing out for shares of Warner Brothers. A couple of other things to just keep in mind. We're talking about, I mean, the tender is out there, but it really is not of great importance. You can't close it. So
I'm here.
What does it really mean? And I'm not talking to a lot of shareholders, at least, who are tendering into it.
Jake Paul, I'm here.
As Sam DiPiazza said, could be spring or early summer is a long...
Jake Paul, I'm here, the thinking strategist behind the sneaky snake trading strategy, Washboardjim, where I talk about chart patterns, moving averages, and break it out now. As we notice, the SPY just now broke out with a double top. Looking very bullish this morning. The SPX has a megaphone, double top, yesterday's high. Whoa, $2 more. Oh God, two-headed snake. Ooh. La da 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 da. SPY is very bullish. $680.94 is what I have next. Does anybody disagree? To agree? Or do you agree to disagree? That's the question. Big old breakout on AMD and Nvidia. Pulled back on Meta. How did that FedEx do yesterday? I'm just curious. FedEx dipped. That's what Jimmy said it would do, but it broke out too. So it'd be even. Maybe not at open though. Oh, it sold it. I had mixed messages on it. Looks to me like we hit resistance. Pretty close. Christmas, Jimmy sent no gifts to me. Ooh, I got an F today. Well, we've got a resistance on 5 minutes. Last 5 minutes here on the SPX. And I'm going to say 682338. To the penny. Tesla. AVGO's had that big sell-off here lately. We're gonna pop right to resistance. Jimmy said it. We're back at resistance again. We just now hit the orb. There's the pullback. Once it hit the orb, I expected that. And we still could go down one more candle. But oak. Oak. And we're retesting. Retesting the orb on the SPX. La 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 la. $68, $24, $94 is the new resistance, and we just broke it. We just broke it. We just broke it. It's a serious situation. How does he do it? I was sitting here watching Washboard on the YouTube channel, and he said, "Get ready." We just double topped the orb. Now we've got a new high. This is it. Damn. Turned down for what? See where 0707 is? 2707. That's my new resistance. Oh! Uh-oh! Something just happened right there. Jesus. How in the hell did that happen? Here we go. You see what I see? I see it. Hey, Nancy, would you go into the shower in there and get my house shoes, baby? Don't argue with me, just go in there and get them. I think we ought to have a poll. Should Nancy obey Jim more than she does? I gotta go get my own house slippers. Nancy. Maps is under a buck. Huh.
%18 of sales, up from 13% a year ago. And the Realtors chief economist noted they did not see a surge of delayed closings coming out of the government shutdown in October. Leslie?
Thank you, Diana Olick, for us there. Let's dig right into the market reaction. We're joined now by Mira Pandit, global market strategist with JP Morgan Asset Management. So the market's, digesting the consumer sentiment number somewhat in stride, kind of more of the same that we've seen for much of this year. From a sentiment standpoint, we've gotten some pretty decent AI indicators over the last few days with the Micron earnings. There's news that OpenAI could be raising at a significantly high valuation of $830 billion, at least that's what they're targeting. How important do you think that theme will be going into 2026?
The theme of our outlook.
Yeah, this one's contextually. Look at the numbers. We were at existing home sales churn was over 6.5 million units in 2021. Since then, we've drifted lower and stabilized to slightly over the 4 million prints. So if you look at the estimates for this month year over year, 4.15 million, but we came in slightly less than that at 4.13 million. Previous though was around 4.10. So essentially a little bit higher than the previous print, but less than expected. And if you look at the month-over-month reads, they came in around 0.5% to the upside. and that's less than the previous of 1.5%. So if you even think about, Sam, in the context of the Fed and Jerome Powell during the FOMC meeting last time around, he really spoke about the weakness in residential investment, and that's again indicative of what we're seeing with these existing home sale numbers around the 4 million mark. I looked at a long-term chart. You go back all the way to the 1980s. We're talking about these levels that go back to these 40, 45-year prints. But again, stable, but not necessarily the same levels we saw just going back a few years ago.
Okay. Okay, that's the data out of the way. Let's just talk about what is going on as far as some of the other geopolitical headlines we're tracking. Obviously, we've seen the EU leaders now approving this 90 billion euros, or I believe that's $105 billion of a loan package now, at least to Ukraine to help it out with some financing. This is not going to be about using frozen Russian assets. So just talk us through the importance of this story and exactly why we should be paying attention to that.
Yeah, I think the importance of the story is really not to disrupt the negotiations and, of course, the ultimate goal for peace between Russia and Ukraine and the EU. So this is a loan agreement. It's a funding gap agreement for 2 years. The approximate numbers in dollars is $105 billion to Ukraine. The important part of it is that they're not using the sequestered Russian assets as part of this loan agreement, because those assets that have been seized by foreign countries in the EU that are Russian-owned are still in legal dispute over the claims of those assets and even the legal right to those assets. So I think this is important. It's essentially funding gap to Ukraine, but also not disrupting the ongoing tensions with Russia and, of course, the EU and Ukraine.
And just switching gears to obviously another big story, we've been tracking a lot of central bank action this week. No surprises that the BOJ hiked by 25 bips overnight. We're at 0.75% now on their policy rate, which is of course the highest since 1995. We've seen yield spiking, which makes sense, but what doesn't make sense perhaps is that the yen weakened. It seems to be the reason that everybody's pinning to that is the fact that basically, Ueda was vague in his commentary around, what's going to happen in the future, so maybe less hawkish than the market was anticipating. Why should we be watching this?
Yeah, so less hawkish than anticipated, and I think the narrative behind this is, again, why is the yen falling? Well, if you consider that they did raise their policy rate to 75 basis points, which is the highest level in basically 30 years, expectations of those rate hikes are slowing down. If you look at the differential in rates, it's still very large. 75 basis points to Japan. If you look at the United States, let's just call it 3.6, between 3.5 and 3.7. That differential is still nearly 3%. The differential in the 10 years also, with U.S. rates over 4, Japan rates around 2, is quite large at 2%. But the interesting thing is that still the real yield in Japan is still negative, considering inflation in Japan is nearing 3%. So let's just call it an equivalent inflation rate as the United States, but the rate differential is still quite large, especially on that lower end of the curve. That differential is nearly 3%. So, the earlier threats and concerns of the Japanese yen carry trade unwinding happened when rates were extremely low. Now, as they're moving higher, that differential again is still there, but it's not as impactful. It doesn't have the largest magnitude like it once did.
Yeah, and I am seeing that the traders are on a little bit of intervention watch now with the yen, watching to see if that weakens any further and what authorities might do as far as stepping in to support the currency, particularly as we go into a sort of thinner session next week, of course, with holiday trading looking volumes a bit more thin. It could create some volatility for the yen too, but it's really important to highlight. Thanks so much for that this morning, George. I'll check in with you a bit later in the show. Coming up, we will take a bigger picture look at the macro picture and how the Trump administration's tariffs are still impacting the global economy. Morning Trade Live is back after this.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl?
Schwab, a modern approach to wealth management.
No politics, no spin, just the market, from open to close and beyond. Streaming.
No technical difficulties.
That includes Oracle and Silver Lake. In mid-January. The big question, of course, is that if Beijing will give the green light. We are waiting on that. But for now, Oracle shares are 2.5% higher. We are trading at 192 and change right now. So let's take a look at the winners on the session. And no surprises there that Oracle takes the cake off the back of that news. We've also got Micron extending on these gains. Yesterday, we saw his tough titcher rally off the back of its earnings, so really giving the green light to the broader AI technology type trade. We've got Carnival sitting up at 7.5% as well off the back of its earnings report, which looks good. It is being rewarded in the session today. AMD also higher in the session, up at 5%, as we have seen this nice rebound for technology across the board, as I mentioned. Let's take a look at the laggards on the session, and of course we do have a lot of earnings type of driven performance here, particularly for the likes of Nike, which was a bit of a disappointing print, particularly what it was telling us about China. Obviously some margin pressure there, so we are down almost at 10% on the session this morning. Lamb Weston down 20% this morning, so that is our biggest loser on the day. Conagra off the back of its earnings as well, down 3%. Paychecks, meanwhile, down 2.9%. So that's a quick snapshot of who's winning and losing on the session so far for this Friday. Joining us now, I'm very pleased to say, is Donald Muskin, Chief Investment Officer at Trend Macro. Very good morning to you, Donald. Let's just talk about the potential for this tariff reversal by the Supreme Court. This obviously has been put on the back burner as to how people are sort of thinking about this, obviously focusing on a few other things, but it continues to sort of bubble away there. Do you think the markets are pricing in, the potential outcome yet?
Well, I think I disagree slightly that it's been put on the back burner. I just think that the market fully expects that the Supreme Court will in fact strike down the tariffs. So it expects that so fully that there's really no reason to debate it. The oral arguments on November 5th were very clear. It's going to be 7-2 majority. We're probably going to lose Alito and Kavanaugh. But a 7-2 majority is just going to be a commanding defeat for these ridiculous tariffs that are indeed quite unlawful. But there are parts of it the market is not discounting. The market is not discounting that the Supreme Court will surely order refunds. And if the decision comes today, the amount of tariffs that have been collected that will need to be refunded are like $125 billion. That's 5% of S&P 500 earnings. That's just going to drop onto the balance sheets of the S&P 500 like a Christmas gift. Nobody thinks that's going to happen. In fact, everyone thinks it's not going to happen. There is a market on Wall Street in refund rights. Refunds are trading at 20 cents on the dollar. Wall Street thinks there's a 20% probability those refunds will be offered. No, it's going to happen.
It's going to happen.
There's never been a money drop on the S&P 500 like this.
And what would be the impact of such a money drop like that? I mean, especially for stocks, what would that mean for yield?
Well, it could go, I don't, so when you say yields, you mean, say, treasury yields, right?
Yeah.
Oh, I don't think it'll mean anything at all. I happen to believe deeply, and I believe the bond market agrees with me, that at the end of the day, the only way America is going to service its debt and deal with its debts and deficits is by growing its way out of it. You cannot grow your way out of a debt and a deficit by increasing taxes. Taxes are anti-growth, and you need growth to get out of the hole. These tariffs are simply taxes, no matter what our erstwhile president says. They are simply taxes. The elimination of the tariffs is a tax cut. It is pro-growth. The most recent Federal Reserve survey of the entire history of tariffs over the 250-year history of the United States shows this. It's not a question of whether they produce inflation or not, whether they help with federal finances or not. The question is what they do to growth. They hurt growth. They cause recessions. They cause depressions. This is going to be a huge boon to the stock market and the bond market both.
You know, I don't want to get too political, but it's just interesting that, you know, Trump has very much used the tariffs as part of his whole legacy. I mean, that was part of his whole campaign. I mean, what happens if we do see a sort of reversal? I mean, is there anything that you see that suggests that we could see some sort of replacement for that, as far as, you know, reputationally what that would mean for, you know, his political career as administration?
Yeah, well, there's no question. At his rallies, he, you know, always talked about tariffs, and he put tariffs on in his first term. Yeah, it's part of his signature thing. But if you go back a year ago, and when he was elected, and you look at the exit polls and why people actually voted for him, the number one issue was still the number one issue today: affordability. The number two issue was the border, and the number three issue is that Democrats were too woke. All this trade and tariffs and hollowing out the middle class in industrial America and all that stuff, that didn't even appear. Nobody voted for that. You see it in the exit polls. So Trump comes in, and his most high-profile economic program are these tariffs. And then, a month ago, Mamdani becomes mayor of New York, running on the same affordability platform that Trump did. And a day later, Trump takes his tariffs off coffee and beef, because he realizes that the American public needs relief from the affordability crisis. His tariffs are going the wrong way on that. So he himself is already reducing them. So when the Supreme Court knocks them down, sure, that'll be a bit embarrassment, and he'll go on Truth Social and call them scumbags and say they should be impeached. And he will privately get down on his knees and thank God that they just saved his presidency.
The other story that we've been tracking today is obviously a Trump administration. This
Hallelujah.
is Reuters looking at a review of getting these H200 chips to China. Now, of course, this would be good news for NVIDIA. We have to wait to see what the appetite is like in China for that. But I'm just wondering, you know, as far as what would be the strategic sort of upside for the US, is there anything you see as far as that's concerned? Because, I mean, Trump has been talking about how this is obviously going to help jobs. And I think, you know, this is important for investors as they look at this story, you know, as to what the intent is behind getting these chips to China and, you know, what it could mean for businesses manufacturing here in the U.S.
Well, it's very clear to me that the intent is simply to have a flagship American company, NVIDIA, be able to sell stuff to China. It's just, so, you know, here on out of the one side of his mouth, Trump is saying we have to make America great again by having our great companies export more stuff. And then he puts export controls on the most useful thing we have to sell. We don't have shoes to sell to China. We have NVIDIA chips to sell to China. So let's sell NVIDIA chips to China. What do we really think they're going to do with them? You know, fine, this is great.
Yeah, I mean, it certainly is an important piece of technology for the Chinese, particularly with respect to training. It's just whether we get the green light from Beijing. I suppose that's the next part of the story to watch. You know, we know that there's appetite from some of the Chinese companies, but I suppose it comes down to the officials over in China. But really great to chat to you this morning, Donald. Thank you so much for your time and your insights today, and have a happy holiday, Donald.
Hey, same to you and all your viewers. God bless you all.
Turn macro, appreciate your time. Coming up, we will take a closer look at the big picture with the team over at Charles Schwab. Morning Trade Live. We'll be right back.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
How's it going? First day, so. Sometimes, you know. Next. Try again. You could have done better. Please. Same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're a bull or a bear, you want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk Our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Western is selling off this morning despite beating earnings and revenue estimates and hiking its quarterly dividend. The sales were flat on a constant currency basis in the quarter, and adjusted gross profit fell despite manufacturing costs being lower. We are trading down. That is why it is down 21% right now. Welcome back to Morning Trade Live. It's time now for the big picture. Let's welcome in Colin Martin, Head of Fixed Income Research and Strategy, Schwab Center for Financial Research. So Colin, it's a global fixed income story for us this morning with those higher yields off the back of what we got from the BOJ last night. I mean, we've got the 10-year, what are we at right now? 414, we're pushing 415 this morning. Japan's 10-year high since 99. We're looking at 30-year yields in France, high since 09. What do you make of it?
Yeah, it's going to be an interesting story in terms of how that frames the outlook for 2026, because we're seeing this shifting dynamic where the Fed is clearly still in easing mode. How much they ease, is to be determined depending on the inflation and labor market outlook. But you have the Bank of Japan, which continues to hike. As you mentioned, its 10-year yield at its highest level in a long time. And when you look at Europe, every country is different, of course, but it looks like the ECB is done cutting for now, and we're starting to think about when will they start hiking rates down the road. So we're seeing shrinking interest rate differentials. And that can have implications for bond investors, where we're actually starting to see some value across the globe, where for years it just didn't make too much sense to really go global and consider non-US dollar denominated bonds, because one, the yields were pretty low, and two, we were in this dollar bull market. That's starting to shift, and we're starting to see more value with more attractive yield and income opportunities with non-dollar bonds. And if we see the dollar weaken due to these shrinking interest rate differentials, if you're a US-based investor, you go global, you might be able to get some currency appreciation as well.
Yeah, I've been talking to a lot of fixed income guys about that, as far as what they're telling their clients about where some of the opportunities are. I'm just wondering, where you're looking, where perhaps the best opportunities right now. I know obviously some do like the gilt market, particularly because they are highest amongst the G7 nations. But where should we be looking?
We don't get too into the weeds in terms of specific countries or areas. You do mention gilts. Their yields are still a little bit high, pretty close to U.S. yields. Because if you look at Europe, for example, they've already lowered their rates. So you'll see a yield differential there. There's a few things to consider if you are U.S.-based and considering global bonds. Because on the one hand, if the Fed continues to cut rates and we see U.S. yields move gradually lower from here, you get more potential price appreciation than you might get with, say, European or Japanese bond yields, which bonds will probably hold their value or maybe at risk of declining a little bit. But then you have to factor in the currency appreciation as well, as that might be able to offset some of the gap you're getting in income and potential price appreciation. The way we're framing it for a lot of US-based investors is that we think there's been an under-allocation to global bonds for a long time. And we think that a lot of investors probably have no exposure, maybe very limited exposure. So this is a good opportunity to maybe just introduce them as an asset class, one, for diversification purposes, but two, for potentially strong performance if we do see dollar weakness going forward.
Okay, something to consider moving into 2026. So let's just switch to the macro picture. Obviously, we've got a lot of information this week. The so-called Swiss cheese CPI report. Obviously, we saw a little bit of a movement in terms of how the market is currently pricing in what's going to come next from the Fed. I know that there's expectation they'll sit on their hands in January, but it looks like we saw a little bit of a movement as far as projections on the March cut, potentially above 50% now. So what are your thoughts? How have you been absorbing all of this data and sort of the impact on the market?
We'll need to see more confirmation before we figure out how this one report, it may or may not reframe our outlook. And I think Swiss cheese is a good way to describe it, having an asterisk there, taking it with a grain of salt. We can throw out all those buzzwords and buzz phrases, but I think that's the reality of the situation. Most of the data we didn't get. We get the year-over-year numbers, but we're missing key, under the hood inputs, and monthly data matters too, to see what was that 1 or 2 month trend. So, it is a step in the right direction. I don't want that to get lost in that the move down in the year-over-year core and headline CPI numbers was certainly a good thing, but we need to see more confirmation over the next few months, just like we need to see confirmation with the labor market. So this doesn't really change our outlook right now. It hasn't really done too much in terms of Fed expectations for January and March. But if we do get more good news like this going forward, I think it can pull forward the potential next cut date, where we're right now we're looking more at June, so kind of close to the middle of the year. But if it shows that this is actually the case and we are starting to see the tariff impact behind us and we continue to see services inflation come down a little bit, then maybe we see a spring cut.
Yeah, it's interesting that, the New York Fed Reserve President John Williams had been sort of out this morning also talking about how the sort of technical factors had distorted the numbers that we got yesterday as well. Obviously, we've been passing over a lot of Fed speak. Just wondering, with all of that in mind, particularly with what we're seeing on the jobs front as well, what else you're sort of thinking about as we move into 2026?
Yeah, it's going to be all the data and the more complete picture we can get. Clearly we're looking at the labor market and inflation is still above target, but there doesn't appear to be a risk of a reacceleration from here. So if we're going to separate the Fed's mandates and focus on what those officials will be really keying in on, it's the labor market. And we are seeing, pockets of weakness there. The fact that we've started to see monthly job losses, even though we've seen a rebound in the following months, job losses are not a good thing. And if that trend continues, given the concern that Fed Chair Powell mentioned about potential overshooting with the numbers, given that we saw the unemployment rate rise up, even though there's a lot of factors that go behind that, if more entrants are joining the workforce, doesn't mean the increase is necessarily a bad thing, but we don't want to see that increase continue. So we're really going to be focusing more on the labor market, especially given that we got some positive news with CPI, albeit a little bit incomplete.
If we see that unemployment
so there it was, 63 with a hammer.
If it goes up, a tenth here and there over the next few
It was
months,
right off my little support level that I had here.
And we probably reframe our Fed outlook a little bit more and expect
So
more
yeah,
cuts in
that was
2026.
Okay, something to look out for. Hey, thanks so much for
I was watching on the /ES. We never did break below the 63.
Colin Martin, Head of Fixed Income Research and Strategy, Schwab's Head of Financial Research. Coming up, it's time for the morning trade. And we'll take a closer look at Nike this morning, which is selling off after earnings yesterday. Morning Trade Live. We'll be right back.
Yeah, I missed that one.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7,
6840s.
anywhere, free on schwabnetwork.com.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast
Two in the chamber.
right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the
Boom.
NYSE, right when it counts.
We're back on Morning Trade Live. So let's focus on Nike right now. The stock is selling off today after issuing a very gloomy outlook. More on that in a second. Today's move on the chart is just the latest in a very up and down year. 6 months ago, the stock gapped up 15% after earnings and was trading as high as $80 in late August. But since Labor Day, the stock is down more than 25%. And that is after today's slide. So we are down right now. We're at 59 and change. Let's take a look at other athleisure names here. And we are getting dragged down across the board here. Lululemon, which came out with a not too shabby report. In fact, up almost 2% right now. Deckers Outdoor up 1.2% and On Holding. Oh, sorry, excuse me. They're all down, down fractionally for On Holding as well. Getting my words were mixed up this morning, but we also saw athleisure names over in Europe getting hammered overnight off the back of that in sympathy as well. So that is the focus of the morning trade. So joining us now for a closer look this morning is Kevin Green, senior markets correspondent. So you and I were breaking these numbers down yesterday, KG, and they didn't look good. We saw the market responding. Obviously, that number out in China is, obviously what's very problematic here. Not to mention the fact that they're absorbing tariffs, they're cleaning out this inventory as well. Just talk us through what you're seeing as far as the reaction today and, what some of the sort of sell-side analysts are saying and, whether we're seeing this pullback and whether it's justified.
Yeah, we are seeing the shares down about 8%, but you do have
68.40s back at resistance.
From the lows from pre-market trading. But as you talked about,
Beers.
the announcement was not that great, at least when you're looking at the guidance moving forward. Now, the company did report revenue at $12.43 billion. Street was looking for around $12.1 billion there. And the adjusted earnings per share came in at 53 cents. Street was looking for 37 cents. So a top and bottom line beat, but it's the margins that's actually causing a lot of the problems. The company actually did saw a reduction of margins by 300 basis points for Q2, and they also guided to the fact that they may see another 175 to up to 225 basis points decline in margins in Q3, and that is where the problem lies. Now, we did see actually expansion and growth within the North American sales, and that did offset some of the China weakness here, but the margin compression, as well as trying to get through some of the existing inventory, has put into question this name, at least for now, and which is why the stock is moving to the downside. Now, if you're looking at the sell-side analysts, they're still optimistic over the long term, but they have moved their price targets down. We do have Bernstein moving their price target down to $85 for the stock. That's down from $90, but they keep their outperform rating on the shares. Once again, acknowledging the strong Q2 beat in some respects, but they do believe that the management team still has a long way to go in order to turn this company around. We are also seeing Bank of America. Their price target has now been moved up actually to $73. That's up from 84. I'm sorry, moved down to $73. That's
now be careful.
$84.
Up here at resistance levels.
Again, kind of acknowledging the margin compression here. So is the move justified? It is. It is pulling back, but getting closer to an area of support where buyers have stepped in before. But this is putting a lot of pressure on other apparel names, as you noted earlier here, Sam.
Certainly is something that we are seeing getting hit across the board. Thanks so much for breaking down the report and some of the reaction in the market today, KG.
I hate to raise it
Scott
up.
Bauer, CEO of Prosper Trading Academy. Very good morning to you, Scott. Happy Friday. It's not a happy Friday.
But if it's up there, if that breaks.
Absolutely. I mean,
You got a double top.
Kevin said here, and we're kind of in the middle of nowhere.
68.30, 60.
Support down at the April lows, which is 54.55. So
we're at resistance.
Volatility has gotten absolutely hammered after earnings, as it should. So I am actually going to buy, going out to January regular expiration here, the 55 put and the 65 call. That is called a strangle. I can pay for that for $1, maybe a little bit less than that. And all I am looking for right now is a move in either direction in Nike. Just, it doesn't matter. You know, if it falls back to that 54, 55 level, great. If it rebounds a little bit, great. But really what I'm looking for now is just taking advantage of that very, very inexpensive option premium.
Okay, Nike shares trading down this morning off the back of its report card. Pretty disappointing one. Just want to get your sort of thoughts on the overall market action today as we sort of cap off the last full trading week of the year. Scott, what do you make of it? You know, does this sort of set us up? Has it given us the green light off the back of the information we got yesterday for a Santa rally come next week?
We're definitely at resistance levels.
I mean, it's great that we saw
68, 30, 61 levels.
I don't think we fully understand the eco data that came out.
Definitely
yesterday
at
with
resistance.
CPI. There's a lot of concern that it's really not what it kind of was announced to be. So I think as that kind of comes out and we see more data coming out over the next several weeks, we'll be able to digest that. But
for the
nonetheless,
68
the market likes it
40s.
right now, so maybe we are set up for that next week.
Yeah, many are saying out there we must need a more cleaner print, you know, and a little bit more of confirmation of that trend moving into January, which is obviously why we're seeing the current pricing in for potentially a March cut. But let's watch the data. Hey, thanks so much for that, Scott, today. Happy Friday to you. Happy weekend. Scott Bauer there, CEO of Prosper Trading Academy. Coming up, we will take a closer look at the sectors on the move this morning and what is moving markets overseas. Morning Trade Live will be right back.
Boom. $640.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter. Plus, get 24/7 live help and access support by phone, email, and in-platform chat.
Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the...
Well, she's definitely at resistance level. We got the 63 coming down. Nope. It's definitely run on the SPY. More knifage. Jimmy more or less said we had resistance up here, and now I'm getting ready to feel like I want to be in this trade soon. We got the VWAP on the /ES.
so that they can, operate in a new decentralized finance that does leverage stablecoins and tokenization. So I think it's a great opportunity for 2026 for the financials because this is going to take time, Sam. It's not next year, but it is coming, and I really do look to see what banks like Visa are making and taking those steps.
All right, noted. Thank you so much for that, Rebecca. And if I don't see you, happy holidays. Thanks for your help over the last few months or so. Rebecca Walser, President Walser Wealth Management. Appreciate it. Let's trade it now with Tom White, host of Fast Market. Okay, we're looking at JP Morgan Chase, an example trade for that name, Tom.
Yeah, Sam, they report on the 13th. We kick off another earnings season that second week of January. So look at a strategy that's a little bit more passive while avoiding that potential event risk as the stock's up by basically 32% this year, just a couple percent below those record highs that we hit. Went out to the January 9th weekly cycle here. So just a few weeks until expiration on this one, 21 days, where I'm going to sell an out of the money 310 strike put, and then against it, because I want to stay risk defined, I'm going to buy the 300 strike put. So it's short, $10 wide, neutral to bullish put vertical here. You're going to collect roughly about a $2.20 credit for this $10 wide put vertical. That means you can make $220 per spread with about $780 in risk, but that's below the 300 level. Now, if you collect that $220 credit on this trade, that takes your break even down to $307.80 over the next 21 days here. So you've given yourself a little bit of a cushion. The probability that that short 310 strike will be out of the money at expiration is about 63%. So those are those trade-offs that we always talk about on trades like this. It's directionally bullish, right? But I'm giving myself a better probability of success where I could be wrong and the stock could fall from current levels here, just above 315, to where it goes down to 310, maybe 308, and I could still be potentially profitable on this trade. So 3 out of 4 scenarios I profit, stock goes higher, stock stays where it is, or even goes lower, but remains above 310, I can be profitable on this one. I always look at baseball analogies or, don't try to be a hero type of strategies where, hey, I can still take a directional bias without being aggressive on it. Now, you could go out and buy a straight call or buy a call vertical if you're a little bit more aggressive going into this. But after the recent run-up that we've seen, the market and valuation base is at record levels here at this point. Passive type of strategies like this might be the way to go, but you get that cushion to the downside on this one of about 2.5% before you start getting below that break even.
Great stuff. A good look at JPM this morning for us. So reporting on the 13th of January, we'll be watching. Thanks so much for the example trade for us this morning, Tom White. I'll catch you a bit later on. Let's just check in with these markets, where things stand right now. We've got about 90 minutes into trade so far, and we have got a rally happening here. We've got a risk on across the board here. A bit of Friday cheers. So for the S&P 500 up at 0.7%. A good day for technology. It continues to rebound off the back of the price action we saw yesterday. So extension of those gains. A lot of moving parts with respect to some of the earnings stories as well, push and pull, but we are up across the board here. The Nasdaq off the session's highs now, but still up 0.9%. That's going to do it for us here on Morning Trade Live. I'm Sam Vardas. Download the Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. We've got Trading 360 coming up next, and I'll catch you later on Market on Close at 3 p.m. Eastern. Have a great rest of your trading day.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets
expert strategy, from the opening bell to the closing bell.
Well, it's trying to make up its mind. Real low volume.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of
Time
change
for
in
lunch.
sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside areas to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
They don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing up houses, opening up our business, having children, they've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
I'm Jenny Horn, filling in for Marley Caden today, coming to you live from our Chicago headquarters. Here's what's coming up on today's show. In our 360 Spotlight, we'll highlight the latest news in fintech and digital, infrastructure, plus the overall expansion we are seeing now of crypto ETFs. Now, Citi resumed its coverage of CoreWeave, and we're seeing a really nice pop today in shares. So George Tillis will give us the news behind the move and an example trade in our disruptors. And Nike selling off pretty substantially after yesterday's earnings. We will break it all down and some of these key numbers to keep on your radar in our 360 round. Now let's take a quick look at markets as we are seeing a pretty nice end to the week here as we're up in all four of our major averages. S&P is up about 0.6%. The NASDAQ is up 0.9% out in front today for the second session, and the Dow up about 0.5%. Russell is also up about 0.7%. So a pretty firm green day. Of course, a lot of time left though in today's session. Now as we check in on some future products, we are also seeing a pretty green board. Treasuries are up about 0.3%. US dollar also up 0.3%. Gold, a real standout, as well as crude oil, which is up 0.4%, and Bitcoin. Futures products are up 3.75% to hopefully ease fears of the crypto winter that has been looming for the last several weeks. But now to shift gears and take a look at some of the top movers in the market today. I'm now joined by Jeff Pierce, Senior Manager of Derivatives Trading for Charles Schwab. And so, Jeff, we have all of these developments regarding TikTok and their U.S. units now being sold to a group of investors that does include Oracle. So what does this news now mean for Oracle, which is a name, hey, that's pulled back about 44% from its highs that it made back in September?
Certainly so. We're seeing quite a pullback out of Oracle, and this is causing a slight jump today. As you pointed out, we've got TikTok USDS Joint Venture LLC coming out. Oracle, Silver Lake, MGX will all be big partners in that, each controlling around 15%. New investors as a whole control about 50%, with ByteDance retaining about a 19.9% retention there. Existing investors will also have about 30.1% control. The focus on the duties here for the joint venture is really that U.S. data protection, the algorithm security, and the content moderation that's been discussed so heavily around TikTok. They will have a board with about 7 members. They're going to be focusing on all of those duties. The U.S. data will be stored at Oracle on their systems. The algorithm retained with the U.S. data will be insulated from any sort of foreign influence. ByteDance, however, will keep their core algorithm IP and the global monetization. As you pointed out, this is a big move here for Oracle today. What it really means for them is a real reputation boost. Clouds and security partners with a politically sensitive platform and a big global brand. They also could be a major cloud and compute customer for Oracle. And strategically, it does align with their AI and data center build-out.
Okay, so to widen out and talk about some of that AI data center build, is that narrative perhaps maybe a bit more important to those that have been so skeptical of Oracle's debt load, its reach into AI, than this TikTok deal? And I'm not discounting this is obviously a positive development, but it does feel like all of the concerns still very much exist for Oracle.
Absolutely, and this should not take away from those concerns, and it really won't. We're not seeing a bump to make up even the last drop from the earnings report we saw. Obviously Oracle has had a good few years. Last year was a
get ready.
It's been much choppier in 2025. A lot of that has been concerns around AI infrastructure spending being very high. That remaining performance obligation growth that we're seeing is not necessarily showing up in near-term profits. There's a disconnect there for investors. Plus, we've heard stories around data center delay reports and seen some pretty big sell-offs around that, even when the company has come out and said that those aren't true. On top of that, you have a market that's really rotating out of some of these high valuation AI tech names, right? So the question for investors right now is, can these long-term AI cloud contracts really turn into some short-term cash flow? And so far, we're not seeing that. This story is not going to change that for investors, but it certainly is just another way for Oracle to show what they're doing on the AI front.
Yeah, I definitely think, a 7% move is nothing to, just brush off. It at least does help push Oracle shares positive now on a week-to-date basis. So great summary and great breakdown of what we're seeing recently in Oracle. Jeff Pierce, contributor here for the Schwab Network. Now, shift gears and get some insights on the news that is shaping the overall markets. For that, we'd like to welcome in Dale Smothers, President and CEO at RDS Wealth Management. Dale, thanks so much for being with us on this Friday. Looking back at the year that was in 2025, why do you think this bull market is still met with so much caution?
Jenny, you're exactly right. It was the climbing the wall of worry is an analogy that I like to use. This market has been resilient. The consumer has been resilient. There has been 3 major factors that have really shaped the market. The overreactions we've seen have come from China, the AI trade, and the Fed. These 3 things will continue into 2026. And while I do believe that 2026 finishes with a positive year, I would be surprised if we get much above a low double-digit year in 2026. These 3 stories will be the determining factor early on as to whether or not this optimism continues.
Okay, so which potential catalysts, those being like earnings misses, China headlines, or just unexpected Fed moves, pose the greatest risk to the market stability in 2026 in your opinion? Or is it just the combination of all 3 of those things?
A combination of all 3, they could certainly counteract one another. If the Fed comes out and decides that they're not going to cut any longer in 2026, which is the projection, to be real honest, with the new Fed chair, I expect a continued dovish cut to what they would deem to be neutral, which is probably around 2.7 to 3. We're 100 basis points away from that, Jenny. If something changes that, whether it's labor or interest or inflation, rather, any of those changes are going to cause a catalyst to the downside, perhaps, in the market. An expected settlement of China's trade war, if that doesn't come to fruition in 2026, it's certainly going to be a headwind for us, not a tailwind. And the AI trade, I think it's starting to mature, and the questions have to be answered. What is going to become profitable? Turning possibility into profit is a must. No longer will we buy the hype or the headlines. We need to see these AI companies making money on these trillion-dollar spending contracts that they're signing.
Yeah, the monetization leg, I do think, will be so critical in just the coming months. But to go back to more of that inflation conversation, focus on the Fed here, what factors do you see causing the Fed to perhaps deviate from their expected policy-driven approach and return to data dependency, as they call it?
I love what you're saying there, Jenny, the policy driven. I think a lot of what we're going to see with the new Fed is that policy will shape the data rather than data shaping the policy. And the reality is what could certainly change that is a higher than expected inflation print. This higher than expected inflation print will not be something that's met lightly. Continuing to turn interest rates lower in a higher inflation with a labor market that doesn't move like we expect it to. Perhaps it's AI driven, perhaps it's immigration driven, whatever it is. These two competing pieces of data cause the high wire act that we're seeing with the Fed, and either move on either side, higher inflation or a very stale and a stubborn labor market will likely cause that market to not react favorably to whatever the Fed decides to do.
Okay, so let's talk 3 of your stock picks. Apple, Amazon, and Nvidia. Let's start off with Amazon. What makes this now an attractive play, despite the fact that now, looking back at 2025, it's actually the worst performing of the Mag 7?
Which is exactly what makes it one of the most attractive plays for us. I believe that if you're going to play the Mag 7, there's a lot of potential that lies in Amazon as well as Apple. Amazon's continuing build out and subscription to AWS. Amazon Prime.
I agree.
These things are all cash flow positive for this company, and they have the cash to spend on existing and newly advanced AI. I believe that as they start to harness the AI, they are going to be a benefactor from this undervaluation, if you will, or maybe it's a lagged trade in the AI race of the Mag 7. I like Amazon, and like you said, Apple. Again, I've been a ringer of the bell for Apple for about 6 months now. When it was not making any AI decisions, it's now started to make some partnership announcements and advancements in its AI. But I think the AI infrastructure here, with the delay of their rolling out of what they're going to do with artificial intelligence, has actually given them a little bit of an upper hand. And because they've been a lagger as well in the Mag 7, I think both of those are good names.
Okay, and I mean, we've seen for years now, this is Apple's strategy. They're one of those that have like a delayed, really push into any major development in tech, and then they seem to do it better, which is, I think, the genius of their strategy, at least in these later years. But Nvidia was another name mentioned, and we always check in on Nvidia. It's one of the most, if not the most important name to this market. So given some of the pullback in shares, I mean, where do you see some potential catalysts for Nvidia now into the new year?
Sure. I think, Jenny, the pullback in shares really comes from our perspective at least, it comes from this battle between Google and OpenAI. You know, whether Google's going to be the player in the AI race or OpenAI, and clearly Google uses a little bit of a different type of technology. I still believe that the GPU is the workhorse of AI. This lead, if you will, that Google has taken over OpenAI has caused NVIDIA to pull back just a tad, but I believe it's more of a game of leapfrog, like we used to play whenever we were children, right? The leader is only the leader for a period of time until the new leader takes place, and oftentimes it was the former leader that takes place. OpenAI is making some big moves here, and with that, NVIDIA. I also use the analogy that no matter what horse is racing, if you will, the horses of AI, no matter what horse is racing, it races best, at least to this date, it races best on the track of AI, if you catch my analogy there. The GPU that NVIDIA makes, the track of NVIDIA, that is the fastest track for a lot of these AI horses, and I believe that we as a firm are bullish on this name simply for that reason alone.
Okay, and continuing to speak about AI, how does this build out create a growth story for a more traditionally defensive sector like, say, utilities?
Yeah, you know, I'm a big fan of utilities right now for our clients that are in this boat where losses hurt them more than gains help them, those who are maybe entering into retirement. Utilities has always been a place that's a little bit more defensive. It's a high dividend paying sector for sure. I like XLU here going into the new year, not only for those defensive properties, but as AI continues to build out, Jenny, it is going to demand energy. And these utility companies are going to be a benefactor from this. Strangely enough, I think utilities could become a growth story even more than they have in 2025 going into 2026.
Okay, last but not least, really quick, wanted to get your thoughts on silver, because this has actually been kind of a standout of this session in the last several sessions, which is a surprising, optimism really that we're seeing into this new year.
as silver as a commodity. At this point, you wouldn't think of silver and gold as being growth stories, but I think silver certainly is, and it will continue. What it's done in 2025, I think it continues in 2026. Our firm is a buyer of silver now, specifically not only for the defensive trade, which we talked about, the defensive trade, but it's got a pretty good offensive outlook as well. And a lot of this is driven by not only global demand for uncertainty. The uncertainty breeds a little bit of run to these commodities, these precious metals, but the conductive nature, the characteristics of its conductivity in electronics also means technology companies are grabbing for silver, and there is a supply and demand imbalance here that is causing silver to rise, and I believe it continues into 2026 as sort of a benefactor, or maybe we call it a roundabout trade in AI with a little bit of defensive nature.
Yeah, really great points. I mean, you'd be hard-pressed to find two better charts than those on a yearly basis of gold as well as silver. I mean, just like a pretty straight shot to the upside, and it's been consistent, reliable, which is, of course, the value that many do seek. But we so appreciate it. Really great summation on what we're seeing in markets today, and of course, as we go into 2026. Dale Smothers, President and CEO of RDS Wealth Management, thank you so much. Now, plenty more to come on Trading 360 today. Next, it's time for the big three. 3 stocks, 3 charts, and 3 trades. Rick Cat will go through the technicals, and Tim Bowen take us through trades for Delta Airlines, Tesla, and American Eagle. That's next on Trading 360.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Welcome back to Trading 360. I'm Jenny Horn, and it's time for the big three. 3 stocks, 3 charts, and 3 trades. Rick Ducat will take us through the charts, and here to take us through some overall picks as well as stocks to keep on your radar is Tim Bowen, Chief Technical Trainer at StocksToTrade.com. Now, great to see you both. And Tim, let's start with really your big picture thoughts as we are closing out today's, of course, this week is our last full trading week of the year.
Yeah, my opinion kind of remains the same as every week. Still very bullish into the midterms. We kind of got that
5:30.
Oil prices down, rate cuts coming. Listen, I just kind of remain very, very bullish, for the foreseeable short-term future.
You do, buddy.
And I was on with Nicole a couple of weeks ago and was talking about, S&P 7,000. I said, maybe not this year, but things look pretty strong. And I mean, we're running low on time, but maybe we get there. Then we had, the news with kind of Oracle, a lot of that big pullback kind of brought back all that AI bubble talk, and that kind of has cleared up over the last couple of days. So still remain very bullish. The AI sector
and now we have space plays, you know, Trump talking about going back to the moon. So just a lot to be excited about into 2026.
Yeah, I love that take that we have enthusiasm, of course, into the new year. But I mean, an enthusiastic sector has been the airlines. We've talked a lot about Southwest recently, of course, reshaping some of their loyalty program, but we're focused today on Delta, which, I mean, has also been a name that's still up about 16.5% this year. So what do you like about Delta right now as we do approach this very critical holiday travel season?
So this one showed up really, you know, for me on a chart perspective, when it kind of broke out over the 52-week highs from kind of back in January, February, right there about 69.70, kind of broke that hard resistance level, and then kind of going into consolidation mode. But as you said, you know, airlines are kind of in the buzz right now, so we've kind of got that, I call it kind of the zeitgeist, kind of the hot sector idea. And then I just like the way this chart has based above the 52 weeks, kind of going into consolidation, and we got earnings coming up, you know, in the middle of January. I think this could definitely run into that earnings day.
And a pretty nice session today, so we're up about 1.2%. So now, Rick, take us through the chart and the latest here with Delta.
Yeah, so our green line here is that point where we saw those old highs from almost a year ago here. The price action that we saw more recently was a downward sloping channel between our two blue lines here in this area. We had a pretty consistent ceiling at our lighter green line here near 62. We did make marginally lower lows, but for the most part, price stayed within these boundaries here. So now if we look at our next chart that includes our moving averages and our RSI, we can see that the moving averages that we follow, 2163 to 252-day exponential moving averages, are diverging farther apart still, with the faster ones outpacing the slower ones to the upside here. The nearest is our shortest term yellow 21-day EMA near about 67 at this point here. As well, our 63-day EMA roughly lines up with our old highs from our range-bound area there. But the RSI is what is most interesting about this particular chart here. For one, you can see that during this time when we were forming this repeated floor near 55, 80, 56 or so, we were seeing bullish divergence that whole time. So marginally higher high or higher lows on the RSI, while price was making slightly lower closes here. It did play out to the upside this time, but now we're seeing a reverse situation. We are seeing bearish divergence here, where price was grinding slightly higher here, but the momentum was trending downward and has moved out of that overbought area. But now, you know, we could see this could be a bull flag, bull pennant type of setup here if we get another push above that resistance level here near 72.34, which represents our intraday highs that we saw from a few sessions ago. If we do push to the upside, the 75 level stands out. It's our +2 standard deviation channel. That could be a short-term resistance area to the downside. If we do break below 69, there's heavy volume at around 67. That also roughly lines up with our +1 standard deviation channel and our 21-day EMA, so that gives us a confluence point there, so 67 to the downside.
Okay, and now to shift gears entirely into a different area of transportation and, of course, trying to be more of an AI play. That's Tesla. And so, Tim, Tesla did make a new record high this week. I had to triple check my platform because it's just amazing the way that they always are able to do this, it feels like, at the end of the year. But do you see a lot of this upside perhaps tied to SpaceX and this basically being a proxy for Elon Musk really at this point?
You nailed it. You kind of stole the words out of my mouth. You know, I've obviously been a Tesla bull for over a decade. You know, funny enough, about 3 years ago, I was on a similar interview, and basically the host ended with, if you were like going to a desert island for 5 years, what's the one stock you would buy? I instantly answered Tesla. Look at the 3-year chart since then. Would have been a pretty good time on the desert island. But what I like about Tesla now is exactly what you said. You know, the space, you know, again, Trump's talking about returning to the moon. Everyone's like, as soon as the SpaceX IPO got announced, I mean, people were like blowing me up. People were like, how do I get in? How do I get in? I'm like, it's going to be a while, guys. So I think a lot of people are using Tesla now as a proxy for that SpaceX IPO, add in the robotics, add in the fact that Tesla or that Elon is just always in the news. I just love this chart, and I think if this thing breaks 500, I mean, that could just be a next launching point for the next level higher.
I always say Tesla is the gift that keeps giving, because even when we're like news light, they always have news. They always have price movement. They're always volatile. They always have pretty decent volume. So I think great points there. And Rick, as far as this chart, this is also a name that we frequently discuss from a technical perspective because it's all over the place.
The typical length of time I look at on our charts is 1 year. This time I thought it was important to do a 2 year because we are near a very significant old high. If you look back here, you can see our intraday high came in around 488.54. In terms of our best close though, it was a little bit lower, but notice here, we did break above, we closed above that level, we did make intraday highs beyond that point, 495.28, but then we had a bit of a pullback here. Now we've been chopping around between these two boundaries here, roughly the levels we mentioned above 488, and here was our some of our best closes from back in that previous period from November, about a year ago here. That level's 463. So those are two very noteworthy boundaries here. Notice again, 463 was around where we saw some highs as well. Price had a hard time getting above that point, and then it was our high before our gap to the upside here. So notice as well, we are in a very tight, very narrow upward sloping channel type shape here. So those could also be some potential ideas for boundaries to watch going forward. RSI has been trending upward. Momentum still remains more positive here. We are starting to slip a bit below this trend line here that we're seeing. So momentum slowing down somewhat here as we are at this resistance level. But, you know, we have to see, once again, this could be the triangular bull pennant type shape here where we do get the breakout eventually above those old highs, and the trend continues to the upside. Finally, our volume profile study shows all the heavy volume is here in this area between 420 to 450 or so. We can see that would be a notable point to watch to the downside. We are also roughly right about at our +1 standard deviation channel near 481. So this would be a notable supportive point as well in the shorter term if the price does start to lose some traction as we head into the end of the week.
Yeah, and I know lower, of course, on today's session modestly, but it's still a winner on the week and a winner definitely in the month of December so far. Another winner in the month of December has been American Eagle. I mean, this thing's up, it's just a cool 35-36% this month so far. So Tim, I mean, I would have never guessed that we would be discussing AEO with this much optimism, but frankly, it's been a really good story as far as their financials, the technicals, everything's adding up to this company.
Yeah, and you know, I always like to, you know, fortunately, you guys keep inviting me back every week, and I like to bring fresh ideas pretty much every week, but this is one that I know I've brought back several times. The first time I mentioned it on Trading 360 was when the Sydney Sweeney campaign first started. Stock was at 18 then. It was a big breakout right there. And I mean, really, when it comes to this, I like the retail idea, love the chart. And at the end of the day, there's this old saying in trading that, you know, if the stock does no wrong, stay long. And you look at, you know, when I shared it at 18, I think I shared it again in the mid-20s, and this thing just keeps grinding along. And that's really, I think that if it can really, the next test is going to be 30. If it can break 30, back to that quote that I used.
What?
If it does no wrong, stay long. I mean, it's just such a nice gradual uptrend in a retail stock. You know, it's Christmas season, all of that, and you get all the headlines with Sydney Sweeney, etc.
Yeah, it's been an impressive story. The return to depth.
You don't want to take profit?
Highlight on the earnings call, which I guess I'm not cool enough to fully understand, but hey, that's a trend that's working for them right now. So Rick, as far as this chart, I mean, Tim just laid out the way it's been this really nice upside swing that has not been really waning for the most part. I mean, December we've seen a 35% climb.
Sell it.
Right, this is a stock that can have some pretty big swings. Notice that we had a large push to the upside after earnings, but then a lot of the gains retraced retraced here, we once again found ourselves filling that gap here. That gap was the supportive point here before things started to improve. After a short period to the upside, we broke above this trend line. We had a strong rally then afterward here. So this area is also pretty interesting. See, we have this gap here between 2144 to 2307, just to be very specific, because this is a stock with a lower price, so these decimal points can stand out quite a bit more. But anyway, so that was where we had our gap up here. Then we had our bull flag type shape here, a sideways to downward consolidation. In this case, it didn't really even retreat to any notable near-term support, which is pretty interesting. It didn't even fill the gap before
no, it didn't.
Anxious to step in again. So now we push to the upside above those old highs near 2466. Now, perhaps we're in another of these consolidated phases here. This one more triangular, this one being the pennant as opposed to the flag that we saw lower. Anyway, so we can see that RSI is compressing somewhat here, seeing a little bit of that bearish divergence once again that indicates momentum slowing down here. If we were to look at our volume profile as well, we can see that the volume areas here are kind of around 24 and around 2750 or so. Those are the heavy trading points to watch out for. Our standard deviation channels, 2927 to the upside and 2532 to the downside. Could be some boundaries to watch as well.
Yeah, and of course, again, modestly lower today, but still closing out, expecting to have at least a winning week. But so appreciate it, Rick Ducat, as well as Tim Bowen, Chief Technical Trader at StocksToTrade.com. Appreciate you both. Great breakdown on 3 names to keep on our radar. Now, coming up next, we will be spotlighting a crypto turning point as Washington moves towards clarity. Vanguard is opening the door, and new IRS rules are unlocking staking in federal funds.
There it goes.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to
there we
go.
go.
Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach.
There's resistance level.
Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
It's a major resistance level.
The morning with the data and the decisions of moving markets. Morning Trade Live that breaks down the macro moves driving the price action, from Fed policy to global growth to inflation.
It happened to be today's high, which is we already hit that.
Always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are. Welcome back to Trading 360. I'm Jenny Ward, live in our Chicago headquarters, and it's now time to spotlight digital infrastructure and fintech. Joining us now is Paul Golding, Senior U.S. Lifestyles Payment Analyst at Macquarie. So really, Paul, where to start? I mean, what are you watching for in this space, and what are you watching in regards to the Clarity Act?
Good question.
Yeah, thanks for having me on. There's been a lot of legislative and regulatory improvement in terms of the backdrop for the crypto space over the last 6 to 12 months, really, but especially over the last few months as we had Genius, and now we continue to hear progress around Clarity.
we see large asset managers that are in the passive investing space moving into crypto products on their platform for retail. And we also continue to see regulatory improvements around tax treatment. We talked about the safe harbor for ETPs, exchange-traded products in the crypto space, in our latest FinTech and Crypto Digest report. But nonetheless, in what has seemingly been a bit of a risk-off environment as of late, we have seen prices in the crypto space relatively depressed. And so what we're looking for is not only a continuation of this regulatory and legislative progress towards incorporating crypto into the broader financial services ecosystem, but also continuing to see tangible use cases or relevance to store of value grow and potentially be more supportive of crypto prices overall.
Okay, and really, how transformative is Vanguard's reversal on the ETFs for cryptos for these flows that are into, Bitcoin?
Another good question.
Well, what I'll speak to is maybe what the arc of progression has been in terms of adoption in more traditional financial products for crypto denominated assets. And we've seen institutional adoption of crypto, whether it is Bitcoin as a store of value via ETFs or Ethereum ETFs having been approved as well.
Sorry, sir. You're not allowed to talk no more. Uh-huh. Pulling back a little bit here.
volatility as well. As far as some of the action here on Wall Street, we've had a few names that have really grasped everybody's attention, including Oracle now. Oracle has been higher throughout the day. It's up about 7%, and that's come TikTok agreeing to sell its operations to a new joint venture on that report. We've seen Nike, for example, under some pressure and some headwinds from China, where 17% decline in China's sales. North America was a little stronger. We're going to talk about FedEx in a moment, but that's had ultimately some good news that we can sink our teeth into. But big picture here, the 10-year bond yield sitting at 4.14. It's come off the highs. You still have several possible Fed chairs, and we may learn that in the next week, 2 weeks, 3 weeks, who will in fact lead the Federal Reserve in May when Jay Powell steps down from his role at that assigned time. And I should note the cruise lines are doing really well. Also, this is Carnival Cruise came in with some revenue for annually that really surprised everybody.
Yeah, and our Max 7, for the most part, has been intact today, but you mentioned FedEx, and actually, things have, just further improved throughout today's session, which is not something we've been able to say for a lot of these equities in each session this week, but we've been climbing ever since the open. I know we're still lower, but market has shaken off the mixed earnings quite well here, as we're only down about 0.5%, so walk us through your thoughts on that report.
CEO came out and talked about what a great quarter it was, and there were parts that were extremely great bright spots, in addition to lifting the bottom end of guidance going forward, saying, well, it won't be as bad as this, in fact, it will be better. So the guidance was some good news there, but I'll start with the current quarter, where they saw improvement. Priority packages did very well at home, U.S. domestically, as well as abroad. They did raise the numbers. They beat the street on the top, the 482 for earnings per share. It was 411. The estimate was 411. The revenue for the second quarter also beat at $23.5 billion to the $22.8 billion estimates. So you did see a beat there on both earnings per share and revenue. And the growth going forward is now 5 to 6% for revenue growth from 4 to 6%, right? So
that's a big deal.
There, and also on earnings per share too. So those are some bright spots. They have been trying to cut costs, but they have faced headwinds with wages on the rise. They've had to hire some folks in the LTL division. They plan on spinning that off. Some global trade policies, transportation costs, and the aircraft fleet, the MD-11 aircraft fleet that was grounded. But the big picture here, the analysts are still very positive on this name. For example, Jefferies has a 326 target, and the stock's at 285. Bank of America 315, Stifel 328, and many others in the high 200s. For example, Wells Fargo at 295, JP Morgan at 294. So they are seeing upside potential for this name. It is a peak season time, and the CEO did note that they felt it was an outstanding second quarter. They executed their growth strategy, the network transformation that they've been working on, and the cost savings and initiatives, and he was extremely proud of the team members worldwide. So some good news ultimately maybe in the longer run for FedEx. Right now, down about 0.75% today.
And definitely encouraging that we've seen some of that weakness that was, looking a bit steeper pre-market at least, definitely easing throughout today's session. So great breakdown on all of the things to keep on our radar today. Nicole Pedalides, of course, host for the Schwab Network. Now time to dive into our disruptors, and George Tillis, senior markets correspondent, is here with us with today's mover, which is CoreWeave. Now, Citi resumed its coverage on CoreWeave. What else is going on, though, with this? 20% move to the upside, George.
Yeah, this one was really waking up today, Jenny, and we talk about CoreWeave quite a bit on the programs across the board, because this is an important company, an important technology when it comes down to database as a service, or if you will, high-performance computing as a service. And CoreWeave has been establishing many partnerships with major hyperscale customers. Their backlog is extremely significant, approximately $260 billion in the next 5 years. And it was really a hyper-growth story, considering also an IPO earlier this year. And it did run up quite a bit going into June to about $180. But since then, we've actually seen the stock drift to the downside by about 50%. And it's reestablishing itself at some lower levels. But nonetheless, the analysts now are starting to look at this a little more carefully. Some of the issues that CoreWeave really faced was customer concentration risk. And again, we're starting to see that considering, Oracle, for example, has a lot of customer concentration risk with OpenAI, and that actually has not played out very well with Oracle down significantly since its high in September. But in fact, if you look at the analyst note from Citi, they actually resumed coverage on the name. They've got a price target now of $135. That's down from $195 or $192, forgive me. So a little bit more conservative in this regard. But they're citing that despite the fact that there was some issues with supply constraints because of power needs and power demand, they see the gross bookings last quarter as reported are still increasing. So there was a little bit of a hang-up in terms of deployments last quarter, but bookings are actually growing, so they're extending out further revenue streams. But again, they still see the strong growth in the supply backlog. And in fact, if you look at some of the other news with CoreWeave, they partnered up with the Department of Energy in their Genesis program, which is basically bringing together high-performance computing alongside the backing of the DOE, which we know has deep pockets.
Yeah, I think that news is probably a bit, not to say the analyst calls it important, but that I think is also a huge driver of today's upside. So as you now think through trading this name for example purposes, walk us through your thoughts.
Yeah, so interesting enough, if you look at the stock, like I said, in the last 6 months, it's down pretty big. It's trading below its 50-day moving average, so we have to keep in mind that the trend context intermediate is still down. But days like this, especially with stocks that are big powerful names, high beta names, they can get some short-term impetus and mobility and move higher. Now, if you look at recent levels going back to November, around $64, it looks like that might be a shelf floor. But at the same time, we've got some resistance coming up around $90. So based on the short-term momentum, I'm going to play this as a trend, short-term trend continuation. Keep in mind that the intermediate trend is still down. So this is a short-term play based on a continuation of that next level of resistance at 90. So what I'm going to do is I'm going to buy a call spread. It's a bullish trade, so the stock has to go higher. And I'm basically going to go out to January and buy an in-the-money $75 call, and then I'm going to sell the 85 call against it. Altogether, earlier today, you could have bought this for about $4.50 a share or $450 a contract. So the whole premise is,
okay, I'm here.
Essentially to break even, which it already is. And again, at 79.50's break even. You pay $450 to make $550,
we
and
pulled back.
$550 return will occur if the stock hits 85 or higher by expiration in 29 days.
Yeah, this one has been, definitely a volatility play throughout this year, so appreciate it, George Tillis, for that breakdown. Now, coming up next, it is time for our 360 round as we look at Nike. Shares falling in reaction to yesterday's earnings. We are now down about
I'm watching the 68.40s.
What to watch for the athletic retailer coming up next?
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays. We bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
Welcome back to Trading 360. I'm Jenny Horn. It's time now for the 360 round. And for that, let's bring in our panel to discuss Nike, as shares have been under pressure throughout today's session, even though we did see, some overall better than expected earnings. So joining us now is Jan Rogers-Niffen, CEO of J. Rogers-Niffen WWE, and Zach Waring, equity analyst at CFRA Research.
Niffen.
So Jan, I'd like to start with you. Thank you both for joining me on this Friday, first and foremost. But why did Nike's earnings beat fail to translate into any sort of positivity in this market reaction?
Well, Jenny, I have two kinds of clients I work with, long-term investors and short-term investors. And the long-term investors look at it and go, okay, early stage turnaround, Elliott Hill knows what he's doing, he knows how to fix these problems, this will get done, so they're probably taking positions as we speak. The short-term investors look at it and go, problem with gross margins, nothing's happening in China yet, the DTC is still a question, and until they see those things start to change, they probably won't be jumping in, and therefore you're seeing this crash in the stock today. But I'm a believer, I'm a staunch believer the turnaround's real. I think that Elliott Hill does know what he's doing, I think that it is early stage, it's not broken, and I think that will all happen, but it's not going to happen tomorrow.
And so really it does seem like this market is so impatient with some of these turnaround stories. And Zach, I'd like to throw it to you there. As far as this turnaround plan is seen, how do you depict some of these earnings in relation to hopefully the long-standing recovery?
Yeah, I think in our opinion, there are just better options right now within the space, right? So we do think there is a turnaround story here, and we do think they'll do a good job over the next 2 to 3 years, but we just like other names within the space a little bit more than Nike. Valuation isn't cheap, even if you look at it, on a 2-year basis. If you look at fiscal 27 earnings, consensus is around $250 a share.
They look cheap.
Earnings, and if you look at that, it's about 25 times that number right now today. So we like other names in the space. We think the turnaround story is real, but we think it's going to take longer than investors think.
I think that's definitely being felt by this market today. And Jan, as we look at some of the areas that were, easily weak, like direct-to-consumer, some of their China exposure, what really sticks out to you as perhaps a pain point that could continue into 2026?
Well, the one I'm the most worried about is China. They can fix the other ones because they can fix the other ones. They can't fix China if it's something more fundamental than they're just not buying that particular shoe or piece of apparel, right? And that may be the case. We don't really know what's happening in China right now. And I'm sure they're all working on what can we do about that. But that's the one that gives me the most pause. They'll get the gross margin fixed. The tariff will become less of a problem going forward. They will make some changes there, and then the tariffs will annualize. So I don't think it's a 2 to 3 year story. I think it's an 18-month story. So maybe that's the big difference in the way we're looking at this company. But yes, I still think it's a turnaround. I think maybe it's a little faster than maybe some other people do. So I'm saying 18 months, other people saying 2 to 3 years. That's a big difference in whether you want to own the stock or not.
Okay, Zach, to ask a bit more about its valuation here, Nike does trade at a premium to say like Lululemon, which we've talked about a lot this week, but as far as now forward-looking expectations, your price target is $60. So basically, do you anticipate things just stabilizing and staying exactly at these levels?
Yeah, there could be a pop, post earnings. I think, like he said, a lot of investors that are looking more long term, might get in here at these levels. And you saw that after the last quarter, it had a big pop, 15% pop in the first quarter for them. And we just think that it'll probably trade sideways to down if you do get that pop over the next 6 months. They're doing a good job, but the tariff impact was bigger than a lot of its peers in the U.S., and they actually have a smaller U.S. business than most of its peers. Which gives us a little bit of worry. And then the digital business falling double digits was another concern of ours. The premium that they're trying to put on that brand and that platform, we just don't know that it's going to work, and it might impact top line.
Okay, and so Jan, before we go, want to get your thoughts on some of the trends we're seeing in the broader athletic retail space. And sometimes I think we overcomplicate it, as we all tend to do as students of this financial market, because frankly, we've seen a lot of competition, like names like Alo, Vuori, even Lululemon, On. I mean, it just goes on and on, the list of companies competing for athletic retail. And so is that also a driver of some of the caution?
Yeah, you have that hook and Adidas. Yes, we're certainly seeing more competition in the space, and we're seeing new, fresh, fun competition. Part of Lulu's problem is they don't look fresh and fun, and Alo and Vuori both look fresh and fun. So that does make a difference. Nike, though, has this great name in the space, and if they can just get the pieces moving, and I agree, DTC and China are my biggest concerns. China #1, DTC #2, and I think DTC is more fixable faster than China. So I think as people start to see things like Foot Locker work for Nike, and as they say things like Dick's Sporting Goods taking more of a position with Nike, and that'll synergistic piece happens between those three businesses, that'll be a positive and will get attention. And as they start to see DTC start to work, we will see people bailing in too. China may take a long time, but the other pieces of this can go faster. And I think that's enough to make it all work. If China just doesn't get worse and marginally improves.
And we'll also be continuing to watch Nike, of course, as the rest of this year unfolds. I know we're pretty much at the end, but Nike not ending the week at least on the brightest spots. But appreciate you both, Jan Rogers,
kind of at a pivot point.
WWE, and Zach Waring, equity analyst at CFRA Research. Thank you for tuning into Trading 360 today and all week long. I'm Jenny Horn. Download the free Schwab Network app available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. Fast Market with Dan King Hall is coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered. Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand. Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey Bob. Hey Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant. I programmed that 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Nike took a beating, yeah.
Welcome to Fast Market here on Schwab Network. I'm Diane King Hall, coming up on noon Eastern here at the New York Stock Exchange, and the Bulls are working on a second day in a row of games. Let's get right to a check of your scorecard as we hit the lunch hour on Wall Street. The S&P 500 right now better by a little bit more than 0.75%. Information technology is at the top of the leaderboard there. Dow got a gain of a little bit more than 0.5%. NASDAQ 100 better by more than 1%. Russell 2000 has a gain of almost 1% at the moment. Here's the roadmap for today's show. We'll look at example option strategies for Apple, plus the team from Lightfolio will be along with new sentiment data on Royal Caribbean. And Alphabet Google is also on our radar today. Got a couple of the Mag 7 names in there. Now that we've got the roadmap for today's trading action, it is time to bring in my co-host. You've got Tom White in our Chicago studio, and Kevin Green is parachuting in for us.
Tesla.
We got the AI trade. It looks like it's alive and well today. You got gains in NVIDIA. You got Alphabet Google. It's not the only one. You got AMD gaining some ground right now. When I look across this heat map, there's a lot of green over there on the tech trade. Tom, let's get your take first.
Yeah, I think if you take a look at it, it's almost like a relief rally the last couple of sessions after that four-day losing streak for the S&P 500 and the Dow. Typically in the month of December, most of the gains come toward the latter stages. Santa Claus rally may be in full effect here. And then I think if you start taking a look at, maybe what's coming over the next week, right? We've got a holiday shortened week next week. There's not a lot of data out. A lot of it's delayed. That might not ruffle any feathers at this point. But we're seeing that reversal back into some of the names that led most of the gains in 2025, and that's into major tech. But I think one of the keys is, even when tech was under pressure the last couple of weeks, you saw a rotation into other areas within the market. The S&P 500 equal weight near all-time highs, just off slightly from those record levels. So the broadening of this rally is probably going to help. And then you throw in the fact that we haven't seen any volatility in the yield market, in bonds at this point. And I think that's supportive of optimism here for equities also. So keep an eye on that over the next couple of weeks. If we start to see any volatility in the bond market and with those yields, that might cause maybe some headwinds. But right now, it just seems like the momentum to the upside here as this rally continues to broaden out here.
Okay, KG, Tom just mentioned the Santa Claus rally. Is Santa already in town?
I'm not sure about that. I think Tom actually did a little bit of a short yesterday regarding Santa Claus as well. It was a phenomenal one to say the least here. And look, I think today we actually do have a little bit more mechanics actually taking place here in the market, and the reason why we were seeing it move a little bit higher. We do have triple witching. You saw aggressive volume to start off today's session, which is normal at this point in time here, and you are starting to see
Mister.
I get a little bit concerned though going into the close today. Usually on days like today, we see one direction to the upside very aggressively, or even to the downside very aggressively, and then a reversal going into the last hour and a half, as institutions rebalance and as also a lot of these indexes rebalance as well. So this is actually a really decent day, but if you're kind of looking under the hood, you talked about a lot of these tech stocks that are doing pretty well, but the performance from Broadcom, I think I'm still keeping that one on the radar. That was the first telltale sign of a little bit of a pullback yesterday, going into the close, and it's still a little bit weak. It's up on the session, but still a little bit weak here, but there's a lot to factor in we had some economic data that was better than expected this week, outside of maybe some of the housing data that we have here today. And we may have a little bit of a relief rally, but usually that Santa Claus rally is the last 5 trading sessions of the year and the first 2 trading sessions of 2026, and that's what we have to kind of keep our eye out on. And I'm not also a fan of volatility trading at around a 15.5x. Seems a little bit low given the environment that we're in right now.
Okay, so KG just mentioned the triple witching. We've got more volume expected today. We've got trillions of dollars in on options that are set to expire. So, Tom, I got to ask you this question. With more volume, can we expect more volatility?
Not necessarily, but that does sometimes take place. You've got a lot of pivoting, a lot of open interest in this options expiration, $7.1 trillion as far as notional value that's expiring today across the board. That could add some additional volatility, but KG made a good point. I mean, the VIX is at 1530 right now. I mean, it's not reflective of anybody out there reaching maybe for some hedging, maybe for some protection. At this point, so I think a 2-day rally into the end of the week here kind of took away a little bit of the steam from potential volatility, but that might still reverse and start happening as we get later into the day and closer to the closing bell at this point. But I think it's the largest, I think, on notional value as far as expiration goes in history. So there might be some additional volatility in there, but I think when you see the market up a couple days in a row, that kind of takes away a little bit of the bite maybe from any potential volatility at this point.
Okay, so maybe not so volatile, but KG, what's your take on what to expect throughout today's session with triple witching happening? Okay, I think we got a little bit of a hit there with Kevin Green's audio there. So let's continue this conversation. Let's shift and talk Oracle. Oracle's got some gains today. You've got news around, this was first reported by Bloomberg, that TikTok's long-delayed separation from its Chinese parent company ByteDance is officially underway. So we've got shares of Oracle higher today. Tom, what's your take when you look across this one?
Yeah, this has been in the works for basically a year or so. The consortium of Oracle, MGX out of Abu Dhabi, and then Silver Lake also taking maybe a potential stake here. 45% I think they're going to own the U.S. assets. So this is probably a benefit for Oracle. Remember, the bar has been really low. This is basically a 1-day, 1-minute chart here on Oracle, but you look at a year chart, or even a 3-month, 4-month chart of Oracle, it's been volatile. The bar was really low on this one. This would definitely help them. I think in the long run, maybe having an interest in this this entity that's they're generating billions of dollars in advertising revenue, and get them away from the Chinese government at this point. It's not confirmed by the Chinese government, but at the same time, there was the CEO did say on social media that the joint venture is almost a done deal, maybe a week and a half. But this is definitely a win, I think, because remember, during the last administration, they wanted to get rid of it altogether and just ban TikTok. So people that use that platform, Diane, I'm sure it's going to be a benefit for them. You wonder if they start changing the algorithm or anything along those lines also. But yeah, I mean, it's come into fruition at this point. It's probably a benefit for Oracle, but I think there's other things out there in Oracle's world that investors are more concerned, but seeing a nice little relief rally here on the back of that news today.
I know there's so much concerns about Oracle and how it's funding its data centers, for instance, but obviously news around this TikTok situation is on the front burner today, even though for months it has been on the back burner. Let's get KG back in here for his thoughts on this one. So basically, for a while, TikTok's fate here was unclear, and they kept kind of kicking the can down the road. Now it seems like there's more progress. We've got Oracle in this group. We've got Silver Lake reportedly in this group as well. What's your take when you look across the shares of Oracle right now, up 7.5%?
Yeah, it's a relief valve here. Obviously, it's going to be a tailwind for them, especially the fact that they're going to be housing a lot of this data and really making sure that we are in compliance when it comes to this application. But I'm not sure if it's going to be a major driver moving forward for this name. Obviously, the headwinds when it comes to artificial intelligence, I think, is still front and center, especially when you're looking at the credit default swaps that continue to move to the upside on a day-by-day basis. You know, the only thing about Oracle that you have to be mindful of if you're a bear in this name is that obviously Larry Ellison has ties to this administration. So anytime that we do see any potential headwinds, especially when it comes to risk of artificial intelligence and their ability to sustain this data center build-out, you always have to think in the back of your mind that there could be maybe some further support from the administration in order to keep this one sustained. So it has been able to pull back here. Some buyers are stepping in, but I would still be a little bit cautious. A lot of the news items around this name has been, for the most part, very bearish, and that could take a lot of this premium out that we're seeing it at if we continue to get that news flow.
Okay, KG, I know we lost you before we got your thought on the expectations for how today will flow given triple witching. I want to get your thought on that before we get to the news items hitting Nike.
Yeah, I made one bearish comment, and it seems like the gods wanted to shut me down here. But look, at the end of the day, what actually does occur on today, we already had the AM expiration for the index options as well as the futures, and so we are now going to be focusing on the close. Usually the last hour and a half to hour of the day, that's when we start seeing volumes start to creep to the upside, and that's where you kind of look at that small cap and mid cap space, because a lot of those stocks, obviously their market cap is fairly low, and it doesn't take much to really move them, and so you probably will see a pretty decent reaction either to the upside or downside there, and then into the close. Once again, I would expect a little bit more volatility in this market. I just get a little bit concerned that we move up. It looks like everything's good and fine, and then you get somebody selling into strength. We've been seeing that pretty much every single session going into the close this week. I would not be surprised if today is the same one. I'm not saying that we go negative, but maybe we don't sustain at these current levels that we are at when it comes to the S&P 500 for today's session.
That's a good point, because yesterday we finished off the highs of the session, so great perspective there. All right, let's talk about this one, especially Tom, because yesterday we got into this about Nike, and I thought that you guys were beating up on it too much. Clearly I'm wrong. The Bears have their claws out. Shares of Nike on the back foot today, to borrow a term from our colleague Sam. Investors just seem to be fretting about this hit to margins. They heard the word tariff. They're obviously heading to the exits. You got to stumble in China. North America did look solid. It looked good. Tom, what's your take?
Well, initially when the report came out after the close yesterday, I was like, oh, okay, maybe investors couldn't get that sigh of relief there as EPS and revenue beat expectations, and they saw that North American sales were better than expected also. But then you throw in China, and it's, this turnaround, this win now strategy that Elliott Hill is trying to put into place is taking a lot longer, and this is probably based on the fact that you saw revenue decrease 17% out of China. That's 6 consecutive quarters of declining revenue in which used to be their growth area at this point. So then the hits keep on coming. They lowered their gross margins. They expect those to dip 175 to 225 basis points in the current quarter, including the holidays, which is typically a big area for them. But yeah, this turnaround strategy not working at this point. We talked about this with Mike Folio yesterday, and I kind of hinted on it. Wasn't bashing him, Diane, but I'm just not a Nike guy anymore, right? I'm old, right? But I go into those newer competitors, and I think they don't focus enough on the competitive nature in this space and getting out innovated. Remember, this win now strategy that Elliott Hill's trying to implement is supposed to reinvigorate some of their brands, increase awareness as far as running, getting back into their core, and it's just not working, and it's taking a lot longer than investors expected at this point. And then you throw on top of it, I always compare it to like Starbucks. It's a great brand, it's a well-known brand, but maybe execution issues here, and those are continuing because the turnaround's taking a lot longer than a lot of people expected at this point.
Yeah, and KG, I know you had some thoughts on this one, and obviously it's very, focused on the metrics here. And listen, I don't have a dog in the fight, but it's like nostalgia, I think, around it. I like Nike. I did I told Tom this. I bought something recently for my son from there. You got Steph Curry, who's a free agent. They need a Steph Curry shoe. What's your take when you look across Nike?
I just bought some, white on white Air Forces. It doesn't seem like it actually helped the shares out. But look, this is a stock that obviously is getting impacted because of margins as well as tariffs and competition within this space. Look, North America sales did pretty well, 9% growth on a year-over-year basis. But you also are potentially going to take up to around a 500 basis point hit on margins by the end of Q3. And so the top line growth that you're seeing with North American sales compared to the margin impact that you are seeing is just not adding up for potential growth here for this name, and which is why the stock is being hit to the downside. Now, they will need a little bit of a different strategy. Also kind of looking at the Converse brand, I'm not sure why they're still holding that within their portfolio. Continues to see deceleration in sales on a year-over-year basis at an aggressive pace. Now, it's a small portion of their portfolio, but it's just one example of something that has not been working, and it seems like they need to make a shift. So the stock's coming off here a tad bit. Once you kind of get back maybe another 5%, 6% to the downside, then maybe some buyers will try to step in here. This will be a tailwind type of trade once we do get a little bit more confirmation about Southeast Asia trade deals. I think this is going to be the big proxy for that. But right now, that's just not the case, and you have other competitors that are outperforming them, which is why you're seeing dollars kind of flowing into other names.
Yeah, indeed. All right, we'll see what Nike pulls out of its hat to try to compete with, say, Hoka, or the parent company of Hoka, obviously. All right, we got bull versus bear coming up. Guys, get their example trades put together for Apple. We will have more Fast Market after this break.
Dude. Okay. 5:30.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. Shares of Apple under mild pressure today. The stock is closer to the bottom of the leaderboard within the Mag 7 than the top. It still has a gain year to date. Some analysts have the view that will change in 2026. Morgan Stanley is more bullish, raising its price target this week on the iPhone maker to 315. That is up from 305. It's sitting around 278 right now. Fueling the conviction, the analyst believes Apple will be an AI leader come 2026 thanks to the coming Siri re-release in the spring. Keep in mind, stock nabbed a record high earlier this month. All right, let's gear up for the tug war on Apple. For that, let's welcome back in our co-host Tom White and Kevin Green today. It is bull versus bear time. Before we jump into the example trades, I want to get your thoughts, guys. Katie, let's start with you. Your thoughts on Apple.
Yeah, Apple's actually had a pretty decent run this year after a lot of the doubters kind of hit the stock because of their lack of exposure for artificial intelligence. But they have obviously rolled out a new phone. It seems like demand is actually pretty strong there, not only here in the United States, but also when you're looking at China, which could be a tailwind for them. And this is also a stock that's leveraged as maybe a lower beta trade or maybe a flight to quality trade anytime the AI story or AI narrative is challenged in this market. And if that's going to continue here, this could be a stock that continues to run to the upside. Last but not least, if you're kind of looking at it from a technical standpoint, on a seasonal basis, if you look at the last 10 years, generally next week, starting on the 22nd, Apple stock actually does rise to the upside. I think there's a lot more focus when it comes to consumer spending and the holiday season, and that could be a tailwind for this name. So I know that there's been a lot of concern around their lack of spending when it comes to artificial intelligence, but this is a company that has shown in the past that they kind of wait until it's the right time for them to integrate certain products and services within their platform, and instead of really kind of spending a lot of CapEx. I think they're going with the same strategy this time around, and I think they're going to be ultimately a winner over the long term when it comes to the AI trade, as well as this new sales cycle that we are seeing for iPhones.
Tom, Dan and I put out a note this morning with top 10 tech predictions for 2026. He believes that Apple and Google will announce a formal AI partnership around Gemini. He thinks that'll cement a real AI strategy for Apple. He thinks it will lead to a subscription service, and that will lead Apple to achieving he suggests we'll see a $5 trillion market cap. What do you take when you look across Apple?
Yeah, it makes sense. If his prediction comes true, just because they have the search partnership already built in between the two companies. That's, but KG made a good point. This is all about the iPhone 17, this new cycle. I don't know if you'd call it a super cycle, but sales improved last quarter, 6.1% from year-ago levels. That's the first time that we've seen some significant growth in iPhone sales in the last 3 years. So that's a benefit. And then in October sales of the iPhone 17 over in China, Apple captured 25% of market share due to that new phone, that new iteration doing well over there. So it's still 50% of the revenue. And we mentioned CapEx and Apple falling behind as far as the AI trade, right? Well, maybe they did need to be in it to begin with, especially if they have these partnerships. There was rumors that they were going to buy Perplexity also to kind of beef up their Siri release that's been delayed a couple times. But yeah, partnership in AI without spending the CapEx spend that all these other big Mac 7 names are spending, maybe that's going to end up being a big, massive benefit for Apple in the long run, especially if they do continue to work on partnerships without having to develop it themselves, because remember, they've lost a lot of AI talent across the board over the 6 to 9 months here, and they've gone to Meta and other tech companies at this point. So yeah, maybe the lack of spend might actually be a bonus for them.
Okay.
All right, let's get into the example trades. KG, let's start out with you. What's your approach today?
Yeah, so obviously kind of talking about the bullishness or the bullish environment that Apple could see over the next couple of weeks, I actually have a trade that is looking for upside potential. It's a combination trade. Just looking at buying a long call, and this is actually the January 2nd 270 call, and then on top of that, selling a put spread, looking at the December 26th 265, 262.5 put spread, selling the 265, buying the 262.5, doing this for a debit of $4.50 here. So what you would like to see is the stock obviously moving to the upside because it is primarily bullish, and what you're doing is taking in a little bit of credit in order to offset that debit in order to get some upside potential. And if the seasonality does kind of keep intact here, this could be a trade that does see some upside potential, but you do need to see a potential move. But this also has capped downside risk. Now, the potential max loss here could actually be up to $700, and that's if the stock is below 262.5 at the time of expiration of the short puts, as well as the long call at that time of that expiration here. Now, I will kind of set Tom up here for the bearish portion. If you're looking at a MACD and as well as the weekly chart for Apple, you have seen a little bit of a shooting star pattern, a doji candle last week, and this week potentially a hangman candle. All three of those are reversal candles, and the MACD looks like it's wants to hang. So this is a trade that's kind of focusing on the seasonality and looking for that sentiment trade, but it is kind of ignoring a little bit of the technical setup that is kind of showing itself and reflecting itself within the weekly chart.
Yeah, KG, look, we'll go through this custom trade because it's two different option series too, so you got to take that into consideration. But KG, as KG mentioned, max loss on this would be about $700, and that is the combination of the short put vertical, $2.50 wide, plus the debit that you're paying on this one. But let's break it down. January 2nd weekly options, so just a couple weeks till expiration here. Buy the 270 call, basically at the money. That's a bullish portion of this, and then against that, to offset some of the costs on the bullish purchase of that call, he's going to sell the December 26 weekly options that expire in 7 days. The 265 put, he sells that, buys the 262.5 strike put, short $2.50 wide put vertical that's neutral to bullish on this. As a package, you're paying roughly $450. It's probably trading closer to below $4 now because the stock has moved down a little bit since Kevin looked at this earlier. But the debit you pay is going to be the risk plus the difference between that short put vertical. So you've got to keep that in mind that, yeah, you'll have some risk down to that 265 level, and then it ramps up again if it goes through those down to the 262.5 price. Still risk defined on this, but it gives you a lot of upside exposure over the next basically 14 days until January 2nd weekly expiration. So aggressive bullish trade here that KG brought us. I'm going to flip the script. I'm going to do something a little bit more bearish on this one, but it's aggressive trade also. So I'm going to go out to the January 16th monthly options. It's going to avoid earnings. You're not going to get earnings until end of January, early February at this point, unconfirmed at this point. And I'm going to buy a put vertical. I'm going to buy the in-the-money 275 strike put KG, and against it to offset some of the costs on the that bull or bearish put purchase, we're going to sell the 260 strike put. So $15 wide bearish put vertical. You're paying roughly, I got a 510 debit on it. It's trading $550 now because, as I mentioned, the stock has gone lower. That expands the price of it. But you're buying that $5 in the money put, which has got that higher negative delta on there, and selling something that's out of the money by about $10 on this one. So KG, you're basically paying just over 1/3 the width of this bearish put vertical, and even if you pay that 550 debit or 510 debit, and it takes your break even down to just below 270 on this one, you don't need that big of a move on a percentage basis to get below that that level.
Exactly, it could actually kind of sustain around these levels as well, and this could be profitable as long as, once again, the stock is kind of moving to the downward direction. Now, what's also very kind of interesting with this trade, Tom, the 265 level is actually a key area of support for the stock. So even if it does go down to 265, this still would be a winner if it is able to trade at that level at the time of expiration. But you're right, when you're looking at that risk-reward strategy, as well as it being risk-defined, but you do need a little bit more of a move to the downside, and having it sustain that way is going to be very key for this name. And you're giving yourself a little bit more time. In the January monthly expiration here, you got about 4 weeks for this to really mature. And you could also look at potentially taking the trade off if it does go in your direction before the time of expiration if the market is available. So overall, this is a bearish trade nonetheless, but you're giving yourself a little bit more deltas, a little bit more movement to the downside here in order to make a profit. And that's really the trade setup with this name. Any type of massive reversal to the upside, though, Tom, you got to be mindful. You could see also premiums being crushed within the spread.
Yeah, and that was one of the key things, KG. You mentioned you got 4 weeks in this trade, but that gives you some flexibility as far as trade management goes because, hey, if you get the move you want down below maybe 265, 260, and this thing starts to expand, it gives you the opportunity if the market's open to close it ahead of time. If all or a portion of your trade. But then KG, I was also looking at the fact that, you know what, it's less than $1 below, the break-even's less than $1 below. IB percentile rank in Apple now down near the 4% level. So we're the bottom, basically 9/10 of where we've seen implied volatility levels. So that makes these verticals, when you're buying them, costless, right?
Cost a little bit less, yeah. And if we do see volatility expansion or IV spiking, and that IV spike is in relation to the stock moving to the downside, that could also accelerate profitability, at least in the near term. Any type of, once again, hiccup within the stock. So overall, once again, it's directional in nature. This is a stock, though, and I will just go back to the technicals, that we can see pullbacks, and sometimes they can be prolonged, but this seems like a solid uptrend. So this might be one of those trades, Tom, where if it goes in your direction, you got to make that decision as to what your profit loss is going to be, what your take profit target is going to be, and maybe readjusting the trade as you see fit. I don't know what your thoughts are on that one, but kind of holding a trade, especially a spread going into the monthly expiration for January, could get a little bit dicey. I'm not sure if you want to talk about some of the experience with that in the past.
Yeah, and that's the truth, KG, because you have 4 weeks and it's not going to fully expand to max profitability, even if it went down to 260, on Monday or Tuesday. So you've got some duration. That's what you start taking a look at as far as trade management goes, is, hey, how much profitability am I willing to take, with the thought that, hey, this stock could easily reverse and go higher again, sitting at a key level right here at the 50-day moving average also, which we haven't been below since August. So those are those trade management skills that you have to talk about, like if this thing expands to $7, do you start closing all or a portion of it, or if you really believe that's going to go below 260 over the next 4 weeks, maybe you keep it on. So yeah, those are decisions. But there you go, Diane, a bull bear debate in every form here from KG and I.
Absolutely, and you took us to school. Thank you guys, and our thanks to KG for pitch hitting today. We've got cash tags coming up. The team from Lightfolio will be along with new sentiment data on Royal Caribbean. And if there's still strength there, those shares are actually higher right now. They've been an outperformer this year in this sector. Stay right here on Schwab Network. Fast Market. We'll be right back.
Hi, I'm Alice.
I'm Dean.
And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Lattis, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall alongside Tom White in our Chicago studio. Time now for our hashtag segment. For that, we want to bring in our next guest, and that is Megan Brantley, Vice President of Research at Lightfolio. We are looking across the cruise liners today with Royal Caribbean in particular focus. Carnival out with its earnings today, and you saw, although it was mixed for the quarter, it was a strong year, and you've seen strength in Royal Caribbean as well. When you look across your data, what's the top takeaway? Megan?
Yeah, I think that Royal Caribbean is getting a little bit of a boost from that Carnival report. And when we look at our cruise data at large, we're seeing some solid momentum here. And I will note that this, from a seasonality perspective, isn't always when we see, the most traffic, the most demand. We typically start to see this more in February and March and April, what we classify as wave season, which is like that really popular booking season. So whenever you compare and look at Royal Caribbean versus peers, it sits nicely in the middle, and I think that this tracks whenever you look at its price point as well. It's kind of like the Goldilocks cruise. The price point is a bit below a Norwegian, it's a bit above a Carnival, and you can see demand sits right there as well. From a mind share perspective, Royal Caribbean and Carnival have a much higher consumer mind share versus the Norwegian that you see above. But I think that the Carnival report and overall reaction is a good omen for Royal Caribbean, which won't report here for about another month. They're delayed about a month on their schedule, and we see a slight overperformance, and I think a lot of this is driven mostly by just the premium brand that Royal Caribbean commands versus a Carnival, and also just that premium consumer, consumers who are willing to pay a little bit more for that perceived superior experience, for a little bit more exclusivity, and we're seeing that a bit in our data, but you can see there's not a huge separation there. So a nice report from Carnival for us is right in line with what we expect, and we actually see a little bit more strength out of Royal Caribbean. So this could be a nice play over the next month, especially ahead of earnings, as the market kind of reacts to the stronger than expected cruise industry at large.
Hey Megan, when you guys look at, I think everything's changed a little bit for some of these cruise lines is the consumer spending while on board and the other things that they have, whether it's private islands, stuff like that. Are you guys seeing good traction there? Because if you looked at the Carnival report, it wasn't that great because the stock initially went down, but then started spiking after the conference call and stuff, and booking trends continue to be better. RCL has the best balance sheet out of all of them at this point, so this kind of alleviates maybe some of the consternation because the stock has pulled back from recent highs. But are you guys seeing any trends in your data that says, hey, people are willing to get that all-inclusive, deal by buying, a spot on a cruise, but then the money that they're spending while on board continues to move higher, and that goes directly to higher margins, right?
Yeah, we're actually seeing increased app adoption on Royal Caribbean, and I think that really leads into what you're talking about in this on-cruise spend, because what consumers are doing is they're purchasing these packages before they ever set foot on the boat. So you can kind of get a better lead time into how that increased spend looks, and at least for us, that digital traction and that app traction is a solid indicator that consumers are still spending, they're still willing to splurge on that excursion or that drink package or that cabana. You can imagine all of these amenities, and part of that, the reason why Royal Caribbean we feel is so insulated versus other peers on kind of this upcharge effect is because its audience is typically comprised of a higher earning consumer. So, we talked a lot about the K-shaped economy and how, these higher earning consumers are more insulated and more able to continue spending at these higher levels, and that certainly benefits a name like a Royal Caribbean more versus a Carnival cruise line. I think that there's also an element of a bit of a trade down effect of potentially some consumers who are trading down to Carnival just for a more affordable value package, but at large, the core Royal Caribbean customer is even Royal Caribbean reported strength among its core consumer base, and that they expect to see spending continue to rise, though they did note last quarter that they don't expect it to rise by double digits, they just expect it to be strong. So I think any surprises here, any resilience or improvements in spending could be a nice surprise ahead of earnings.
Do you think, Megan, that the street may have been underestimating Royal Caribbean into like Carnival's results maybe in terms of the look ahead into 2026, fueling some of this momentum that we're seeing in Royal Caribbean today because they talk about how booked out they are into 2026 expectations. We may see the same from Royal Caribbean, especially when you think about how shares performed off the back of their last quarter, even though they had, they did better than expected, had pretty strong guidance, it seemed like, but the stock sold off. What's your thought about like what you're expecting to hear and see, or what you're seeing about sentiment around bookings for 2026 for Royal Caribbean?
We want to see strong signs of that forward-looking booking. So we have seen indications that consumers are booking a little bit closer to that departure date, so that cuts in a bit to our lead time that we like to have. Typically next quarter is when we're really looking at that peak season, that wave season, and you can kind of see that seasonality when you look at our demand chart. So we're going to be tracking this one really closely in the next month to be sure that Royal Caribbean can kind of keep up the pace that it's maintained thus far. We'll also be looking at those app mentions like Tom mentioned, just to try to get a gauge of how much consumers are upgrading their experience, if you will. But I think if you zoom out, if you look at where expectations sit for Royal Caribbean versus where expectations sit for Carnival, although Royal Caribbean stock, I think shares have pulled back about 20% from highs earlier this year. If you zoom back on like a 5-year basis, the stock is up almost 300%. Carnival in the same time frame up about 44%. A lot of this just has to do with just the fiscal responsibility and the underlying operations in Royal Caribbean. But we do see superior consumer sentiment, and for now an edge on those booking demands for Royal Caribbean. So definitely something to watch. We think that we could be setting up for a more resilient consumer than perhaps the market expects, and perhaps a better report than the market expects. But as you mentioned, even a nice report doesn't always translate into a stock pop immediately after earnings. So we'll have to take a look and see where the stock's trading before earnings and how demand shakes out. But right now, at least, things are looking really nice for Royal Caribbean.
Hey, Megan, real quick here before we let you go. They talk about, RCL's got the best, maybe balance sheet in here. It's a little bit more upscale, this K-shaped economy that everybody's talking about. And I see these videos from Carnival Cruises, and I just go, no way in heck am I going to go on one of those Carnival Cruises, because it's a different vibe. Is that starting to show up in any of your data where, this K-shaped economy might be supporting the higher end portion within this sector, which is RCL?
Yeah, we've seen that even in some premium retail brands that have reported of late. On Holdings is an example of one that we've tracked recently that has really benefited from that higher earning consumer in that K-shaped economy versus when you look at what Nike just reported. And so I think that this is certainly on the upper part of the K-shaped economy if you're looking at cruise lines, RCL falls. And so we would expect to see some overperformance here. We'll see how things play out. But if we start to see some underperformance, that could be troubling, but we aren't necessarily seeing major red flags right now.
All right, thank you, Megan. We'll leave our conversation there for today. That's Megan Brantley, Vice President of Research at Likefolio. All right, we're going to get into the trading perspective, all things Royal Caribbean. Tom, we got good insights from them. Royal Caribbean, especially when you think about the financials, you mentioned how strong their balance sheet. I definitely wouldn't underestimate their performance when you've got Jason Liberty at the helm of the company. He's the former CFO who took over that job. It'll be 4 years ago in January. He took it over in January 2022. So, you compare that balance sheet to that of Norwegian, to that of Carnival, much better. And again, they are considered the more premium compared to the other two. So I do think there is some strength to be seen there. But what's your final take before you get to the example trade?
This Megan mentioned it, nearly 20% pullback, before today's pop of about 3% on the back of Carnival's cruise line. So maybe that gives you opportunities. But as she mentioned, if you look at this thing in a longer term view, 5-10-year chart, it's gone up pretty significantly, probably reflective of the more affluent consumer, and then also the better balance sheet that they have. So I looked at a strategy. They report earnings on the 27th of January, so I want to avoid that, but maybe take advantage of some continued optimism in this name, especially after CCL beat expectations and raise their guidance moving forward. So I went out to the January monthly options here, 28 days to expiration, and just looked at a pretty straightforward bullish example here. January 16th, buy the 290 strike call. That's in the money by about $5. And then against it, sell the 320 call. So basically a $30 wide bullish call vertical that you're going to pay roughly. I got $12.50 debit on it. That's where it was trading earlier. The stock has come in from session highs. It's probably closer to $11.30. So you can get this actually cheaper now But the debt you pay, whether you pay $12.50 or $11.30, is going to be your risk. So $1,250 or $1,130 per spread on a $30 wide vertical. If you pay $12.50, it takes your break even just above 302 to the upside on this one. So on a percentage basis, not that big of a move needed. And one of the key things when looking at directionally biased verticals like this, IV percentile ranking, there is about 8%. So we're in the bottom 10% of where implied volatility levels have been over the last 52 weeks. And when you buy directional verticals like this is a bullish call vertical. If you bought a bearish put vertical, it's going to cost you less when implied volatility levels are lower on this one. So that's a benefit also. You still have that risk. You need the stock to move higher by at least $7 to get above that break even. But it's risk defined, you're directionally biased, you know exactly what your downside is going into a trade like this, Diane. But you know what, if you're bearish on RCL and you think it's going to continue to move lower, like it has over the last couple of months, then do the opposite. Do a put vertical to the downside. But I think one of the keys is you're avoiding earnings, but still giving yourself 4 weeks in this trade for it to develop.
We got a little bit of time in there. Thank you, Tom. And our thanks again to the Likefolio team for their data. We've got the breakdown coming up. We're taking a look at Alphabet Google. It's the outperformer among the Max 7 year to date at the top of the leaderboard. We'll be right back with that breakdown.
To the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an educator.
Well, I got a question.
It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Apple just had a sharp reversal.
Welcome back to that
It's cold.
Schwab Network of Diane King Hall. On for the big board. Before we get to the breakdown, let me give you a check of where the market stand as we get closer to the bottom of this hour. You still got gains on the board. The S&P 500 right now better by 0.8%. Dow's got a gain of more than 0.5%. NASDAQ 100 advancing about 1.25%. Russell 2000 has a gain of nearly 1% right now. Alphabet remains at the top of the leaderboard within the Max 7 year to date, and that is not changing today. The stock is higher at the moment. It is raising its price target on the Google parent company while maintaining an outperform rating. Among the key drivers, Wedbush expects AI monetization, continuing investment cycles, and agentic AI adoption. Bottom line, Webber sees Google as well positioned to continue its momentum into 2026. Time now for the breakdown. For that, let's welcome in George Silla, Senior Markets Correspondent, taking a look at Alphabet Google. George, this is also the time of year where you have all analysts, a bunch of analysts releasing their price targets and views on the sectors and looking at AI for the year. You see Alphabet Google on a lot of different lists, expected to continue its momentum. What's your take? What's the fundamental take on this one?
Well, I think, the fundamental take on Google is they're becoming so complete or more complete in the agentic AI space. And if you look at AI monetization rates, they're increasing substantially. 34% contribution rate last quarter is reported. Over $400 billion run rate per annum now. $100 billion last quarter, that was a record. And I think, and this is what we talked about with Google, and I mentioned this, probably over a year ago or close to a year ago, in terms of it being the most underappreciated name in the AI space, because everyone's really focused on ChatGPT, Microsoft, and of course NVIDIA is the architect or lead architect of the semiconductor stack within that ecosystem. But Google, was looked upon as maybe antiquated. But if you think about the nature of search, which again, you could make the case that they have a de facto monopoly in search, Google and of course YouTube being the two largest global search index engine, it really comes down to what AI utilizes. It utilizes an indexation of search. And Google has now integrated Gemini. They released Gemini 3, the third version. It's very powerful, especially in the programming realm, in the programming ecosystem, if you will. And again, they're essentially now vertically integrating their own search with their own program. And if you think about OpenAI too, and other platforms for artificial intelligence agents, they index search, they need search, and that's going on in the background. So Google was really underappreciated. Now it's playing catch up, being one of the better performers in the Mag 7 space. Profitability also, last year, 600 basis points higher than historical average, net income over 32%, profits, EBITDA growth over 20%. And valuation right now, not necessarily outlandish, it is trading at around 30 times forward earnings. Typically it's around 24 times, but the profitability is improving, top line sales improving. And I think the trends in terms of market share vertically integrated with, like I said, AI agents with their search, presents them as a formidable competitor in the AI race from a software and programming standpoint compared to ChatGPT. And the reason I'm looking at this in this context is because if you look at Oracle, and I'm using Oracle really as a proxy or a benchmark of challenges, they're very tied in with ChatGPT, OpenAI, and that's why we see weakness in Microsoft, Oracle, and Google is really playing market share catch-up, and they've done a phenomenal job.
Okay, yeah, and it's great. I'm glad you brought up the perspective of how Alphabet Google was perceived earlier this year versus how it's perceived now. It was almost like, I don't want to use the word circular because we kind of use that word for everything that's happening within the AI arms race and who's paying who's got what contract. So, the expectation that seems to be is that we'll see Alphabet Google, when I look through various analyst takes, that it will continue to be at the top of the ladder into 2026. Are you seeing similar things, or is there something that's across your radar that we might be missing?
If you look at just the technology integration, if you look at the core revenue base for Google, which is supportive, it's substantive, to essentially, propagate, if you will, their agentic AI technologies. Looking at it relatively speaking, OpenAI, because it's private, we really don't know what the revenue is, and I'm using Microsoft as a proxy for what's going on with OpenAI because they own a portion of that company. I'm looking at the relative performance of these names, and so again, I think Google has done an exceptional job, and I think this is why the market's rewarding it, of integrating its agentic AI technologies within the context of search, and it has such a large revenue base to support its ongoing capital investments, and that's why I think there's a possibility it just continues to lead from here.
All right, thank you, George. That is George Silla, Senior Markets Correspondent. Have a great weekend, George. Let's get Tom back in here for example trade purposes. So, Tom, you got the example trade in Alphabet Google. You've probably read through some of the views on Alphabet Google as we head into 2026. You know the performance already. What's the approach you're taking?
Yeah, I think if you take a look at it, the results basically from earnings have been supportive, as far as growth goes. They continue to, just hammer everybody as far as search. They own 90% share in there. They're not losing any of it from any of these AI models, and ChatGPT being one of them. Gemini 3 rolls out, and it just blows everybody away as far as the reviews goes. And they just released their new Gemini 3 model, Gemini 3 Flash, yesterday to add to that family in the Gemini 3 class. So outperformance at this point, and the integration that they're doing with their AI into their already established search business has been one of those reasons that you're seeing all these analysts raise their price targets, saying this is going to be their top pick over the next couple of years, as they're figuring out and monetizing AI a lot quicker than others within this space. They do have that CapEx spend that's been in the thorn of the side of a lot of these AI players, but if they keep on generating the returns on their investments the way that they have, that's why I think the optimism's back in the stock. But like I mentioned, stock's up 61% this year, just off of those all-time highs that we hit just a few weeks ago, down about 7% from those levels. So I looked at a strategy in here that's a little bit more passive, not as aggressive as some of the other trades we've talked about today. And this is still a bullish trade, as an example, but it's more passive, a little bit higher probability of success, but with that comes a little bit more risk. So going out to the January 16th monthly options, so 28 days to expiration. They don't have earnings until early February, so this will avoid earnings. And if you think that it's going to at least consolidate, maybe go higher, or you could be wrong and the stock goes lower, you still have a chance to be potentially profitable on this one. January 16th, sell it out of the money, 295 strike put, about $10 out of the money to the downside. And then against it, to make it risk defined, this is a high price stock, buy the 285 strike put to a short $10 wide neutral to bullish put vertical, collecting roughly about a 210 credit. The credit you collect is what you can profit on this trade, $210 with $790 in risk, but that's all the way below the 285 level. If you collect that 210 credit, Diane, takes your break even all the way down to 290 to the downside, and you've got a probability that that short strike at January expiration will be out of the money of about 67%. So high probability of success on this passive neutral to bullish example.
All right, good stuff. That is going to do it for us today on Fast Market. I'm Diane King Hall alongside Tom White. Our thanks again to Kevin Green for joining us today. Download the Schwab Network app. Visit the App Store and tune in 24/7 on schwabnetwork.com. Stick around. You've got Next Gen Investing coming up.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
On insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey Bob.
Hey Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I programmed that 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Live insights, actionable data, and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at SchwabNetwork.com.
Welcome to Next Gen Investing. I'm Jenny Horn, and we'll check out our markets here at the noon hour Central Time, of course, in Chicagoland. So we're seeing a pretty nice session to close out this week. Now actually sending shares of the S&P and NASDAQ higher on a week-to-date basis. Well, we do still see some overall week-to-date performance sluggishness from the Dow as well as the Russell, although modestly, that's actually now only down about 0.8% in the Russell, while say the NASDAQ's out in front on a week-to-date basis, now up about 0.5% this week. So a lot of enthusiasm that has been tied really to the back half of this trading week, as of course we close out the final full week of trading for the year. But joining me now to discuss some of the top movers definitely influencing hopefully some price performance to the upside in this market, Sam Badas, of course, host for the Schwab Network. And so, Sam, just want to get your broad thoughts here on this market, as I will say the tone definitely feels a lot different to close out than it did to start.
Yes.
Yeah, absolutely. I mean, we are seeing an extension of these gains we see yesterday off the back of cooler inflation, and of course also what we got from Micron, which sort of gave us the green light as far as the resumption of this tech rally. And so a lot of follow through we're seeing today, leadership back in focus, really taking this market higher, as you can see, propelling the NASDAQ to really the outperformer. We've got technology up over 1%. And you know, you have all your usual suspects back in the limelight here. I mean, you've got Nvidia up almost 4%, you've got Broadcom up 2.5%, you've got Oracle, of course, up over 7% on the back of that TikTok news as well. Chips are having a very good day. Look at AMD, you're up 6% there. You know, I'm looking across some of the Bitcoin-related stocks as well. You've got some really nice gains there. I mean, you know, particularly those in the business of the Bitcoin mining too. So across the board, we're seeing sort of more risk on when it comes to technology and sort of the more riskier assets as well. So as I said, a little bit more sort of follow through. Obviously, it's been a big story as far as some of the earnings reactions. I know we're going to dig into some of the individual names, but it's also been a day of higher yields as well. Obviously, we've got the BOJ, which is the Bank of Japan, which did hike rates overnight, and while the yen actually has weakened, which is a bit of an interesting move, not very typical, but that's got to do with the guidance coming from the governor of the central bank. We do actually have those sort of higher yields globally, keeping things in check here, so we are looking at the 10-year higher and sort of elevated as well, but that doesn't seem to be impacting stocks too much, as we do have, of course, as you mentioned, a really nice sort of rally here to cap off the week, some Friday share in what is the final full trading week of 2025. We made it, Jenny.
We made it. It has been a long week and lots of news to get through, but as you mentioned, some of these earnings movers that we're still seeing, I know we're very much at the tail end of this earnings season, but we'll start off with, unfortunately, what is a drag up today, especially on the Dow, and that's Nike, which is down over 10%. I will say the margin outlook does at least show some quarterly improvement, Sam, but that is really as optimistic as it gets, because I know that the fears have been surrounding all things China, as well as still some North America weakness.
Yeah, it's been an interesting report out from Nike. Obviously, this has been an underperformer. Everybody's wanting to see more updates on this turnaround strategy. You know, this is a big ship to turn around, and that was really what we heard from some of the commentary. But look at the
big ship.
As you say, one of the underperformers on the session, broadly speaking. So we're down 10% right now on Nike shares. It is up to low, suffice to say. It wasn't all bad. Let me just run you through the quarter. Earnings per share, 53 cents. This is about 38 cents, which was expected on revenues of $12.43 billion. $12.22 billion was the street estimates here. So as far as the quarter, it was actually a beat, but really it is the concerns around China that seems to be what is behind the price action we're seeing today. The investor worries, which is leading to how people are feeling about this company moving forward with respect to obviously that market coming off. That has really been a bright spot. Yes, okay, we did see some more strength in the North America market, which did help offset some of that weakness. That was up actually 9%, while Greater China was down 17%. But this is still a bit of a concern here for this company, given that this has been a very strong market. This has been a market where they have very much seen sales that have managed to offset some of the weakness in other parts, but it's the margin pressure very much that seems to be the big story for this company and what investors are focusing on right now, because they are absorbing tariffs and they're also clearing all of that inventory as well. So while you might see a bright spot in the North American market managing to offset the Chinese market, you're still getting those products which are coming in which they're having to pay the higher tariff costs on. So you need to keep that in mind as well. Also guided to the fact that margins may continue to get hit. So, this is really how they see things in the future as well. So it's the margin compression story that seems to be what is moving the stock to the downside today. Interesting though, Jenny, if you take a look at what the analysts are saying, there still seems to be some optimism here. Bernstein has reduced the price target to 85 from 90, keeping an outperform rating, however, on the shares. They've acknowledged the beat, but still saying that the company has a long way to go as far as the turnaround. And BSA also bringing the price target down to 73 from 84, but they still kept a buy rating here. They are talking about the margin compression too, so it's not all that bad. But it is hurting other athleisure names. Very interesting if you take a look at the European session, which obviously was the first to react to this. Yesterday you saw Puma and Adidas down, and also you're seeing today Lululemon and On Holding getting dragged down low, sort of in sympathy. But obviously this is a turnaround story happening over at Nike, where they have focus. This is a point that one of the analysts made earlier today that I heard, where they have put their focus, they are seeing some success. So I thought that was really interesting, particularly around wholesale. This is a business that they actually pulled back from, they shifted away from, but have got back into. So they have seen a little bit of an improvement there, but it's just not enough, Jenny, to offset some of the China weakness and concerns around that, and also, of course, this margin compression.
I know, I thought the direct-to-consumer business contracting was interesting. It's such a shift from the business model we knew just years ago. They were our DTC king, and they sense straight away a bit in that strategy, which actually was a great bright spot of that earnings report. But another name seeing some weakness on the heels of its earnings was Conagra Brands, which, just to break down some of their segment performance, which I thought was so interesting, grocery and snacks, those sales decreased 8.5%. We did see refrigeration and frozen that also declined 6.5%. International also slumped roughly 5.5%, and their food service segment, another 1.3% contraction year over year. So that does not paint a super positive picture, but I will say that we're down about 2.2% today. It's actually not a bloodbath by any means, given the fact that there was not a lot to be enthusiastic about regarding their outlook either.
No, as you say, you pointed out some really good metrics there as far as, what seems to be the worry here. We're seeing the stock down as really a reflection of some of the concerns that you just highlighted with those numbers. Just generally around sales and the macro environment, the challenge here, the market pressures that they are facing as well. I did also see that reported a net loss of $63.6 million in that fiscal second quarter due to some non-cash impairment charges as well. It was a bit of a mixed quarter here, but they are facing some challenges here. We know that, of course, the consumer is value hungry right now. They are tightening their belts. The CEO even acknowledged that budgets are constrained right now, coming from households, particularly the lower low-end, low-income consumers as well. Retailers have also been pulling back on their orders, and they have also cited the government shutdown as, part of the reason behind that too. That perhaps reflects some of the lack of visibility we had around that period of time, which of course this quarter is capturing too. They talked about how things were actually impacted too because of the SNAP payments which were stopped. So, obviously we're seeing some sort of material impact here in these earnings, or at least the commentary with respect to what happened there with that government shutdown. But they do, interestingly, sort of maintain market share in some of those single-serve meals as well. Now, just as a bit of a bright spot, you could say, they do expect things to get better in the second half of the fiscal year, and that is thanks to some of the new products that they are launching and more merchandising as well. But once again, it's another case of where, some of the things that they are saying that might be a bit more optimistic is not enough to offset some of the challenges that they've been facing and what they highlighted this quarter, particularly around the consumer, which we know has been impacting other brands as well, Jenny.
And we know for a lot of these staples, yes, it's not been a Conagra-specific story. The pricing environment does still remain fairly difficult to navigate. And they do, I liked that they gave the encouraging guide for the second half of their fiscal year, but I think that we need to see it evidenced as consumers at these grocery stores, which it is still very expensive, and I'm not sure that will change anytime soon. But our next thing today is FedEx. And FedEx is a very different story, frankly, and I covered it during market, because now we're actually higher. So modestly, and I say this cautiously because we're basically unchanged. But hey, shrugging off earlier losses on raising now their fiscal 2026 outlook. Very mixed bag from FedEx this quarter, but definitely, I think, encouragingly, we've seen dip buying, obviously, of interest today, and a lot of the enthusiasm has really revamped as we were set to open lower, and now we're at least slightly higher.
Yeah, I wonder if some of the reflection coming through from the stock as far as, coming off the lows, as you mentioned, is to do with what we're hearing from the sell-side community as well. I mean, while there is some caution, as you say, a bit of a mixed quarter here, a mixed bag as far as the earnings were concerned. I mean,
mixed quarter.
Mind the quarter. I mean, I was looking across some of the notes today. I mean, JP Morgan looking at 294 now from 285. We're currently trading at 286 and change right now. Citi is now looking at $327 from 310. You've got Evercore ISI at 288 from 275, and then TD Cowen 313 from 271. So some of the reasons behind some of the price target moves have actually been around analysts seeing pricing power moving forward, and also improving operations in Europe, which has typically been a bit of a weaker spot. So I thought that was a really interesting takeaway, and as you say, off the session's lows now, but teetering around the line at the moment. But I think that's just a reflective, as I say, of the mixed quarter that we saw. Some of what had been weighing on the stock earlier, or at least perhaps continues to do so, right, sort of capping some upside here. I heard that some of the pressure might be coming from the guidance, particularly around the freight division specifically, and maybe the negative impact from grounding a specific fleet of planes there. But yes, I think, as another analyst actually pointed out, which I saw too, was that the problem with the strong quarter was that the updated guidance here actually implies now second half operating profit will be about 5% lower than the roughly $3.2 billion that Wall Street was projecting. So I think there's a few sort of mixed reads within this. Obviously, we know that this is a company that has dealt with a lot of the tariff impacts. I mean, as far as not having any visibility sort of in the middle of the year, and then reinstating that guidance. I mean, this really is a bellwether stock, Jenny. I mean, it is a barometer of the global economy. I mean, you're talking supply chains, you're talking about small business, medium-sized businesses. I mean, just how consumers are feeling, the geopolitics and the tariffs as well. So, yeah, I think, obviously there seems to be some to like in this, maybe some not to like, but it looks like at least things seem to be improving. And they very much put down the performance that they saw to the cost reductions, which has been a big focus of the street, and then also the increased shipping volumes, which is something actually we've heard across the board. It looks like there's some resilience in the face of the tariffs and the pessimism that we were talking about earlier this year.
I mean, absolutely. If there's any barometer of shipping health, it is my apartment building, which the lobby is overflowing with packages right now, although mostly Amazon, I will say, which perhaps is what is also driving some of these sluggishness with FedEx. But encouraging to definitely see that we've turned around pretty substantially just in today's session alone. Unfortunately, what has not been a turnaround story has been KVH, as they also saw some earnings disappointment. I mean, I saw margin pressure highlighted as well as build to order was highly in focus amid these slower home sales. And so the tone isn't a new one, frankly. We've talked about it a lot with the other home builders, Toll Brothers recently. But KB Home, the one thing I think is important to note is the home builders are not all created equal. KBH is one of the smallest by market cap, so not to say that, you know, the 8.7% move to the downside is something to write off, but this is a significantly smaller home builder than, say, the behemoth that is D.R. Horton.
Yeah, you raised a very good point. It also has exposure, of course, to the first home buyers market too. So I think that's important to keep in mind as a sort of differentiator here. But, you know, it's been a really, really tough old year for a lot of these companies in this business. I mean, just because, of course, the general trend has been one that the housing market hasn't turned around as much as maybe some had hoped, particularly when you've got, you know, 3 interest rate cuts in the system, which many had expected would help people come off the sidelines. But it just really hasn't been the case here. Interesting though with this report though, Jenny, I would say it wasn't an earnings beat and a revenue beat, but the market reaction has been somewhat very pessimistic, and that comes as, you know, obviously to your point, you know, a bit of a cautious outlook and, you know, ongoing concerns around just sort of general market conditions at the moment, you know, about affordability. There's that word that keeps popping up over and over again. It's interesting, I was actually talking to a guest on Market on Close a couple of days ago. I think it was from the conference board. It was an economist who was talking about the age of the first home buyer has gone from the sort of mid-30s now to 40 or something since pre-COVID days. So I thought that was really interesting as well. But yeah, the CEO still sees things as challenging. Elevated mortgage rates, affordability challenges, you know, the housing conditions remain challenging due to low consumer confidence. So I think, you know, all in all, this is a situation and a challenge and a headwind that all these home builders are facing. I mean, we've heard it from Lennar and, you know, Toll Brothers, the others in this business too. So you're feeling it across the board. It's the incentives that's now obviously a story of margin pressure as well. That's something that the street has been very focused on. You know, the price drops that they have used to try to incentivize those home buyers to step into the market, that is going to become, you know, an issue for profits that chip away at some of those margins. And then another story that I think is really interesting to watch with some of these home builders as well, Jenny, is just commodities prices. You know, everyone's talking about this commodities bull market going into 2026. I mean, we've already seen these skyrocketing prices for things like copper, aluminum, silver, etc. this year. Something that a lot of economists have been pointing out, and people out there in the industry, is that, you know, this could become a margin problem as well. So it could be a bit of a double whammy for some of these home builders if those higher input prices start to translate into how much it costs to build a home and then how much it costs to buy a home. So that's just something to think about and a bit of food for thought when you're thinking about some of these names.
Really good point as well, and frankly, it's been widespread. It hasn't been necessarily specific to like the first-time home builders, the more affordable home builders, or even the high-end, where we talk a lot about the K-shaped economy. But frankly, as far as just broader home builders, it's still all of the pricing pressures, the affordability concerns, and the lack of buying right now. Is that deferral mindset seems to still weigh on sentiment. So really great insight into all of these earnings movers that we had to parse through today. Sam Vadas, of course, host for the Schwab Network. Now coming up next, it's time to dive into some charts and example trades. We'll be joined by our chart master to break down the nice, actually upside swings we are seeing in NVIDIA and Oracle to close the week on a brighter spot.
connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can manage for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl?
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time for the Chart Master, and today we are talking about two of our behemoths in the broader world of AI and tech. Now, Oracle with the big pop today to close out the week actually on a pretty bright spot, as well as NVIDIA we'll be diving into. But Rick Ducat, our chart master, is here for the technical and trade setup help. And so Oracle, of course, part of this TikTok deal. I think that the bigger story with Oracle has been a lot of its spending concerns and its ability to monetize AI, but shrugging off at least some of those fears today with an 8.2% move to the upside.
Yes, there's still quite a bit of work to do to recapture those old highs that we saw shortly after our previous earnings event in September, hitting those highs 345.72. But typically I look at 1 year charts in this segment here. In this case, I put it back to 2 years here because there's some important old highs that I wanted to focus on here. First, there's our darker green line here. That was the low point before a gap down, a subsequent high point, and then a breakout point. If you were to go even further back, it was where we found support as well. Now we've fluctuated around that area, but look as well, 179, our lighter green line back here, notable old high, low point after a gap up, high point after a gap down, resistance, etc. So that's where we bottomed out here. So we had a 10-point range of about 179 to 189 that seems to have been a long-term supportive area that has thus far held on. We have not yet taken out our old recent relative highs here near 202 from just like about a week or two ago, but we have not filled the gap either yet. 217, old highs, subsequent lows, and then gap level right here at our pink line there. That's another notable upside area to keep an eye on here. But our narrow, tight, downward sloping channel in blue has been broken at this point pretty convincingly here now, so that may not be really too relevant to watch going forward. The shorter term price pattern, though, is a falling wedge type shape here that we have broken out through to the upside from. So now these horizontal levels may be a bit more important to consider. We can see that our RSI study, we are out of the oversold area, that threshold below 30. So that would be more of a bullish signal here, the crossover from that extreme low momentum area here now, but we still would want to see a crossover above the 50 midline if you did have a more bullish outlook in that this particular stock here. Finally, when we look at our volume profile study, you can see there's some pretty distinct nodes here, some spikes in this blue histogram on the right side of the screen. That's our volume profile study. So the areas that stand out for volume activity, 189 right here, around 202, and around 217. So lining up very closely with our horizontal areas that we mentioned before in this segment here. So those really stand out not only from a price perspective, but also from the trading activity that we found at these areas.
Okay, yeah, and Oracle, of course, I mean, an 8% move is a pretty substantial repricing to the upside, so that's encouraging, but doesn't do a whole lot to revise the over 40% pullback we have seen since it's, I mean, one of the best days, I believe it was the best day on record, surging 36% after it's now 2 earnings reports ago. So it's been a bit of a different story for Oracle in the latter part of this year, but as you think through now trading Oracle for example purposes, given all of the information we have, walk us through your thinking.
Okay, so the thinking leaving behind our two trades today in these two tech companies. We're going to go for bullish example trades, and both this one will be the one that's a little bit more conservative and more high probability with less potential rewards. So the trading question, +1 February 20th, 200, 220, 230 strike, call butterfly at a 425 debit here. So this would be a bullish trade, obviously, 63 days out till expiration here. Max loss would be that debit paid 425, max profit 1,575. So a bit worse than the 1 to 3 risk reward ratio that we commonly look for here. But really though, that's kind of a bit misleading because we have this long flat area. If we get above 230, we maintain profitability here. Our sweet spot is near 220. That's our short strikes that we're selling to those 220 calls that would be making a butterfly here. So we can also see that if we did look at why we chose those strikes, that 200 level to the upside, that's where the significant volume node came in. It was near those recent highs, so we'd be looking for a breakout above that point. Then 220 to 230 is where the volume drops off, and it's also where we find the edge of that expected move range for that option expiration month. So if you're going to pick a point for price activity to stop, you can think about that as a way to get started here.
Okay, now to shift gears into another name in the broader AI world, a bit bigger of a company, that is NVIDIA, which is up about 3.3% today. And also, sentiment for this name has hugely improved even just this week, as Micron earnings was a pretty nice catalyst for NVIDIA here. So a lot of pessimism about some of the pullback in shares. I know we're off of highs, but at least ending this week on a bright spot.
Yes, Micron said demand far exceeding its ability to supply the chips and memory storage here, so it seems pretty interesting for NVIDIA as well. When we look at our price activity here, downward sloping trend line in this case is looking like we are breaking out to the upside from that area here. You can see connecting our highs from those all-time highs near 212.19. Notice as well to the downside near 171 or so, we held on to this area, our darker green line here that we found recent lows at. We held on once again. If we were to even move below that point though, 165 also stands out as potentially supportive based on another pre-gap high point and subsequent lows there and there. So now we are
NVIDIA. Descending flag. Almost a fallen wedge.
Out to the upside. Some people might argue that you should.
I ain't gonna argue with you
here though, because this was where we had gap up after earnings. Things kind of got a reset. In this case though, you could draw it going across these highs for our white line. By that measure, we haven't really broken out quite yet here. Notice also RSI still trending downward and still below the 50 midline. So kind of a question mark in terms of depending on how you look at it, whether this breakout has actually materialized yet, or if it's still kind of just a potential breakout that hasn't fully developed. We can also see that our volume profile point of control, our heaviest trading area of all, is right near these other indicators that we mentioned. That comes in near 180. So a move
we kind of have broke out
178 or so, 177. That would be we would be starting to get out of the heavy trading area, and we would be keeping our eyes perhaps on our supportive zone there, 165 to 171 or so.
Okay, and I think that you made a really good point, and that's the fact that it's probably too soon to make any calls of like major directional shifts, but at least ending this week on a nice spot in today's session, I mean, 3.25%. So thinking through now trading NVIDIA, of course, for example purposes, I mean, this name has a lot riding on it into the next year, but all that to be said, walk us through your thinking. I know you mentioned some
it's definitely a fallen wedge.
Yeah, so if you were kind of thinking more of a speculative trade, thinking that the breakout will materialize beyond these early potential changes here, this would be perhaps a bit more of an aggressive trade. +1 February 20th, 190, 210 call vertical at a 480 debit here. So once again, we can see that we are focusing on that February 20th expiration, 63 days out. In this case, 480 is our max loss, our debit paid here in this risk-defined trade. Meanwhile, our max profit would be 1520. So we're closer to that 1 to 3 risk-reward ratio here that traders commonly look for. Why did we choose these strikes once again here? Well, 190, the recent highs above 188, as I said, would be the mark that traders would be looking for a potential breakout. And then the 210 short strike here that caps off our profits. Well, 212 is those all-time highs. 204 is the upper edge of the expected move range according to the options market here. So once again, that seems like a place, if you were going to choose a point for the move to stop, that might be where you might start looking here. So break even, 8.2% to the upside, expected move range, 13.5% here. So well within that possible potential move.
Yeah, and this day is definitely helping the overall markets as well, that we're seeing a nice session, of course, to close out this week. But appreciate it to Rick Ducat for all of the technical and example trade help today. Coming up next, though, we'll discuss the move to the upside we are seeing in CoreWeave. Shares are now up over 21%, so we'll discuss more what's driving this pretty phenomenal session coming up next.
Well, what a week.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets.
We're getting ready to squeeze any minute.
At N Petalides.
Any minute, and that's 10 minutes.
On LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms.
That is
Bring your
true.
trades into focus on Thinkorswim desktop. Tailor the platforms to your unique needs.
Mine looks like that.
And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the
The
Schwab
video.
Network app and get live coverage wherever you are.
Hey, Dad, I have a question for
Oh,
you.
God.
Sure. When did
No.
your dad first start investing?
Granddad had an account with Schwab before there were branches in the area. We really started.
Granddad. Okay, well. Bob was having a good day for China. Bye-bye. Well. I'm gonna have to clean up my chart. Yeah, it's got too much crap on it. Cleaned up. Oh, God, I can't see it. Pullback looks very obvious. What's going on here?
viewers only on Schwab Network. Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl?
Schwab, a modern approach to wealth management.
Welcome back to Next Gen Investing. It's now time to discuss Lyft, which is down about 3.7% today on the back of some analyst news that was a bit downbeat. So joining us now is Dan King Hall, the host of Morning Movers. David, I say downbeat, it was definitely downbeat. It was a downgrade at that. But walk us through this note from Wedbush.
Absolutely, Lyft is not getting a lift today. This coming after a sell-side
YFT.
less constructive on this one, at least when it comes to Wedbush. Wedbush has downgraded it to underperform from neutral, so they've moved, before they were just in a holding pattern, their view on this one for Lyft, but now they've moved off the sidelines. They've cut their price target to 16, that's down from 20. So you are again seeing some pressure on Lyft today. Lyft down, as you mentioned, 3 3/4%. And year to date, though, Lyft has had a strong run. So maybe part of that has to do with their performance as well, along with Uber. Both of those have actually outperformed the S&P 500 so far this year. But the firm is warning that 2026 could mark a turning point for ride sharing. You'll recall before this past year, there was pressure around these around the
I can see it going to 16.
to autonomous vehicles, but they turned the corner on that this year. Again, both Lyft and Uber outperforming the S&P 500. They do think near-term financial impact will be limited because there's going to be take some time to roll out all of the autonomous vehicle fleets. We've seen a lot of testing on that front, but Wedbush says Lyft is the most exposed to AV disruption because of its heavy reliance on the ride-sharing market. Because Uber obviously has more diversified mobility with regard to they're moving not just people, they're moving food as well. And Lyft doesn't have that. They're simply in the mobility business around moving us. The analyst saying that AV operators, autonomous vehicle operators, may favor first-party applications, so that reduces the role or the opportunity for Lyft in the longer term. And Wedbush thinks the market is underestimating the negative impact from this with regard to the valuation for Lyft. So today, Wedbush essentially saying they're out on this one. Jenny?
Yeah, and I think
Okay,
so many great points, and also
we're coming up to the 200 on the SPX.
Market, which is kind of amazing considering the pretty substantial repricing we've seen towards the back half of this year. But both Uber and Lyft have actually had, all things considered, pretty strong years. When you zoom out, look at the long-term picture. But appreciate that, Dan King Hall, host of Morning Movers. Now to focus, though, our gears here on college playoffs and some of the monetization efforts we are seeing in the world of sports. I'd like to welcome in Stephen Olenek, chair of the sports and entertainment practice at Mintz. So, Stephen, thank you so much for joining us on this Friday. We know that college football is really now in full swing. The playoffs kick off tonight with the NIL exploding in just the past few years. How are athletes and even coaches now cashing in?
Every single person is trying to cash in right now with the transfer portal being up January 2nd to the 16th. Every single college athlete has the ability to transfer potentially if they've transferred already. But let's be clear, the college football playoffs are starting tonight. Jenny, do you actually think anyone's going to beat the Ohio State University? I mean, let's be honest. I mean, it's everyone's playing for a participation trophy right now. But
I didn't say
if we're
Bush.
just being talking strictly about NIL, yeah, you're going to see a lot of the elite student athletes try to convert and potentially get more money in the transfer portal, depending on the situation.
Okay, I will say I'm an Indiana hater, so I'm actually supporting the Ohio State narrative right now. So
Come on, everyone's going for second place.
I know.
What are we doing?
Maybe the one time I'll say.
Okay, sports. You got to hold this support, though.
We potentially need to have that competitive advantage or be put in a position to have a competitive advantage. So what do we have to do? We have to go look to find some capital.
Okay, and outside of these booster collectives that we hear so much about, what really do you see as key drivers for the overall future of the NIL?
Yeah, I mean, like, if you're investing a private capital source, private equity looking in, you're looking at where's the cash flows, right? The ticket sales, the media rights deal, events potentially that you can have. For specifics tied to the athlete, a lot of these guys, as you can imagine, what's going to give me the best opportunity not only to succeed, to showcase my skills and ability to potentially play in the NFL or other respective leagues, or where can I potentially get the opportunity where I can maximize the most money on top of what the school can give me, on top of what a collective or other ancillary opportunities tied to sports marketing opportunities.
Okay, and is there any type of world in which this money might be capped, or we will see prices for these athletes just continue to rise? I mean, do you see any cap being implemented in the near to maybe midterm?
I mean, I think, that's a great question. I think in terms of the cap, I mean, right now it's kind of the wild, wild west. People are looking for, in a lot of the players and the student athletes, they're looking for the best opportunities to succeed. But, like anything, like back in the day, it used to be, how is that money distributed? Was it through the back door, potentially, with these programs? Now it's through the front door because they get the allocation of money from the house settlement on top of what the collectives and other sources that they can get.
Okay, in the broader media landscape, I mean, I know that a lot of this has shifted some of these major media partnerships, but does this then, I mean, just make this overall space so expensive? Because I do know this has also been, then, I mean, specifically more with the NFL, but it's made a lot of the viewership a lot more expensive because there's so much money to be had in these spaces now.
Oh, it's ton. But if you can see, like how I introed in terms of the, in terms of these, like, the conferences, the Big Ten, the SEC, and then the ACC, and then the Big 12, and then everyone else. So in terms of the competition, in terms of the budgets, in terms of the collectives, in terms of the donors, if you bring capital sources or private equity into college sports, what's going to happen with the donors? Oftentimes the one advantage that college sports has at anything, especially with football, basketball, it's a live sport event. Everyone has that affinity, that camaraderie, it's that loyalty tied to their school. Being from the great state of Ohio, what do I look for on every Saturday? We want to see championships, the Ohio State University. So you have enough people like myself and a lot of donors and a lot of people that would want to see the football team win that second championship. So you want to try to compete. But then you start bringing in the private capital. It's like, how are you going to be able to differentiate across all the tables in terms of the program, but also how are you going to have to be able to compete against those select few teams that oftentimes spend the most money?
Okay, that's exactly what I was going to ask you. Does this create then any degree of like alienation of, say, the rest of the schools? And there's, I mean, we could all think of like basically the legacy names in football. I mean, it's your Alabama, your Ohio State, Michigan, etc. Notre Dame, fine, maybe I'll add to that list. But does that then, put these up on a pedestal where it's very difficult to get this funding when you're, say, a smaller school that just doesn't have the same notoriety in your program?
Yeah, that's right. And especially it's for the schools that literally need the money, right? If you don't have an elite
Right off the 200
that generates tons of money, where do you go? The next alternative would be, well, do you have an elite basketball program? And if you don't have an elite basketball program, you're probably looking at what can we do to try to compete, i.e. try to get some alternative capital in the door to build the facilities, to build the camaraderie, to build the infrastructure, to try to compete, to recruit, to get those select student athletes that could potentially be game changers for the select programs.
Yeah, and I think a great point there and a good place to leave it. And I do remember, if I recall, that you were an Eagles fan, so I will give a go Birds in your honor. But
I know. We got Birds, we got Ohio State. Look, where are we going? Where are we going? I mean, I'm from Ohio, so Cleveland, so it's the Browns. I'm looking for Myles Garrett to win that sack leader and become the all-time great.
Myles Garrett is probably the only reason I watch the Browns, but a really great conversation today, and I so appreciate your time. And we're like the pinnacle of sports viewership right now, so really timely conversation. Appreciate it, Steve Olenek, chair of the sports and entertainment practice at Mintz. Now, coming up next, last but not least, it's time for Under 30. Today, we are looking at Carnival on a bright spot today. We are up almost 9% in the stock today.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on SchwabNetwork.com.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network. Stay connected to the markets with Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services.
Schwab Network, available anytime, anywhere, on any device for free. Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
That's exactly what it is.
I'm Nicole Pedalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Very good.
Welcome back to Next Gen Investing. It's now time for Under 30. Today we are talking Carnival on a bright spot as we're up nearly 9% on the session. So here to bring us some more insight on what's driving that upside is George Tillis, Senior Markets Correspondent for the network. So George, I will say that the month of December has been very favorable to these cruise lines. We're up now almost 20% on a month-to-date basis. So walk us through what's driving some of this revamped optimism in the cruise line space.
Yeah. No, I'll just quickly add to that, Jen. I think it's an important point. Seasonality speaks to some nice price action across the board in the transportation space. Typically, cruise liners and airliners, just to give you another context here, do well in the back half. In other words, the back quarter of the year, but also at the beginning of the year. So I think that speaks to why we're seeing additional movement in this space. But Carnival, we've talked about is one of the larger players in the space alongside Norwegian, Royal Caribbean. It's actually
Yeah, I missed a good shot on AMD.
One of the things about it, we've talked about this quite a bit when we cover it, has been the balance sheet issue, which is improving. And I think that speaks to why the stock is higher today, not to mention the earnings per share they posted actually came in quite a bit higher than the estimates. They were expecting essentially a 75% increase year over year to 25 cents, but they beat that number coming in around 34 cents, and that was more than double last year's 14-cent print. And
that's a nice run.
40 million shy of estimates. We're still higher to $6.3 billion, about 6.6% year over year. But the company denoted some improving internals. And one of the things I noticed too is if you look at the year over year passenger carry, it was actually flat. Occupancy rates are now 102% because they're essentially adding more group bookings to existing cabins. That's a good sign. It gives you an idea that they're generating higher price per fixed unit or fixed cabin. The other thing is the debt position. This is what they talked about. I think it's important, so that's why I brought it up as well, is the debt actually decreased 7% year over year to $24 billion. And I went back and looked just a few years ago to 2023, starting for that year, 2023, so almost 3 years, it was around $32 billion. So the number has improved by 25%. And with that said, profitability is improving, debt conditions are waning. It's still quite a bit relative to the market cap, but nonetheless, it's improving. And they also demonstrated the ability to now reinstate their dividend. And so that's very favorable, especially for, let's say, institutions like pension funds, which have in their charter ownership clauses that they can't own anything that doesn't pay a dividend. So that opens the door for institutional acquisition of further shares for Carnival. So all looks like it's working out for Carnival, and the price action reflects that.
Yeah, I think that is such a good point as well, especially in regards to that dividend, of course, being reinstated, which is hugely just positive and shows, I think, a different Carnival than we were discussing at, say, the beginning of this year and post-pandemic and post all of the debt that it really took on. But as far as the overall really appetite for travel, you mentioned that historically this month is strong across the board. Even some of these hotel chains are up modestly, but I mean, collectively, we're seeing strength in the space. And Carnival has exposure to, I think, a wide variety of consumers, various income levels. And so does that then bode well, or is that actually a bit more of a weak spot? Because we talk a lot about the K-shaped economy, but this is a company that has just that wide exposure to every type of vacationer.
They do, and you can also make the case that Las Vegas used to have a wide exposure to various consumers, high and low end. Look what's been going on in that city. They've actually increased prices across the board. There's a lot of availability, but the elasticity of demand is very high. So the point I'm trying to make is that airlines, cruise liners, tourist travel, they've actually, in this case, for tourism and travel like Carnival or the airlines, capacity is remaining very tight. And so therefore prices are offsetting that lower capacity so that they're actually making more money. In terms of profit based on the elasticity of demand. That's really what's going on here, and that's why airlines are doing well in cruise liners. So Carnival is maybe generating more operating leverage because of the fact that they have that additional debt load that is being worked out. But nonetheless, it's a great situation for a company which is still down from 5 years ago, but nonetheless is improving significantly.
Yeah, and I think great takeaways there, especially at the improving debt levels, which has been, I mean, just unfortunately weighing on any sort of bullish activity. Although, hey, we are up 23% on the year. Today's move definitely helping out on the back of these nice earnings. So appreciate it, George Tillis, for all of that insight. That will also do it for us for Next Gen Investing for the week. The watch list is coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking. the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered. Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand. Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing of houses, opening up our business, having children, they've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Welcome to the Watch List. I'm Nicole Pedalides. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange on the corner of Wall and Broad. We've had some up arrows today, and we were going to be saying that the S&P and NASDAQ were down for the second week in a row, but it's looking like a winning week for those indices. We'll cover a lot throughout the show. Of course, we'll look and cover the strong earnings and whether or not that trend can continue to hold up and how stretched the valuations really are. What the economy and the Fed mean for markets heading into 2026. And we'll talk about where investors are finding opportunity, from option strategies to AI-driven plays beyond big tech. And our panel is ready to break down FedEx and look at the earnings for this quarter and what's realistic for 2026. A look at that. And in our CEO Spotlight, we're speaking to the CEO of a testosterone monitoring company. We'll talk about that. Okay, here's a look right now. Stocks are higher across the board. The S&P 500 is 6832, up 57 points at this moment. The NASDAQ at 25,320, up 301 points. The Dow Jones Industrial Average up 0.5%, up 277 points, and the Russell gaining almost 0.9%. Oil and gold are right now both higher, and we have gold at $14, and oil's a bit higher as well. 15.33 on the VIX. The 10 years at 4.15. Oil sitting at 56.59, and the Bitcoin trade, while still below 90,000, is at 87,220, but is up 2.8% today. So a little risk on there. And then we have the movers that we'll discuss: FedEx, Nike, Oracle, just to name. Boeing is just got a nice call from JP Morgan and some of the cruise lines. There's a lot of names to follow. In the meantime, Kevin Green, senior markets correspondent, is here. And maybe we should start off with Oracle, because there was some big news pertaining to TikTok, which gave it a boost today. Good afternoon, Kevin.
Good afternoon, Nicole. Yeah, we are seeing the shares up about 7.5% in the session, and that's after a news report cited the fact that we might be seeing a closed deal when it comes to TikTok around January 22nd. Now, this is according to a memo by the CEO of TikTok that did state that we could actually see further progress within this deal, and Oracle could be a big part of that. Now, this new company is going to be called TikTok USDS Joint Ventures LLC, and around 50% of it will be owned between Oracle, Silver Lake, as well as another company called MGX. And you still will have representation from the ByteDance affiliates as well as ByteDance itself. But the new company is also going to have the majority of their board from America here. So this is a deal that looks like we're getting closer and closer to the finish line. Oracle is going to be a big part of that. They are going to house the data as well as ensuring compliance with the U.S. regulations here. So this is the reason why we are seeing a decent pop in the stock, at least for today, amidst some of the other negative news that we've seen over the last couple of weeks here, Nicole. So hopefully we're able to...
We bounced through the double bottom off the 200. Snake breakout, pullback, double bottom boom.
Understood. All right. I mean, look, especially
on the SPX.
Down, this is a nice bright spot for shareholders today. The stock's up at 8%, like you said. Nike had, some good news at home in North America, some struggles in China, for example. What were the Nike takeaways?
Yeah, we are seeing the shares down over 11% right now in the session, and we actually did see a mixed earnings report, but the margin portion of their report is actually what's in question right now. The company did report revenue at $12.43 billion. The street was looking for around $12.14 billion, and the adjusted earnings per share exceeded the street's expectations, coming in at 53 cents. The street was looking for 37 cents, but when you're looking at the China revenue, it did fall by 17% on a year-over-year basis. Now, the North American sales were actually better than the street's expectations. Those actually grew by around 9% on a year-over-year basis, but the margin story is the problem. Gross margins actually dropped by 300 basis points in Q2, and they guided that they could see another drop in margins between 175 basis points and 225 basis points in Q3. So you are seeing a little bit of a compression there, and outsized growth when it comes to North American sales, but the tariffs are having an impact on this company. A lot of their manufacturing and their products are made overseas. So this has been a headwind for Nike and the executive leadership team, and obviously investors are not really enthusiastic regarding this report.
Understood. All right, Kevin Green, great to see you. Thank you so much. Always. All right, there's Nike down 10.8%. We continue to take a look at the big picture. Glenn Dorsey, SVP, Senior VP, Head of Client Portfolio Management at Clark Capital, is with me. And there's been a lot of excitement maybe about a Santa Claus rally or S&P 7,000. What camp are you in?
Well, I think we have a little choppiness right now, earlier in the month, but it looks like we're going to end on a fairly strong note. The earnings outlook has been very strong. Valuations are not cheap, but given the growth rates that we're seeing, they seem pretty reasonable.
So how do you think, we look at right now the earnings projections, and some of them are a little aggressive for next year. Are they on point and you feel positive?
Yeah, if you look at the S&P 500 operating earnings projections for next year, they're to be up about 17%. So that brings operating earnings to close to $309 a share. The interesting thing is that those estimates have gone up. They were about $295 a share back in July. So the trend has been positive and continues to accelerate.
You did say small caps may finally have its day. Why is that? I mean, obviously we've seen some good news for small caps. People have been waiting a decade to a certain extent. What happens to small caps in 2026, do you think?
Well, it's interesting. So small caps obviously have been cheap relative to the S&P. You have a forward multiple of about 15 versus 22 times for the S&P. But just being cheap isn't a reason to buy things. So there's a couple of catalysts that are kicking in now. As S&P operating earnings were increasing, small caps was going down, and we finally hit an inflection point where those earnings have turned up. So that's a very important catalyst. You also have less regulation next year, which should be a pretty good tailwind. And small caps tend to do better when rates are declining, and theoretically that's the environment we have for 2026. So it might finally be the time where small caps outperform large cap.
You still like tech, right? I mean, are you buying tech on dips? If so, what kind of tech?
Yeah, the earnings are still there, right? The growth is still there. The profit margins are sort of double what the rest of the market is. Obviously, in the Mag 7s at 28 times earnings, so you can't say that it's cheap, but again, that's where the growth is. On pullbacks, for select companies, we definitely want to be there. We want to make sure that we're invested in a very exciting area, and tech in general and AI specifically definitely should be a boost for profit margins going forward.
Say you're also watching healthcare and financials as groups that maybe you like for the new year, but when people ask you if this is a bubble, we look at some of these valuations, and you noted that earnings are going up now rather than down in the past, and you have a Fed that seems to be more friendly at this moment. I mean, I guess there are different elements that say to you it's not necessarily a bubble. Is that right?
We don't think the market in general is in a bubble. When the comparisons are made to the 90s, there's some really important differences between now and what was going on then. You had a Fed that had raised interest rates by 150 basis points in the back half of 99 and in the first half of 2000. Earnings had peaked in the third quarter of 99 and went down the next 5 quarters in a row, declining by 31%. That's a very different environment than we have now, where we have a Fed that's cutting rates and you have earnings growth accelerating.
So you said AI beyond the obvious, go for the data center build out. What kind of names are you watching or sectors?
I think, if you think about all these data centers that are being built, there's engineering, there's construction equipment, there's the services that go into leveling the land and things like that. Power generation and transmission are very important. Utilities are having a great year this year. And cooling. They generate a tremendous amount of heat. So those are all kind of the ancillary areas. And then ultimately all of the users of AI, particularly companies that have a very high employment level relative to their expenses, they should be able to benefit from the AI build out and usage.
Where does the K-shaped recovery come in, and why is that important?
Yeah, it's been pretty noticeable. You look at when you look at delinquency rates, you look at the prime money, prime borrowers. It's about 60% of the market. Their delinquency rates continue to be low. A lot of those are less than 1%. Consumer credit cards about a little less than 2%. But when you look at subprime, which is about 20% of the lenders, those delinquency rates have moved up to 16%. So trying to avoid areas that are sensitive to lower credit scores and lower income, focusing more on the top part of the K recovery.
Understood. What about big pharma or any other sectors? Maybe something related to the consumer.
Yeah, it looks like healthcare in general is starting to do better. It's been cheap for a while. There's been a lot of ups and downs, and some political things that get involved with that as well. But it looks like they're starting to perform a little bit better. Consumer, again, I think you need to focus on sort of the higher end level of the consumer, that upper part of the K recovery, and avoiding that lower end of the K recovery.
Glenn Dorsey, Senior VP, Head of Client Portfolio Management at Clark Capital. Glenn, thank you. Nice to see you. Appreciate it. Coming up, options quarter. Rick Ducat will join us and highlight the options activity. Somewhat unusual options activity on this day. Some heavy big trades. He's always finding them for us, and we'll explain news of Albemarle, Micron, Moderna. And don't forget, it's Triple Wish. We're going to have, obviously, options expiration at the end of the day. Expect some heavy volume and volatility, too, perhaps.
Not much play today. No.
you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the Watch. This time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. And this is the perfect day to do it here on Triple Wedge, right, on this Friday. And the last one of the year. Rick Ducat, lead market technician, is with us. And you're taking a look, Rick, first at Albemarle. And you found a bullish trade that you're going to explain to us. I'd love to hear some more.
Yes, a very bullish trade here. And, lithium is a pretty hot topic lately. It's a critical material that we need for all kinds of semiconductor products, and also it's a key component in rechargeable batteries here. So when news broke on December 17th that China was revoking 27 expired mining permits in one of the key lithium producing regions in the country around the city of Yichun, it made me think, Albemarle is the only working lithium mine in America currently. It's in Silver Peak Mine in Clayton Valley, Nevada here. So now, when that news came in, there were several analyst price target boosts from Wells Fargo, Citigroup, Mizuho, RBC. Citi was the most notable. They raised their target to 150 from 100, so a 50% increase. I did note, though, that all of them kept their hold ratings, though. Nevertheless, Albemarle is at 52-week highs today.
ALB
was very sizable, both in terms of the quantity and the dollar amount, plus 27,661 January 16th, 155 calls at a $5 debit paid here. So a bullish opening trade here. The volume did exceed the open interest. All of our trades are opening trades today here. 28 days to expiration here for this trade here. And this is a sizable one. That $13.8 million debit paid is the max loss here. So what we would be looking for then, break even of about 160 then, so about 7.9% to the upside or so. The expected move for this option series in particular at the time I checked was about a plus or minus 13%. So certainly within the realm of possibilities here. One other thing that really stood out was the size of this trade, as I said. This one single trade was about a third of the market of options volume for Albemarle. Also, it was paired with many closing trades here. If you were to put all of them together, it was about 75% of the total volume. So a very interesting morning for this stock that typically doesn't see quite this much action.
Yeah, without a doubt. What an incredible chart that is, and the 135 price target that we saw from Wells Fargo. So thank you for that. Now, Micron helped to give a boost yesterday to the tech group overall, and that tech trend and up arrows have continued today. You found a neutral to bearish trade on Micron, if you could explain, which is up 7% today.
Yeah, at the time I checked, it was the number 4 mover to the upside in the S&P after earnings. Earnings was good, so was guidance. The obvious theme seemed to be demand is far outpacing supply for these storage and memory chip makers here, which are the strongest part of this chip maker sector so far. Many price target raises, TD Cowen, Wolf, Goldman Sachs, JP Morgan, Barclays, etc., etc. Too many to even list here that I could find for the purposes of this segment here. So the trading question, though, seemed to be perhaps a bit more cautious, more looking toward upside resistance here. Minus 1,132, February 20th, 320 strike calls at a 930 credit here. So this one was about a $1.1 million credit received here. 63 days out here, an opening trade as was our last one here. The break even would be 329.30, about 23% to the upside. So quite a cushion there. It would also be beyond the expected move for this particular expiration, which would be about plus or minus 20.6% here. So that being said, too, it's possible these are uncovered calls that are just being sold to generate income here. We can't know for sure if this is paired with any other positions or anything like that, but the idea of having that unlimited potential risk as a stock could theoretically go upward infinitely here makes me wonder if perhaps it's paired with an existing stock position to give a covered call then, which would be one of the least risky types of options trades that would be possible just based on the general parameters here. So just something to think about here. We don't really know for sure. This trade was in a market that's seeing a sizzle of 2.2, so 2.2 times the expected 5-day average volume for this name here in the options world.
Look, we see Micron at new highs now. The high was 268. We found the neutral to bearish trade this week up 10%, but certainly has had a nice run in 3 months, up 62% for a name like Micron. So what a run. What about Moderna? You found a bearish trade there.
Right, so, Micron is the number 4 mover. Moderna is the top mover today. And the only major headlines that I saw recently mostly seemed more good. The Coalition for Epidemic Preparedness Innovations plans to invest over $54 million with Moderna to support influenza vaccines. Another headline that I saw recently was the EU Medicines Agency okayed one of their new COVID vaccines here. One headline I saw that didn't seem quite as good, though, was from earlier this month on December 1st, discussing how the U.S. FDA was reportedly planning to tighten vaccine approval procedures here. So who knows? And this is a sector, too. This healthcare and pharmaceutical sectors is one that is poised for
mRNA
legislative risks here due to the focus of the administration on drug price negotiation and other aspects like that. Anyway, so the trading price is more of an outright bearish play. In this case, it's plus 10,000 April 17th, 25 strike puts at a 157 debit here. So a $1.5 million debit paid here. Max profit would be about $23.4 million if the stock were to go to zero here. When we do look at the expected range versus the break even here, we've got about 119 days until expiration for this stock to hit the break even of 23.43, which is almost 31% to the downside. So a pretty big potential move there, but really still within that expected move range, which would be about a little under 33% plus or minus either way here. This was a pretty big trade too in terms of its quantity. This 10,000 lot trade. At the time I checked, there was only about 80,000 contracts had traded here, so about 12.5% of the total market was this single trade here. Sizzle came in at 2.6 today, so 2.6 times the 5-day options volume average here.
Right, Rich Cat, great to see you, and as I mentioned, it's Triple Witch, and the booths are filled with all the traders ready to handle the orders at the close here on options expiration Friday, December 19th. Rich Cat there with Options Corner today, looking at 3 trades, real trades that he shared with us. Thank you. Coming up next, we're taking a look at testing your testosterone using AI. Apparently, it's very big business. More to come.
Very interesting.
With the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern.
Still holding up.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts and stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab. Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl?
Schwab, a modern approach to wealth management.
In the world of drugs and testing, we spent so much time talking about GLP-1s this year. Have we spent enough time talking about testosterone and testing that? Because it is a $15 billion industry and growing. I'm pleased to bring in my next guest, Marina's Alexandru, founder and CEO at Adam Health. And on your board, I saw you have several PhDs. You have a chief scientist and AI officer. And you're in the phase now of testing testosterone using proprietary AI. Could you explain that?
Hi, Nicole. Yes, so we're a small company out of London, the UK. Our background was always clinical research. We run clinics in men's health, and there is an inefficiency right now. There's 10 million men on testosterone right now in the UK, in the US, and there's an inefficiency where testing is difficult because you have to go to a lab where you have to post samples, and that's expensive. And we're working using AI right now to create a rapid testosterone testing tool at home. Like you don't need to take labs, or you don't need to post anything. That's what we're working right now on.
Yeah, no, this Adam Health is pretty exciting. It is rapid, it is accurate, it is a test at home by Adam Health. And would you be testing yourself how often?
Well, I'd be testing myself all the time if I had it right now. I mean, testosterone, as any hormone, changes at different times of the day. You have to be testing free testosterone if you're on testosterone. And right now, you simply cannot do that because of logistics. So if you were me and at the age that I am right now, I'd be testing several times a week.
Right, because it did say 1 in 4 men in your notes, have, I guess, testosterone issues, or over 30 have low testosterone. You talk about free testosterone, which is the active hormone, versus total testosterone, which is a different thing that is often tested, and you don't actually get the details that Adam Health will provide. When we talk about this, when will this become available to folks so they can order it maybe on Amazon or get it, and it sounds like you can use it over and over again. What's the price point and when will it be available?
So we're working on having that available within 2026, Q3 or Q4 2026. We're just raising money now. We're raising a seed round in order to do that. We already have tools, other tools in the market that we've been testing with, and it will be. The price point will be around $100 for the testing device. Plus, we're going to be giving testing strips that are going to be consumable, and it will depend on how many times you want to use them, but they will be priced around $6. each test.
That's pretty, yes, understood. So then you could test as many times or as few times as you like. You can also adjust your medication accordingly, I guess, because you said a lot of folks are doing injections or taking supplements, and there are many blind spots. So you said this will help with clarity to treat your issues a little more closely. This will give a key competitive advantage to, you have the AI, gives a key competitive advantage to a name like Adam Health. Is there anything like it? Or do you feel like this is something that you're going to have go public here on the New York Stock Exchange one day? Is that your goal?
This is our goal eventually to be, I mean, our biggest market is the US right now, although we're developing in Europe, but we're looking into the US for science, for talent as well, and we'll be looking to go public in the US. And you rightly mentioned AI. This is what we're going to be trying, and we're building actually right now. We have a blueprint of the technology. We have scientists working on it right now. Every man has a different physiology. We're all different, and we're trying, and we're building the tool right now to map this out for each personalized treatment for each man. I mean, how you take testosterone, at what times, and the dosages, which right now we're a little bit in the blind, as it were.
Right, I saw, I mean, as I saw in your PowerPoint, it had Adam Physiology, the AI engine and the sensors, and this is a saliva test from what I understand, but eventually you'll have more services, referrals, maybe fees that you can help generate, ED medication, clinics. This is the beginning of Adam Health in a big way, right? I mean, when you talk about this industry, I'll give you the final word here, you know, just something really special about Adam Health over everything else.
Right, I mean, Adam Health is trying to effectively solve a problem that shouldn't exist. Men die on average 5 to 7 years younger than women, and we're trying to resolve that using at-home tools and AI. We're trying to map out each man and give them actionable advice and tools through referrals and our partners in the US and Europe to increase their health span and lifespan. This is what Adam Health is building.
Yeah, no, I understand. I do have one quick question that you had in your notes.
Quick,
You said
make it quick.
regulatory environment and even our Kennedy, and the idea of anti-aging and being younger. Are all
Well,
of
heck.
those in your favor, sort of tailwinds for Adam Health right now? How so? Just quickly, final thought.
There was actually a recent panel from the FDA that is pushing for testosterone to be, testosterone administration to be relaxed. Our actually has been quoted saying that he's been taking, in some ways, testosterone and he's in favor of that. It can be legitimately said that it can be used as an anti-aging drug for more mature men. So I think, yes, this surely regulation right now, especially in the US, is in favor of Adam Health and what we're building. Yes.
Understood. And you have, I guess, 11 years of clinical data, and moving forward, and in 2026, this could become available, and then one
Correct.
day we'll see you here at the New York Stock Exchange ringing the bell, and you'll come on with us at that point. It's an exciting, you know, obviously venture, and we wish you and the team luck, Marinos Adam Health. Marinos Alexandru, founder, CEO, Adam Health. Thank you for joining us here on the show today. Still ahead, the macro case for faster growth and why earnings still matter most for stocks, and where AI-driven volatility may be creating opportunity. We'll explain.
sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Pedalides. We're live on Wall Street, the last full trading week of the year. And obviously right now we have some up arrows to speak of. Andrew Graham, managing partner at Jackson Square Capital, is with me to talk about the market action as we sort of wrap up this year. How are you feeling about the market right now?
Well, I feel like we've gone through another, pullback in the momentum factor. You see that in the tech tape up until, yesterday's solid micron report. And there's follow through today. I think it's kind of choppy. I guess I'll give you a bah humbug. How about that this time of the year? I love the holidays. I'm just not so sure. I like light volume and attendance. And I think that's what we're going to get for the next couple of weeks. So it's going to be hard to separate the signal from the noise. All in, though, I look at this pullback in tech as an opportunity to reload, which is our first priority over the coming weeks.
So pullback in tech is a time to reload. And what kind of names or sections within tech do you think work? Where would you pick up some on these pullbacks?
Networking equipment is set to inflect higher as we go forward. There's an effort inside the data center to scale up, right? The first moves were now scale out, and it's adding server racks and so forth. Now I think the industry is trying to add more compute and connect server racks with each other. What that means is greater connect or higher connection rate, more networking equipment that's going to be used, optical transceivers and so forth. But I would start with Arista. I think Arista probably has the biggest upside of addressable market from the scale up and what's going on with TPUs, in place of GPUs. And Arista is the market leader in AI switching equipment, and third-party research groups estimate that the Ethernet switch business is going to grow. TAM is going to grow from $8 billion today to roughly $59 billion in 4 years. So we'll call that 7+ times growth, and that's going to come through in earnings growth. By the way, Arista also has very strong backlog for revenue of $2.5 billion that's going to be coming through, I think, as early as Q2 of next year.
Did you feel that the Fed's projections of GDP growth and also unemployment rate coming down were on point for 2026 and 27?
I didn't read too much into that. I think, Nicole, that's a really good question, because my takeaway from the last meeting, the December meeting, was Powell's concern about the labor market. And I think that's the market's focus. Yesterday we got I think an unusable CPI print. And then it's also probably downgraded. I think inflation's downgraded in terms of its importance. The Fed is going to be watching the unemployment rate. It's kind of a weird number, right? It's the household survey, and it's people calling people at home and asking if they have a job, but it's still how they're graded on job performance at the Fed. And so you get another plus tick in the unemployment rate, and I think the Fed will be easing maybe as soon as January. The important thing is that the Fed is willing to act, so you've got that Fed put in place, and then you just also have, going into next year, you have a number of drivers that I think are going to take nominal GDP growth higher, and there's a strong positive correlation between nominal GDP growth and earnings growth, and that's what matters when we're thinking about stocks and so on.
So you mentioned Arista Networks as one of your picks. What else do you like?
we're staying in that lane, coherent, which makes optical transceivers, I think, has the ability to meet demand, maybe more so than the other players, Lumentum also as well. But my pick is coherent. They've just, they're building it as much as they can in terms of supply to meet the demand that they know is coming, and I think it's going to be a good market going forward for those guys. But you could probably grab any of them, but coherent's our pick. And then there's just a lot you can fall out of a boat and grab any one of those names, and they're going to work. But yeah, that's one in the tech space. And then outside of tech, it's hard not to recognize the inflection in the cyclical stocks recently. I think that's probably a head fake. When I said, I feel like a little bit of a Scrooge here, you're going to be careful with reading too much into the plus tick in cyclical groups, because there's a sort of a leaders to laggards trade that goes on at this time of year. I would instead focus on the AIs that back up, like I mentioned, Arista, Coherent, and then there's just in pharma. I think that we've cleared a lot of the major political hurdles, most favored nation status and Medicare numbers and so forth are all done, and your generalist PM is now looking at pharma again, stuff that's underperformed for the last 3 or 4 years, and our pick there is Lilly, which just owns the anti-obesity market, the anti-obesity franchise, and maybe even that is sort of dulling or obscuring their oncology pipeline, which I think is very promising.
Let's talk also just about AI, back it up here for a moment. I know you had things like Oracle and CoreWeave that you said that tells the story. Also, OpenAI, for example, just now is opening another round of funding. They've got $100 billion, which they hope to do that by the end of the first quarter, and that brings the value to $830 billion on OpenAI. What are your thoughts on what's your AI view?
This recent potholes, like we call it, the AI valley of uncertainty, or whatever you want to call it, that comes up, sort of disillusionment that pops up. This happened again, with the cloud and so forth. This happened in AI several times. This current version, which I'm going to call pothole, it is uncertainty about how these guys are going to fund their ambitious data center CapEx plans. Okay, so the group that we're talking about is NeoCloud, so that's CoreWeave. Got a nice sell-side upgrade that I haven't read yet. Today the stock's up a lot, and then Oracle, I would throw in that group, and then of course OpenAI that just lacks the free cash flow to compete with the sort of legacy hyperscalers. But if you take it, you just look like 90% of AI CapEx is being funded with cash. And the people who are legacy hyperscalers have nothing but space on their balance sheet. If they wanted to use debt, they can. I'm pulling for a very as many players as possible, so I hope it all comes together. But I think that's what's going on in the market. The uncertainty of how those companies are going to fund their AI ambitions has raised the risk premium on the group on the AI themes. And every time you get a plus tick in risk premium, you're going to get a lower multiple. That's going on now. We take advantage of that multiple because it's set to inflect higher, not the multiple so much, but earnings, especially at the networking equipment stocks. Those names are
yeah. And just a few seconds left. I know you said it's hard to have the bear out, but if the U.S. and Japan are actually paying down debt with GDP growth, you like that?
I do. Yeah. I mean, there's a lot of things going on here. There's, the geopolitical competition, I think, is like an underappreciated theme that I lived through once before with Japan back in the 90s. You just feel it. There was an impulse, and again, that goes to nominal GDP growth.
Little bitty scalps.
And that translates into earnings growth. That's the strong positive correlation. So, we're bullish. I know there's recency bias.
But I wasn't here to catch that one. 63.
It's very hard to make a bearish case. I guess the bearish case would come if you ran the economy too hot in Japan and in the U.S. right now.
Oh, yeah?
And you get to a point where the Fed needs to start thinking about rate hikes, but that's nowhere in the lens of the next 6 months, so, or maybe even longer.
Years, buddy, years.
We also keep an eye on credit spreads. We're always looking for ways where the markets can break down. Credit spreads are important. All this debt issuance and so forth is going to increase the credit spreads, and hopefully that will reduce the debt issuance. But always important to keep our eye on those two things.
Understood. Andrew Graham, great to see you. Managing partner.
Get rid of me.
Capital, Andrew, thank you. Coming up
Bye-bye.
FX, the earnings and the 2026 outlook, and they did raise the lower end of the guidance. That was good news. What do we need to know about FX going forward?
Yeah. Well, it's a slow day, people.
For the final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to second
Randy.
we're tracking the catalysts that move markets right into the close. Here on the floor, I bring you real-time sentiment from traders driving the action. And in Chicago, we break down the data.
Can you talk about NVIDIA?
You need to see before the bell rings. Live coverage of the close every single day. This is Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Talk about NVIDIA tonight. I dare you.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Tesla.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Seb Lattis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Believe me, when it comes to investing, you'll love Carl's Way. Take a look at but there's a Carl's Way is the best way.
It is the best way.
At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes,
Whoa.
and I let them manage some investments for me too.
Let's move on, shall we? No can do.
I'll get out
That's a
here.
bunch of shit.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Teaming up on Carl like that.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets.
Well. Tesla.
Who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Welcome back to the Boxes. We bring our how we talk all about FedEx. Dom CCCIO Johnson, the Financial Group, and Andrew Long, Managing Partner, Running Capital Management, both joining me now. Of course, the CEOs seem very positive. They've been trying to cut costs. They had growth here in North America and internationally. Ed raised the guidance, too. There was some good spots there as far as lifting the guidance for growth on revenue and also earnings per share on the lower end. So there were a lot of bright spots. What do you say, Andrew?
Yeah, I think that this was a high-quality beat, not an accounting beat. FedEx delivered $4.82 in EPS versus $4.12 expected. But the real story is how they did it. Express margins and operating income materially exceeded expectations, with both volume and pricing surprising to the upside. And I think that the key stat to really look at here is 66% of FedEx's total revenue is now business to business. And nearly half of revenue growth came from higher quality B2B shipments. That's why 7% revenue growth translated into 17% earnings growth. That's operating leverage, and that's execution.
So I was looking looking at the FedEx stock, which right now is at $287, but there are plenty of price targets here above $300. Jefferies $326, Bank of America $315, Stifel at $328, Wells Fargo $295, JP Morgan $294, etc. Doug, what do you think here? There were some high expectations not only for this year but also for the future. What did you think of the quarter, and what's maybe the outlook, in your opinion, for FedEx?
Well, we're really thinking big picture here, so I'm not too concerned about any one company. I guess what I'm thinking about is what are the clues that this gives me about the market and the economy moving forward. And so what I see here is the market's been behaving a certain way, and you saw it in Q3. Companies that beat earnings got about half the applause or pop in the stock that you normally saw, and companies that missed got about double the punishment. And I think you're going to continue to see investors really scrutinize earnings throughout this season as they're more skeptical of some of these productivity stories.
The CEO noted that they've been cutting the costs and transformation with initiatives. They've been doing that, but obviously they've been talking about some of the macro situations, global trade policies, transportation costs, even the aircraft fleet, the MD-11 aircraft fleet that was grounded at a time. Compensation has also been something, wages have been higher, and that costs, Andrew?
Yeah, I think that it can't be dismissed that FedEx talks about that they have this billion-dollar headwind, which is really tariff policy as well as a global slowdown in shipments. But FedEx is more coiled than it's been in years, in my view. They've already removed $4 billion in costs over the past 4 years. They're on track for another $1 billion this year. They're halfway through the fiscal quarter, and they're on track. But this isn't just cost cutting. The company is really undergoing a three-part transformation all at the same time. They have network transformation that's domestic and international efficiency. They have organizational transformation that's one FedEx, breaking down the silos that existed before. And third, digital transformation that's data, AI, and intelligence all layered on top. Their Network 2.0 initiative, it really is shrinking the footprint by 30% while improving speed and efficiency. So I think that even if shipping volumes recover just modestly, margins should expand meaningfully. And FedEx didn't wait for the cycle to turn. They're really positioning the company and the business for the turn.
What's interesting is the stock has been pretty much flat for the year. I mean, we can note the great move, up 25% since the company reported its first quarter results in September, so you did see that. But going into Thursday trading, FedEx was about flat year to date. How do we compare the story of FedEx and UPS? What's the story about the economy that comes from them, and is one really much better than the other if you're a stockholder?
Yeah, again, big picture, I think, from a market perspective, we are thinking about what the setup is right now and then what you have next year in front of you. Right now, you've got a market that's more discriminating about earnings. They're more skeptical, and they want to actually see, that this AI thing is not just narrative that's going to play out. In companies like these are the perfect kind of companies that should benefit from AI adoption.
Back to 63 again.
Come through. And then you think about next year, and Andrew alluded to it, there's still headwinds out there. There's tariffs and there's other things that are going to cause a lot of noise. And we're at a high valuation for a lot of companies, so you can have good earnings, but a lot of that's already baked into the market.
All right, and I'll give you the final word, Andrew. I mean, when you look at UPS versus FedEx, do we see a good economy based on, because they did talk about U.S. shipment volumes did really help the results. What are your expectations? And do you
Amazon going on its own helped.
Yeah, I think if you're looking at a two-player market, FedEx is leaning into the right customers while UPS retrenches and Amazon internalizes deliveries. FedEx is taking share in both commercial and industrial shipping, where Amazon cannot compete. Winning major enterprise customers and maintaining service levels, even with grounded planes, shows real competitive strength, and I think that this is not temporary, it's structural.
I did want to talk about the spin-off. I know they've been hiring LTL sales and preparing for that. Also, just quickly, Don, what do you think about something like that? The freight segment was declined. That wasn't particularly good.
Yeah, I mean, I don't have specific thoughts about the spinoff or, freight in general, I guess. Again, those are just clues, into how consumers are behaving, what the economy's doing. But you need a lot of breadcrumbs to make a pie. And so any one data point here is just a little thing that we're looking at, but not making a whole picture out of it.
Look, I mean, the earnings did exceed the estimates. They were driven by stronger margin performance at Express in particular. Costs were only slightly higher than expected. That's according to one of the articles I was reading right there. You have analysts that are mostly bullish. Final thought, Andrew.
Yeah, final thought, I think just to answer your question about Express versus the freight is that Express delivered the 5th straight quarter of margin expansion. U.S. domestic package volume was up 6%. And so Express is the engine, freight is the weight, but the planned June 2026 freight spinoff, it really has the potential to remove a drag and clarify value.
Great to see you both, Don Cece and Andrew Wong. Thank you so much, and thank you, friends, for being with me here on Schwab Network every day at 9 a.m. and 2 p.m. Here on the watch list at 2 o'clock right now. The Dow's up 300 points. The S&P is also gaining. It's up 62 points. And I'll be here all next week. I hope you will too. But if you don't, I hope you have a blessed holiday. I'm Nicole Pedalese. Keep it right here. Market on Close next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage means expert strategy. From the opening bell to the closing bell, we've got you covered. Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance. I'm not saying a rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time, with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand. Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing of houses, opening up our business, having children, they've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
all those clean? Yep.
Hey, investors, you know the market moves. Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k, saving, spending,
we're coming down now to the promised land.
Count on Schwab for market insights,
Into Power Hour.
powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab.
Finally. I was sitting here watching this one day and I was waiting for the right time.
Good afternoon, it's 3 p.m. on Wall Street, and this is Market on Close. I'm Tom White.
Let's go.
From Marley Caden, coming to you live from our
Marley Caden's gone.
Hello, Tom. Happy Friday. I'm Sam Butters coming to you live from the floor of the New York Stock Exchange.
With Marley.
Let's take a look at what is coming up on today's show. We'll look ahead to 2026 and get some investing thoughts for you for the new year and discuss the Fed's path for next year. Later, we'll dive into digital assets, tokenization, and the future of blockchain. And in Options Corner, we'll take a look at CoreWeave, which is rallying after a bullish note from Citigroup. But Tom, what are you seeing in the markets today?
Yeah, the extension of the rally that we started on Thursday today, all four of the major indices higher. We've got the S&P 500 about 0.9% here today. The NASDAQ 100 up about 1.25%, so leading to the upside. Dow Industrials up about 257 points, or just over 0.5%. The Russell 2000 small caps up just over 0.75%. Now let's take a look at some of the other asset classes that we got on our radar. Continues to consolidate around that 4.5 or 4.15% level. So no volatility in the bond market at this point, which is actually helping support equities. The dollar index slightly higher. Gold rallying just below all-time highs, up nearly 0.3%. Crude oil starting to stabilize above that $56 a barrel level.
$2.40.
And Bitcoin also, its risk on trade there, up 3.6% today. Now, whether we're seeing that setup, Sam, go ahead.
Yeah, no, I was just going to say, I mean, given what you just sort of laid out there, I think we're really looking right now, Tom, aren't we, to see whether this is really the setup for the Santa rally come next week. As you pointed out, an extension of gains today, which was really given the green light by obviously the cooling inflation data yesterday, and then obviously what we got from Micron too. So we really saw this resumption of the tech rally, and so we've got the NASDAQ really pushing us higher today. It very much looks like leadership is back in the driver's seat, particularly when you look at the technology sector, which has been really our outperformer. I mean, you've got the Micron story, which has really relieved some pressure on that broader AI narrative. Just a couple of names to run you through, obviously, that's been catching a lot of attention. You've got Oracle, for instance, that's been surging over 7%, and that came after, of course, that story around TikTok agreeing to sell its US operations to a new joint venture that includes Oracle. That is a sharp rebound, obviously, in the stock after the AI jitters earlier this week. Then you've got NVIDIA, for instance, that's climbing over 3% after, of course, the Trump administration is reviewing whether the company can sell advanced chips to China. So we have seen a nice rally for some of those other chip names. When you look at some of the Chinese companies as well, you've got Baba and Baidu, which are also up too. Micron itself has extended its rally up another 7% after its earnings and guidance earlier this week. And, you know, obviously we've heard analysts talking about an AI super cycle for the memory space now. And so you've got
SanDisk, a lot of the other memory names which have been up in sympathy, up nearly 8% as well. So we're also seeing, as far as risk assets are concerned, continued recovery in crypto prices too. I know, Tom, you just touched on BTC prices. I mean, we're up at around 88,000 once again today. So we are seeing also Bitcoin-related names rallying as well. I mean, if you take a look at some of the Bitcoin miners, you've got Iron, which is up over 10% right now. You've also got the Strategy up over 4%, and Coin up around 2.5% as well. So it very much looks like, of course, the risk-on proxy, we are seeing some nice gains there too. And so that's really just sort of setting us up as we enter a short trading week with the holiday, of course, next week, Tom. But I'll send things back over to you with Jenny Horn in Chicago with some of today's top movers.
Thanks, Sam. Yes, we're going to get into some movers here today. For that, let's bring in our next guest. That's going to be Jenny Horn. She's the co-host of Next Gen Investing and also contributor across the network here. Jenny, first one we're going to talk about post-earnings. Nike getting hammered once again. The bar was low going into this report.
It was.
And they didn't get too much positive news. When I first saw the earnings come out, they beat on EPS, they beat on revenue. Stock immediately just turns lower just from some of the commentary. And if you start diving into this report, it wasn't all rosy.
It was not all rosy, and I think that China overshadowed a lot of the strength that we saw, and just based on its top and bottom line. We did see revenue that rose about 1% year over year, but from a regional standpoint, that's when things don't look as strong. We did see some improvement in Europe, Middle East, and Africa, but China's sales were down 17%, which accelerated from the first quarter's 9% decline. So that trend is not obviously improving, it's worsening. And so net income fell 32%, and adjusted earnings were a beat. Yes, they were down also 32% year over year. Now, a couple of factors weighed on their profitability, like gross margins falling 3 percentage points due to the higher tariffs here in North America. They also saw an 8% contraction in their direct-to-consumer sales, which do tend to carry higher margins than their wholesale business. So margins were compressed really by their effort to clean out old inventory as well as bring in new products. And their CEO did remind that the recovery will not be linear, saying that their comeback will continue to move at different speeds. It will not be a straight line. Well, they're acting decisively and accelerating the lagging areas, with China topping that list. So guidance did not exactly help. They have refrained from providing full-year guidance for several quarters as they now work through this turnaround. But they do expect third quarter revenue to be down by low single-digit percentages. Street had been projecting an increase by about 1%. North America expecting modest growth, while trends in Greater China and Converse, which was also down 30%, are expected to be pretty much in line. So gross margins will be down about 1 3/4 to 2.25 percentage points from a year ago. I mean, none of this really is signaling this improvement that everyone keeps talking about. The analyst commentary actually was fairly positive, all things considered. But I mean, even like Truist, for example, they were like, yeah, sure, the channel should continue to improve, we should see stronger trends. They still did revise their price target to the downside. So it's been a fairly mixed picture, and I think that competition is fierce. I know that they're still the biggest on an international stage, but they are not dominating the same way they used to.
Yeah, you make a good point there, because we talked about this on our show, Fast Market, and the negative impact from competition in the space. Like, I'll give you an example. We used to wear Nike 20 years ago, but I haven't worn Nike shoes, Nike clothes. You go to different brands, and you probably don't go back to Nike. This win now strategy that Elliott Hill, the CEO, has got, I mean, this is like a barge trying to turn around. It's taking a lot longer than investors have wanted at this point, but I just don't see them getting back to that old Nike level unless maybe Michael Jordan comes back and starts playing again or something.
I know, Nike just is not as cool. I mean, I don't even know what's cool, but I know what's cool in shoes, and that's that Nike shoes are expensive, and they are for, I mean, to me, they're for a narrow foot type of person. That's not myself, but it is true. Once you have this loyalty to a brand, and there's so many to choose from now where it's just, so the wide really felt weakness across a lot of these athleisure names because there's just not dominance the way there used to be. And again, that is a bit with a grain of salt because I know Nike is still so much larger as far as its market cap, but it's also expensive. I mean, it trades at a premium right now, even to say like Lululemon, which has not been seen as a cheap name historically. So I think with this premium, this price in shares, you need to be putting up growth.
Yep, I think competition is more of a thorn in the side of that company than they're probably letting on at this point. You've got those names, Lululemon and On Running. Hoka also taking some market share from them. Now let's pivot over to FedEx, big green candle here today. This stock was up over 25% from the last earnings report. It seemed like pretty good on headline and headline numbers and bottom line EPS, but at the same time, stock rose, stock fell. It's been a pretty choppy trade here.
Yeah, I think encouraging that we were at least able to recover from earlier losses, as the story was a lot different. We were looking lower this morning, but I mean, cost reductions, higher U.S. shipment volumes did help the results. And we did see that they reported sales that were able to easily beat, and adjusted earnings also did top expectations. Now, going into today's session, the stock was about flat year to date, but was up 25% since those fiscal first quarter results that were released back in September. What's more is that right now there's the thinking that a lot of these estimates going forward are just even conservative, given the fact that they're now expecting still some turbulence from a pretty fragmented overall just logistics environment. But the problem is that with the second quarter and the updated guidance implies second half operating profits will be around 5% lower than the $3.2 billion the street had been projecting. But I mean, right now they're trying to really find a way back to their overall peak in quarterly sales, which we did not see that same strength is really coming out of the pandemic. But inflation, lower domestic shipment volumes have been a consistent headwind for this company. FedEx, though, has secured new business from Amazon, for example, after UPS decided to walk away, citing the insufficient profitability. But it does feel like when you look at these names for a great read on consumer health, logistics health, there are still some macro pressures that are going to affect this company. I mean, like you have just overall freight volumes. Crude oil actually would be a positive for this name right now, but shares have fallen out 3 of the last several quarters, and they've risen once over that span, so it doesn't exactly have a track record of being a boom post-earnings.
Yeah, when you've got to go into cost cutting to kind of increase your margins, help that top line a little bit. That starts to get a little bit dicey, but it's had a good run. Remember, the bar was pretty high going in to that report. Now let's pivot over to another name that reported this morning and surging on this news. That's cruise liner Carnival, up over 9% here today. Big green candle on this one, and we started to see a resurgence in these names. But this is a multi-year probably boom for the cruise industry, and this is the lower end one. They've got the worst balance sheet, but having a great day here today.
I was going to say, worst balance sheet, I think that the debt load of this company has been a pretty central concern, because coming out of the pandemic, I mean, they just incurred so much debt, where I tend to compare different industries, but similar in the sense of American Airlines, which has been debt-ridden for, decades at this point. So encouraging that they're reinstating their dividends now, which definitely does help at least encourage that debt load is shrinking. And they did say that while expectations were overall, pretty now solid going forward, they did say that the capacity increases with Carnival is continuing to rise, and that should have a short-term impact on the company's pricing. But they did also say that while overall vacationers have, yes, been drawn to a value proposition, the consumer is prioritizing experiences over material things, and they claim, of course, to be one of the best experiences out there. So they did say they plan to unify their dualistic, right now, overall, just consolidate their corporate structure, and they also did say that they are reincorporating perhaps into Bermuda. That restructuring could also help eliminate some of these costs and streamline their governance and reporting. So a lot to like here, and I think that the most enthusiastic tone from them was the fact that they're reinstating that dividend.
Yeah, you never get me on one of those floating tin cans. But people love cruises. I'm not going to bash on them at all. It's just not for me.
Kevin Hanks, he's our cruise line expert.
That's right. But having a great day here and lifting all the other names within the space. Now finally, let's move into potatoes. We got Lamb Weston. That stock's getting pummeled here today. I just looked at something. The sales volume grew by 8% in North America, 7% in international markets. But then they said the product mix or the pricing mix was a headwind. This stock is getting hammered.
Facing for its worst day in over 5 years today. So yeah, we're down 24, almost 25% on the session. They did warn that profit will be facing pressures from both the continual discounting, but also this attempt to win back business and rising manufacturing costs internationally. So pricing dynamics with customers as costs continue to ramp. Specifically, though, in Argentina, as well as these underutilized productions they've seen in Europe, that means the company's right now EBITDA will come in at the midpoint of its range between around $1 to $1.2 billion. So they did, also say that they made some progress in this turnaround, which came after a series of soft results in recent quarters. But a key issue has been a drop in restaurant visits, and then hence lower French fry purchases. So in the latest quarter, we saw a slight increase in sales. North America was basically flat, while international sales actually climbed 4%, and their sales volume did rise 8%. But that was offset by lower prices, which did really work to retain customers and gain new ones for the company, particularly in North America and Asian. But they did also say that they have right now been curtailing capacity to keep up with demand. It was a very mixed message as far as some of the commentary, but I think that all it said, you have declining EPS, you have sales outlook that was at least reaffirmed, but can't argue with price today. This is an ugly red candle.
Yeah, 8-year lows if it settles at these levels at this point. So not a good report there out of Lamb Weston, not good guidance either. All right, thanks to Jenny Horn. She's the co-host of Next Gen Investing here on the network. Let's send it back to you, Sam, in New York.
Yeah, thanks so much for that, Tom and Jenny. Well, coming up, we will look ahead to 2026 and discuss the state of the economy, where the Fed will go with policy and more. We'll discuss that coming up next on Market on Close. Be right back.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution, the 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies.
Nope.
Tailor the platforms to
Here we go again.
with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to Market on Close. I'm Sam Barker from the floor of the New York Stock Exchange alongside Tom White today in our Chicago headquarters. Let's just check in with these markets, see where things stand with about 43 minutes left in the session, because we have seen an extension of these gains that we saw yesterday. So we've got the NASDAQ out in front. Technology has really been leading the charge here, and that came off the back, of course, of Micron's earnings, really giving us the green light, easing some of the fears that have been out there around the airline to do with the whole technology narrative with respect to some of the data centers and valuations, etc. So,
Not much money made today.
some more green across the screen when you take a look at some of the bigger names in the technology space today, names like NVIDIA across the chip space as well, AMD, Broadcast.
NVIDIA.
Dow Jones is sitting up at
She said it.
1 cent, and Russell 2000 up 0.7%. So we've got risk on here in the markets as we of course have got more information as far as macro picture is concerned as well, and what that's going to mean moving into 2026 and what that could mean for the Fed. So we've got US dollar, we're at right now, the DXY picking up, we've got it at 98 to crude oil, as we mentioned, $56 a barrel, and we've got
Bitcoin, which has been catching a bit as well, 3.5% higher, as we have seen that very much closely correlated with the performance in technology. So we're at 87,000 and change right now. The 10-year yield, this has been an interesting story with global yields up higher off the back of BOJ, of course, hiking rates last night. We've seen those JGB yields up higher as well, the most on the 10-year since 1999, and then of course across Europe as well, high yields have been the story, so that is keeping the lift on the yields stateside too. Here's your scorecard as far as some of the sectors are concerned. As you mentioned, technology really out in front here, so it looks like leadership is back after a couple of weeks of rotation out of some of the more high-flying AI names into other parts of the market, of value and of course more defensive type corners of the market. But here we are seeing discretionary actually under pressure, so are staples, but communication services are holding up, and so are financials. And if we flip the board to take a look at what else is on the move, we've actually got utilities lower right now. That's down around 0.5% lower, but the rest are doing okay. We've just got real estate and energy on the line to the upside right now. So a little bit more of a mixed picture beneath the surface, but it really is technology that seems to be doing the heavy lifting today. Let's bring Tom back into the conversation along with our next guest. So it's Mike Dixon, head of research at Horizon. So given everything I said, Mike, just about the sort of two main stories that have really been driving the market narrative lately, obviously the macro data, what it means for the Fed, and then also around the technology stocks as well. What's your thoughts about how we go into year end and then, moving into the new year?
Sure. Well, it was really nice this week to actually get that solid dump of the economic data that we haven't had for quite a while. Overall, things were quite solid. I think, I look back at the economic projections from the Fed just a week ago, and looking at 2026, they significantly upgraded their GDP forecast to about 2.3% from where they had it prior at 1.8. And then this week we got retail sales for October, which is going to be one of the first data points for the Q4 GDP that we're going to get going through right now, and that was very strong numbers. And so where we sit, overall heading into 26 is really strong economic activity, and there's a number of additional catalysts through fiscal stimulus, the One Big Beautiful Bill Act on the individual tax cuts, as well as on the corporate side, some catalysts there to continue with a lot of that economic activity. And I think with a little bit of the rotation that we have seen over the last few weeks, I think as we head into 2026, we might expect that to continue, and not because necessarily the technology is not supported by fundamentals, because it very much is, but because we are seeing those broadening out of earnings and some of those more value cyclical areas of the market are actually becoming really good opportunities. And I think investors are starting to pick up on that a little bit this quarter, and I kind of expect to see that as we start 2026 as well.
Yeah, Mike, when you take a look at the Fed, the actions from the Fed, 3 straight rate cuts, priced in at this point, but now we got the data this week, CPI, it might be clouded a little bit with that headline number 2.7 and the core at 2.6, the lowest in 4 years. Does the Fed matter as much as it has probably the last year or so? Going into 2026, because it seems like the long-term rates, 10 years at 4.15%, starting to stabilize here a little bit. Do you believe that the Fed is still at the forefront of what investors should be watching heading into 2026, or are they going to take a step back from being the leader here?
Yeah, that's a great question, and I think the short answer is no, they're not going to be the central piece of activity that's driving markets next year. For a couple reasons. As you mentioned, we've had 3 straight rate cuts. We look into 2026, the Fed says they're going to do 1, the market thinks they're going to do 2. Regardless, we're pretty close to neutral, and Powell recently just acknowledged that. Now, we do have the uncertainty about who's going to be the next Fed chair. But, honestly, it doesn't really matter that much. They're just one vote on a committee of 12. We've seen a pretty wide dispersion of views. And, I think what that means in totality, absent any significant weakening in the labor market, is you're just going to have a little bit of this tug of war, and I don't think rates are going to go materially lower from here. But that's actually a good thing as well, because as time passes, and rates really don't move, and you have some of that tug of war, you're going to have interest rate volatility overall just begin to come down, and that's going to be a really big boost to particular areas like the housing market and mortgage rates as interest rate volatility, typically will add to the spread. The mortgage rates are above the 10-year, and so a reduction there could be a really big benefit from that housing activity, which obviously has been extremely low. And that could also be a pretty big boom to economic activity that's not even accounted for in the current expectations for GDP growth and other types of fiscal stimulus.
Mike, obviously we've seen this market in sort of fits and starts. I mean, we've had a bit of a rethink lately about, what the technology space is up to as far as, some of the questioning around how the debt markets, how they're actually financing all of this stuff. Obviously we've had this underlying narrative now about, the stretch of valuations. But I'm just wondering, as we've seen this degree of rotation lately, the value being growth, cyclical being defensive, what sectors are you going to be looking out for next year as the sort of a candidate for some outperformance here? Because, I'm hearing a lot about healthcare, people like that. It's got a lot of tailwinds for financials, obviously with that steepening yield curve and everything else going on the regulation front and M&A. I'm just wondering, what else you're sort of looking out for as we move into 2026 with sort of on your radar?
Sure, and I do agree with you broadly there. I think that as investors are taking a look at their portfolios this year, looking about repositioning into 2026, as I mentioned before, there are a lot of other areas of the market that are starting to look really attractive. Now, the tech side of things has been strongly supported by earnings, right? So, let's make no mistake, while you have seen a little bit of a rotation, even with Oracle and Broadcom last week, that was more of just a repositioning sentiment kind of thing because the numbers were quite strong. But when we look outside of just tech, so, I'll get a little more specific to a couple of sectors you mentioned there, some things that I like. Regional banks, for example, on the banking side. So these smaller cap banks tend to trade at even lower valuations than a lot of the big banks. They will benefit from that steeper yield curve, and you have seen an inflection higher.
Boom, baby.
And with a lot of this just increased economic activity, I think that kind of valuation gap is kind of poised to close and can be a really good catalyst for that particular sector. Within healthcare, yes, healthcare do quite strongly, but I think it's going to be a little bit more specific on the pharma and biotech side of things. You saw some really interesting announcements from Trump today, on the pharma side of things. That sector broadly has been under pressure for quite some time as a kind of a secular underperformer the last few years, and has had a lot of regulatory headwinds, but I think the market's absorbed a lot of that, and they still trade at very attractive valuations. So that's another one I like. And then look into some other highly cyclical areas like materials, raw materials for a lot of the infrastructure build out that's going to help make sure the capex that has been following this AI trade and this kind of AI infrastructure side of things really needs to take place so that we make the most out of those dollars. And you take that in totality, and what you're looking at is a lot of lower valuation type companies that are firmly on the more cyclical value side of the ledger. I think there's a lot of catalysts and a lot of reasons that those areas of the market are poised to benefit from this really increased economic activity and a little bit of just profit taking from some things that have done really, really well.
Hey, Michael, when you look at this, we've seen that broadening in the market. You mentioned some of those sectors and maybe some of the overlooked ones that you guys like going into 2026. When you look at the tech side of things, and that's been, the thorn in the side of what's been going on the last couple of months, caused a little bit more volatility. Earnings have been great. They've supported that risk-on mentality here in the markets. Do you see anything going into 2026 that might disrupt this bull market that we've been in for the last 3 years?
Well, one of the things you pointed out that I think is really important to reiterate is the tech side has been firmly supported by earnings and underlying fundamentals. In fact, I think it would be a surprise to many to know that the broad Max 7 index or the NASDAQ has actually seen valuations contract this year over the course of the year. So that means that the returns that we have seen, which have been quite good, have been strongly supported by earnings growth. In fact, entirely driven by earnings growth. And so when you look into 2026, the current expectations for those areas of the market are quite strong, and you're seeing a lot of that through margin expansion. And that's something that you have seen a lot of these more highly valued names really trade in a pretty sensitive range to when it comes to their earnings calls. And so I think being able to maintain those margins and attractive margins that can be 60, 70, 80%. at the gross margin level, which is extremely efficient, is going to be one of the main key areas of risk to watch for, because that has been one of the major catalysts for taking this top line growth and bringing it to the bottom line. And there's a lot of factors that go into that, but I think margin and protecting those margins is one of the key insights to look for when we have these earnings reports here, which, believe it or not, is going to start up in another month. And I think margins are probably the kind of the most sensitive area to watch for as it relates to a lot of those high growth areas of the market.
Mike, great stuff. Really appreciate it. Thanks so much for joining us today. Happy holidays to you and your family. We'll do it again soon. Mike Dixon there from Horizon. Coming up next, we'll dive into the world of digital assets, blockchain, and tokenization. That's coming up next on Market on Close. With the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risks. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Trading Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the Market on Close. I'm Sam Bartis here on the floor of the New York Stock Exchange. Joining me now here on the floor is Yuval Ruz, the CEO of Digital Asset Co-founder at Canton Network. Thanks so much for joining us today, Yuval. So just talk us through what Canton Network does, because you're pretty global.
Yeah, so everybody for the last 10 years have been very excited about blockchain and crypto rails, and we believe that in order to get institutional adoption, you have to create a public network where privacy is something that is available for users. So we've been building Canton for the last 10 years, launched it 2 years ago, and as you mentioned, has some of the largest institutional players participating on it.
Right, okay. So interesting moves in recent days as far as what you've been up to, particularly with respect to the first step in the DCC's broad strategy to make a customized asset available on the chain. Tell us what that exactly means.
Sure. So the DTCC is the largest CSD in the world. They are the central security depository in the United States. They hold $100 trillion of assets they custody for or manage for the entire U.S. capital market. A week ago, they received green light from the SEC to start putting some of their assets on crypto rails. And this week, they announced that Canton Network is the first. It's not, we don't have an exclusive with the DTCC, but it is the first network where they will start putting assets, and we're starting with U.S. Treasuries.
Okay, why U.S. Treasuries?
Well, it's the most important collateral in the world. There are tremendous opportunities for banks and hedge funds and financial players if they can move U.S. Treasuries all over the world in real time. Today, it still takes days to move U.S. Treasuries. Tomorrow, we'll be able to move them in real time, and it will be 24/7.
And then what comes next after U.S. Treasuries?
I'll let the DTCC talk, but the DTCC holds U.S. equities, they hold U.S. corporate bonds, they have U.S. municipal bonds.
No.
There's quite a lot of excitement, and I think that what crypto rails has shown is that if you could efficiently move assets real time, 24/7, there's quite a lot of
27 minutes.
applications that you could grow on top of it.
Obviously, we've learned this year that there is a lot of sort of mainstream appetite for this. I mean, particularly as you mentioned from the institutions as well, as far as some of that adoption is concerned. What has the demand been like out there, as far as that tokenization? Because there is a degree of hesitancy because it's so new, right? It's so nascent. Maybe not to you.
Yeah, well, I get that question quite a lot, and what I try to...
I'm sorry to be predictable.
No, it's great. It's actually good. So we run today 10% of the U.S. repo market on Canton. So we, like one of our clients, Broadridge, build a repo application that processes over $400 million in U.S. Treasury repos every day. To us, that's not a small feat. It's only 10% of the market. It could get bigger. But the reality is, you are correct. At the end of the day, it is new technology, and clients want to make sure that not only that they are careful with how they adopt the technology, but that they're also taking, using the use cases that will have quite a lot of uptake. Because I think that historically, a lot of people talk about, let's tokenize real estate, and then they find out, well, nobody wants to trade real estate on a real-time basis. So U.S. Treasuries, when you talk about collateral management, or eventually do much more efficient securities lending, those are things that we believe will have very fast uptake from a usage perspective once they're live.
So what does it mean for, say, banks and hedge funds, etc.?
Sure. I actually think that this specifically with U.S. Treasuries will have a very positive impact on banks. Today, banks have to meet their capital requirements globally at any given point of time. Because collateral doesn't move in real time 24/7, a lot of times they have to over-collateralize all of their legal entities to meet their financial obligations. We believe that once these assets are live and can move freely, a bank will be able to meet their capital requirements with significantly less balance sheet. If you think about it as an investor in a bank, you always measure their return on balance sheet. So if they can actually achieve the same financial outcomes with less balance sheet, it means that their returns just improve, or they can even do more financial activity with the existing balance sheet they have.
Okay, so that's sort of the institutional, the big guys. I'm just wondering, why is this important for retail investors to know about?
Sure. I mean, at the end of the day, I think that today as a retailer, you could trade a Robinhood very efficiently, you could trade a stock very efficiently. All of these platforms are very efficient in trading. But for the average person, I cannot take my, Apple stock and go and get some kind of a loan against it. You really have to be a high net worth individual in order to get those types of services from your banks. And we believe that asset tokenization will open up financial products, including to retail, that today are not at their disposal.
Interesting. Okay. And this whole idea of blockchain, etc. Why not sort of like Ethereum or something else?
Sure. I mean, Ethereum have done a great job for the industry, really like educating people about the technology. But again, our view is that, first of all, scalability, and most importantly, privacy.
Right.
So it's been kind of a theme of the crypto industry is that privacy is bad.
Yeah.
Our thesis already 10 years ago is without privacy, you will never get mainstream adoption. So our view is that if you are Schwab, you're not going to be capable of offering your services on chain if it means that everybody can see all of your client account balances. right? So for us, privacy was one of the biggest unlocks and also scalability.
Can I just take it up 30,000 feet and ask you about crypto this year? I mean, obviously we had a really good conversation on this program yesterday just about some of the tailwinds this year, obviously with the legislative wins, the sort of more crypto-friendly White House, as people like to call it, and, as we've mentioned, you and I have now discussed the sort of more sort of mainstream corporate adoption as well, the institutional appetite. We did see a nice outperformance, throughout the course of the summer. In fact, some thought it was going to be a bit of a quiet summer for crypto, but turned out to be quite the opposite, and we saw those records in October. We thought that we're sort of stuck now, as far as price action is concerned. And, there's been a lot of rethinking around year-end price levels as well, because, some people were throwing up big numbers out there, 150, 200 on BTC. Where are we at right now? I mean, are the tailwinds that we got this year going to continue to drive us in 2026, or is there something more needs to be done here?
Yeah, so I think that I think we need to separate price to the tailwinds, because tailwinds are adoption of the technology, and kind of if you think about a lot of technological booms, like even the .com, valuation got dislocated from the reality of the businesses that were being built, right? So to me, the most important thing is the tailwinds of adoption of the technology, because at the end of the day, it is only through adoption and putting real businesses on these rails that will mean that it's successful long term. I think specifically with respect to valuations, I'm putting Bitcoin aside, because to me, Bitcoin is an asset class where Ethereum and Solana and all of these other chains are more of a platform. At the end of the day, I think that the valuations of those networks have, for a very long time, grew up with the expectation of real businesses running on top of them and generating a certain amount of fees or cash flows that would actually justify. And the reality, in my opinion, is that you haven't seen that. You haven't seen businesses actually running. And I think that our goal is really, as I said, is to focus on the tailwinds. How do we bring more and more businesses? So Canton this year is at a rate of processing a few $100 million of fees on the network. But until we get to billions, if not tens or hundreds of billions of dollars of fees being processed on an annual basis, I don't see how you justify some of those valuations that are taking place. And I think that there's a bit of a fatigue in the market of saying, like, show us the goods. Show us that you actually run real businesses on these networks, or these valuations are not justified.
Yeah, you're sort of echoing what my guest said yesterday about how there needs to be a bit of a narrative shift, particularly when you look at Bitcoin versus Ethereum, etc. as well. So certainly something to look at in 2026. Thanks so much for joining me here.
Thanks for having me.
Happy holidays to you and your family. We'll do it again soon.
Absolutely.
Awesome. Thank you so much, Hugo Bruce from Canton Network. I'll send things back over to Tom in Chicago for now.
Yeah, Sam, coming up next is going to be the Options Corner with Rick Ducat. He's going to join us and take a look at options activity in CoreWeave after a bullish note from Citi today. That's next year on Market on Close.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
I'm Jenny Horn. We go beyond the headlines, tracking the trends, sector moves, and fundamentals shaping the markets in real time. This is Schwab Network. Subscribe to schwabnetwork.com.
How's it going? First day, so.
Sometimes you know.
Next. Try again.
You could have done better. Please. Same goes for where you invest. Level up and invest smarter with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage for you.
Not to mention Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Schwab, a modern approach to wealth management.
Stay connected to the markets in the Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
And on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Welcome back to Market on Close. I'm Tom White filling in for Marley Caden, and it's time for Options Corner. For that, we're going to bring in Rick DeCat, lead market technician here on the network. We're talking CoreWeave, one of the big movers of the day. Rick, this is based on some news that came out of Citigroup. But you know what? There's an article a couple days ago out of the Wall Street Journal that everybody was talking about the AI bubble. And CoreWeave is at the top of the hill when you talk about potential bubbles in this name, but positive note here today.
Right, CoreWeave basically is a cluster of supercomputers here that you can rent their processing power. That's kind of what this company does. And you can see, like many of these high-flying tech and AI names here, we've had a bit of a fall from grace here. Still, though, up 108% or so since we started trading here, outpacing the XLK Technology ETF and the S&P 500. And if you look to it, some of its other competitors here, Applied Digital and Nebius Group here, a similar trajectory here. Seemingly, perhaps a sympathy move from Micron earnings. The theme there was demand far exceeds supply for chips. It seems like it's just not going to change anytime soon. That's pretty much what the Citi notes said. They renewed coverage with the buy rating, price target of 135 as well. Big asterisk, though, a high-risk designation paired along with it.
Yeah, and I saw that there was a price target cut along with that buy rating. So, take it for what it's worth. They were a little bit more bullish on the name before as far as price targets go. But you got some charts for us to take a look at, and this has been ugly since those all-time highs. We've fallen 55% from those levels.
Yes, but we did hold on to an important supportive area. All the way back here, all the way on our left side of our chart, you can see we had that notable high shortly after we began trading. That was also around where we saw significant breakout points once we breached that area near 64.60. That was also our repeated low point 2 more times here. So it seems like this, relatively speaking, longer-term supportive area has held firm so far. We still have yet to take out 90.66, our recent highs, as well as fill the gap here. The high point after the gap down was near 98. When we look at some of our other studies here, simple moving averages, we have crossed above our 20-day simple moving average. Our 50-day simple moving average is pretty close to that 98 level there, our thick blue line there. So that would be another area to watch to the upside, extra emphasis there. Look for RSI as well to break above the 50 midline and break above this downward sloping trend line here. Finally, if we were to quickly look at our volume profile study, several very distinct volume nodes here.
Drama.
84, 90, 98, and about 105 or so. Those really stand out as high trading concentration areas.
Yeah, when you look at a chart like this, Rick, and we understand it just went public earlier this year. Is it hard to
Do you understand?
These levels or maybe studies based on such a short time frame that we've got with CoreWeave, just because there's not a lot of historical data as far as charting goes?
It can be, but the concepts are still the same. If momentum is strong, it kind of acts independently of time frame here. The price patterns can behave in similar fashions here. Support and resistance are kind of the same regardless here. The options market was pretty interesting in this name, though, here. Today's activity came in about 640,000 options trading hands here in terms of our volume here. 62% calls. Our most active month, January 16th monthlies here. 25% of the total open interest are in that expiration there. Top open interest strikes on the call side, 150, 130, and 180. On the put side, 50, 45, and 48. So quite widely dispersed in terms of our significant numbers there.
Yeah, and typically on a name like this that's got such a high beta, you're going to see probably option volumes and maybe, that speculative type of nature and really far out of the money calls because of the range that the stocks had over the last 6 months, right?
Actually, our most notable trade, though, funny you say that, was a far out of the money put, a long put, though, so someone seems a little bit more bearish here. They bought about 7,000 May 15, 55 strike puts for a 690 debit, $4.8 million debit paid, break even will be 83.50 or so. 48.10 would be that break even. So 42% to the downside, still within the expected move, though, so not impossible.
Yeah, that's the crazy part of it. I mean, that would be a big move to the downside, but maybe somebody protecting a long stock position. You're not sure if it's a speculative or maybe a hedge at this point. All right, great stuff, Rick. Thanks for helping us break down CoreWeave, the big mover to the upside here today on that Citigroup note. But let's send it back over to Sam in New York City.
Thanks. Another one to the upside. We're going to be hitting the road coming up next. It's the time for Overlooked Stocks, Tom, and John Phillips has his own Winnebago heading into the close. We'll break down the news on that company and what you need to know about it coming up next.
Opportunities don't stop when the market ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make-or-break level for this stock. And that could certainly be
No.
short-term, near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network. Welcome back to Market on Close. I'm Sam Bardas, live on the floor of the New York Stock Exchange. It's time now for Overlooked Stocks. We're watching shares of RB maker Winnebago rally today after its latest earnings report. So I'm joined by George Phillips, senior markets correspondent. Hello to you again, George. So lots of people are RB. Is that what's behind the report card here and why we're seeing this reaction in the stock?
Yeah, I think clearly there's some improvements in sales for Winnebago, which is certainly a legacy and branded, known brand when it comes down to recreation vehicles, towable trailers, and so forth. They also have a marine division, their Chris Craft boats division. So again, when it comes down to recreation, leisure, and travel, Winnebago is one of these core names along with Ford Industries, which is a major competitor. But one of the things about their business, and I think that's demonstrating improvement, is they seem to be touching on the lower price point consumer. They've gone through some challenging price mix and inventory mixes, moving off inventory to lower prices, and in fact, some of their newer inventory is attracting some high-scale customers as well. So they seem to be bifurcated in terms of their strategy mix. Lots of the lower end, low price points, but also some of the luxury brands where they're generating quite a big, large profit margin. Now, if you look at their quarter, it was actually quite good. On an adjusted basis, they posted 38 cents. They were expecting essentially 13 cents. They beat it by quite a large margin. And last year, for the same quarter, they lost money. So that's important in the context of the trend reversal I'll talk about in a sec. And at the same time, too, sales were unexpectedly higher. Came in around $703 million for the quarter. About 71 million higher than the 629 million estimated, roughly speaking, and that was higher by about 12%, forgive me, year over year. But the kicker, I think, is in terms of guidance revisions relative to the price action, you can see there's an approximate 8.5% move as we move into the close on Winnebago. But for the full fiscal year, they actually moved their adjusted earnings guidance for the full year higher. So they were expecting at the midpoint around $2.35. They increased that by about 10 cents or $2.35. While at the same time, their sales guidance increased just slightly to $2.9 billion for the year versus $2.85. Now, it's been my observational experience in the past that typically speaking, not always, but typically, if you move the entire fiscal year guidance by a certain percent, you can actually see about double that in price. And if you look at the math, the 10-cent adjustment for fiscal year 26, it's about 4.5% increase. And so you essentially see nearly double that increase. Earlier today, get that in terms of price. So I think what's happening here too is we are seeing the potential of a major trend reversal here in Winnebago. Looking at, for instance, technically speaking, it's broken back above the 50 and the 200-day moving average. And in fact, 50-day moving average is above it. So for what it's worth, they seem to be improving their product mix, their revenues, their operational efficiencies, integrating EV technologies, of course, is part of that. But their profitability profile is improving, considering that in the trailing 12 months, gross margins have been down by about 300 basis points over their 5-year averages. Net income was barely positive. I mean, if you look at their sales, about $2.8 billion last year, they generated only $26 million in profits. So that gives you an idea that they were really struggling to move inventory and retain some profits. That's why the price had been moving down. But effectively, go back just to 2022, the company was generating over almost $5 billion in sales, and they generated about $400 million in net income. So since, of course, the peak of the pandemic, the company has tried to deal with, getting that consumer to buy, challenges with interest rates have been there, but at the same time, moving the product mix and, of course, increasing efficiencies. And, for what it's worth, it seems to be the case where we're seeing a reversal in the stock. This is the second quarter where you see this sort of convexity happen in the earnings, but also relative to looking at the one-year price action, you can actually see in the chart.
Okay, I mean, despite the macroeconomic challenges, it looks like there seems to be a winner amongst all of that. But thanks for giving us across the report card and the reaction to the stock today. We have got to share sitting up 8.5%.
George.
Thank you so much, George, for that. I'll send things back over to Tom in Chicago for now.
Yeah, Sam, we're near the end of the market session. We're going to bring in Kevin Green to break down levels. He's watching the S&P 500 to discuss this week's action. That's next here on Market on Close.
Nice little reversal there.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, global movers, just the trades that matter. As the bell hits and the markets react in real time.
Perfect.
Opening Bell, live with the NYSE, right when it counts.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make-or-break level for this stock.
And that could certainly be short to near-term catalysts.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network. Back here on Market on Close, I'm Sam Vidas here on the floor of the New York Stock Exchange alongside Tom White in our Chicago headquarters. So we're just a few minutes left in today's session to close out the week, so let's welcome in Kevin Green, Senior Markets Correspondent, to do just that. We've managed to hold up here at KG as we've seen an extension of these gains with the rotation back into technology, very much leadership, kind of taking the reins back, you could say, for these markets. What are you seeing out there? What levels are you watching into the close?
Yeah, I would agree. I mean, we actually obviously started off fairly strong here today. We saw some resistance around that 68.40 level, and we kind of highlighted that earlier on this morning. Now, this options expiration obviously kind of started off with some fireworks, and it's been consolidating ever since here. And going into the close, I definitely want to close around these current levels, not to see any type of reduction to the downside or move to the downside here. We have broken through some critical areas of resistance on the chart, especially that 200 period moving average on the 15-minute chart. bar. So into the close, kind of looking at this wedge type of pattern that kind of just gotten broken here, but you want to be able to hold the 68.20 level to the downside, and then to the upside, once again, 68.40 is a major area of resistance. So you have seen volatility actually crush pretty aggressively here. It's probably a little bit too low, to say the least, just given the fact that we still have some economic events on the calendar for next week, and then also leading into January, which could be a very volatile month. But overall, this is actually a pretty successful day, and the bulls were able to kind of recapture some of the losses that we saw early on this week.
Yeah, KG, I want to kind of expand on that volatility discussion because, you know, this triple witching that we're supposed to have maybe going to add some additional volatility at this point, but it's a big giant nothing burger here today with the VIX near the 15 level. But is that maybe reflective more of the fact that we're going into a holiday shortened week? There's not a lot of data, there's no earnings out there, so maybe there's no headwinds out there for markets at this point, and nobody's putting on any hedges if we're going to probably be in risk on a rally.
Yeah, I would agree with you. I think that's how the market is positioning. And then also, as well, we saw a significant amount of notational value actually expiring here today. So that also then has an impact on the wings if you're looking at the out-of-money calls as well as the out-of-money puts, which is being calculated for the VIX. So you are seeing that crush here a tad bit here, Tom. And actually, if you kind of look at next week, we should actually expect low volume markets as well as low liquidity markets. So I would kind of caution the trading action for next week, and it's going to be a little bit difficult for those that love technical analysis because you are going to see very low volume. So the price action can give you maybe some false signals or a false sense of confidence that particular stock or index is moving in one direction or another. So that's exactly what's occurring right now. Usually when you get to these levels around that 15 VIX or even a 14 handle on the VIX, it doesn't stay there for too long. You usually do see a re-rating either the next trading day or the trading day after, and I would expect that would be the same thing after next week.
Less than a minute.
A dull week is being priced into the market, but anything can happen. Obviously, we do have the weekend as well. Maybe see geopolitical risk can creep into the market here, but overall, once again, I think it's actually a win for the bulls, given the fact that aggressive selling pressure.
Ding, 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 ding.
Talk about that, and I'm just wondering, what sort of levels have been standing out to you today? I mean, we've been looking at the stocks. It's been a pretty good day for chips all around. I mean, names like AMD. I mean, you've got some of your memory names rallying. You've got Sandisk up 8%. You've got Micron putting on another 7% right now. So I'm just wondering, as far as some of those key names, which no doubt have been propelled by that good report we got out from that particular name, as we see an extension of those gains today, what you're seeing sort of into the close right now as far as levels.
Very good. It was one heck of a week. A very volatile week. Which, are we going to have a Santa Claus rally next week? I don't know. But it sure, tells me that we really pulled back this week, consolidated. So I'm going to get out of here, get caught up on my videos,